Sir, very happy afternoon to all. Sir, we have completed the quick revision of the chapter cost of capital. I'm moving into the workbook solving of the cost of capital. We are having 3 questions, my dear lovable students. Beautiful 3 questions. Bounce Limited evaluates all its capital project using discounting rate of 15%. That means KO is equal to 15%. Answer is given in the question. Its capital structure consists of equity share capital, retained earnings, bank term loan, and debenture at par. So 4 sources of finance are there: equity, retained earning, bank term loan, and debenture at par. Can I proceed? Rate of interest, sir, that is KD, and on bank term loan is 1.5 times that of what? Debenture. That means if debenture's rate of interest is X, then bank term loans rate of interest is 1.5x. Remaining tenure of both debenture and bank loan is 3 years and 5 years respectively. That means for debenture it is 3 years, and for bank loan, that means both are redeemable. Book value of equity share capital, retained earning, and bank loan is 10 lakh, 15 lakh, and 10 lakh respectively. Debenture which are having book value of how much lakh? 15 lakh are currently trading at 97 per debenture. Since the current market price is 97, it's better or logical to choose the face value as 100. Actually, till now they have not mentioned about the face value. So I'm assuming the face value to be, because 100 ரூபாய் current market 97 rupees current market price இருக்கும்போது 10 ரூபாய் என்னால சொல்ல முடியாது. The ongoing P multiple for the shares of the company stands to be what? 5. So the current price earning ratio is equal to 5. You are required to calculate the rate of interest on bank loan. Rate of interest. That means KD on the what loan? And debenture, again KD. This is bank loan. So it will be represented as KT. KT, term loan. KT, okay. And debenture is KD if the applicable tax rate is 25%. Super question, fantastic question. Sir, first of all, let the rate of interest be X, debenture be X. We are assuming that the interest on debenture be X. I don't know. So rate of interest on loan will be 1.5x. First, this proposition, have you understood? I'm going to find out the KD, cost of debt. From the question, I understood that there is life for the debentures, right? If there is life for the debenture, then KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. This formula pakka? Okay. Sir, interest. What is the rate of interest for debenture? I don't know. X percentage. Am I right? Sir, I will always pay the interest on face value. That means 100 into X. That's what 100X. That's what? Sir, if it is 5%, 100 into 5%, 5. If it is 10%, 100 into 10%, 10. I don't know. So I took face value into X percentage. That's what X? 100X. So I got the I. What is I? 100X. I into what minus C? 1 minus C. That T has been given in the, that's 1 minus 0.25. That means revenue expenditure, dandanaka done. Are you really with me? Plus what expenditure? Capital expenditure. Sir, this is debenture. Sir, how I am going to redeem the debenture? Have they mentioned in the question how are they going to redeem the debenture? Have they mentioned specifically? Yes, sir. At what? Par. In line number. Third line. That means, sir, look at here. Its capital structure consists of equity share capital, retained earning, bank term loan, and debenture at par. Debenture at? That means they are going to redeem at par. If nothing has been mentioned also, we'll assuming that assumption only. Yes, sir. That means 100 rupees I am supposed to repay. Yes, sir. But today, the current market price is 97. That is the net proceeds. So there is a loss of 3 per debenture. And the life of the debenture is also how many years? So every year, I am having capital loss of 1. But question did not mention that capital loss is tax deductible, right? But interest is always what deductible? Tax deductible. Comfortable? I will not take opening liability. I will not take closing liability. I will take only average liability. That's what 100 plus 97 divided by 2. Pakka? So here, is it 100x? 100x. 1 minus 0.25 means 0.75. Up 100 into 0.75. That's what 75x plus 3 rupees is the capital expenditure for 3 years, right? So 3 by 3, 1. That's what the share of capital expenditure. Divided by average liabilities, 98.5. I can't do anything further. I have end up with an equation. Can I proceed? I'm moving to the cost of bank loan, KD. KD, or it can be called as KT. KT. Right. If you want, you can call it as KD itself. I don't have any problem. My dear lovable students, here you should be very, very specific. This is what cost of what loan? Bank loan. For a bank loan, sir, if the bank give today 70, repay 100, such foolishness is not there. In what loan? If you take 10 lakh loan, repay 10 lakh loan. Are you all really with me? Will never have what loss? Capital loss. Will never have capital loss. But there will be capital loss or capital gain in case of debenture. But for a bank loan, there won't be having. If you take 10 lakh rupees loan, we are supposed to repay 10 lakhs. That's it. Game over. Are you all really with me? So the formula will be I into 1 minus T. I into. Sir, I into 1 minus T divided by NP into 100. What is the concept of net proceeds? Because net proceeds and the redemption value always will be one and the same. Then why are you going for that formula? Correct? Okay, man. Sir, you know what is the interest, percentage of interest for bank loan? Don't know, but you know the relationship, which will be 1.5 times of debentures. That's what 1.5x. That's what I into 1 minus T, which is 1 minus 0.25, which comes to 0.75. So 1.5 into 0.75 comes to 1.125x is the KT. KT. What is KD? 75x plus 1 divided by 98.5. What is the KT? 1.125x. Are you understanding? Now I am calculating the KE. What, man? KE. Sir, we are having 6 approach to find out the KE. Number 1, dividend price approach. What is the formula for dividend price approach? DPS 1 divided by MPS 0. Earnings price approach. EPS 1 divided by MPS 0 into 100. Have you heard about price earning ratio? Which is nothing but MPS divided by, here numerator is denominator and denominator is numerator. Getting it? That means KE is equal to 1 divided by price earning ratio. Can I write like that? That's what directly KE has been given in the, but indirectly. Are you all really with me? So 1 divided by P ratio. So 1 by 5 is equal to 20%. Are you all really with me? That means the price earning ratio is equal to MPS divided by EPS. MPS divided by, tell me, sir, 1 divided by 5 comes to 20%. Is the, sir, KE is equal to KR. KE is equal to KR. That means how much percent? 20%. Because there is no flotation cost in the question. If there is no flotation cost, KE is equal to, can I calculate the WACC? You should help me. Sir, is equity is there? Reserves is there? Debentures is there? Bank loan is there? These are the source. Tell me, what is the book value of equity? 10 lakhs. You have to see the question and tell me. Reserves, 15 lakhs. Debenture, 15 lakhs. Bank loan, 10 lakhs. So what is the total capital employed? 15 lakhs. Is this book value or market value? Book value. Can I find out weight? 10 lakhs divided by 50 lakh, 20%. 15 lakhs divided by 50 lakh, 30%. 15 lakhs divided by 50 lakh, 30%. 10 lakhs divided by 50 lakh, 20%. Total 100%. Comfortable? Are you really with me? Sir, KE is equal to 20%. எப்படி calculate பண்ண? 1 by price earning ratio. What is price earning ratio? 5 times. 1 by 5 comes to 20%. Sir, KR is equal to KE, 20%. Why KE is equal to KR? No flotation cost. No flotation cost. Are you able to match it? Sir, KD already you find out, which is I into 1 minus T. What is 1 minus T? In this question, what is 1 minus T? 75%. That is 1 minus 0.25 comes to 0.75. What is the face value? 100. 100 into 0.75. That's why 75x plus there is a capital loss of 3, life of 3 years, 3 by 3, 1. That's why plus 1. Divided by, I will not take the opening liability. I will not take the closing liability. I will take the average liability. Comfortable? That's why 98.5. Comfortable? Which is calculator, man. 75 into 0.3. 22.5x. Have you understood how it become 22.5? 1 into 0.3. 30 paisa. Correct? Divided by 98.5 into 0.3. Correct, sir? Panna? Correct, Alia? Yes, sir. So, my dear lovable students, it is because this is what by what? 0.3 divided by 1. Correct? So, 75 into 0.3 comes to 22.5x. 1 into 0.3 comes to 98.5 into 1. 98.5. Comfortable? You know it. Sir, the second part, man. Again, it is, sir, 0.2 divided by 1. Correct? Only numerator is there, so point divided by 1 does not have any sense. So 1.125 into 0.2. 0.225x. Correct? Sir, KO given in the question as already given one start. First line. Comfortable? So you tell me 4 plus 6. 10. So these two comprises 10. Correct? Total, that means this should be 5%. This should be, that means, my dear lovable students, I am solving for you 22.5x. Sir, 22.5x plus 0.3 divided by 98.5 plus 0.225x divided by 1. Nothing is there. Should be equal to 5 divided by 100 na 0.05 divided by 1. Correct, sir? Sir, can I cross multiply this? Yes, sir. That means 22.5x plus 0.3 plus 98.5 into 0.225 comes to 22.1625x divided by 98.5 comes to 0.05 divided by 1. Can I again cross multiply? Yes, sir. Sir, the same will be cross multiplication answer. 22.5x plus 0.3 plus 22.1625x should be equal to 98.5 into 0.05 comes to 4.925. Right, sir? Can I plus this x and x? That means calculator. 22.5 plus 22.1625 comes to 44.6625 plus x plus 0.3 should be equal to 4925. So 44.6625x should be equal to 4925 minus 0.3. Am I going correct, sir? That means, my dear lovable students, 44.6625x should be equal to 4.925 minus 0.3 comes to 4. So x should be equal to 4.625 divided by 44. So 4.625 divided by 44.6625 into 100 means 10.36% approx. 10.36%. That is x. Yaroda interest rate. Sir, the percentage of interest for bank loan will be 1.5x. Am I right? Should be equal to 10.36 into 1.5 comes to 15.53 3%. This will be the rate, man. Sir, if you find out, X will be 10.36. How much we got? X will be 10.36. Clarity? And the rate of interest on debenture 10.36 we finalize. And for bank rate 15.54, 15.5354, a round of difference. I believe that you are able to appreciate what is happening there. Clarity? Good question, man. Brilliant question. All questions are only brilliant. I'm not solving illustrations. Question every question will be having some adjustment. I sit, sir. Chuma Brahmandamana question we selected. Right, sir. Question number N. A done, N and M is a target. Information relating to book value and market value weight of X Limited is given below. This is with regard to book value and this is with regard to market value. Right, sir. Equity share capital book value 2 crore 40 lakhs. Retained earning 60 lakhs. Preference 72 lakhs. Debenture 18 lakhs. Sir, in market we won't trade retained earnings. Right, sir? Because retained earnings is a bookish concept and not a markish concept. Correct? Yes, sir. Equity share capital 4 crore. Sorry, FD sir, inga 2 kodi 40 லட்சம். Inga FD sir 4 crores. Because it is including retained earnings. Preference share 67 lakh 50 and debenture 20 lakh. Additional information. Equity shares are quoted at how much per share? 130%. That means current market price is equal to 130. And new issue priced at rupees 125 per share. Be fully subscribed. Flotation cost will be how much per share? 5 per share on what value? Face value. That means, sir, for KR, I will consider 130. And for KE, I will consider 125 minus 5 is equal to 120. Comfortable? Because there is flotation cost. If flotation cost is there, KR is not equal to KE. During the previous how many year? 5 year. Dividend have steadily increased from rupees 10 to 16.105 per year. That means 5 years back the dividend was 10. It has grown to 16.105 per share. Correct? So this is Wi-Fi. This is Wi-Fi. And this is Y1. Correct? Or you can Y0, but dividend always will be paid at the end of the year 1 only, no? That's why I technically called it as Y1. This is not for the time value of money anyway. Correct? Dividend at the end of the current year is expected to be 17.716. That is Y6 is 17.716 per share. Story correct? 5 years back, they gave a dividend of 10 rupees. After 5 years, it grown to 16.105. After current year means 5th year over. At the 6th year, they are giving 17. So calculator 17.716 minus 16.105 divided by 16.105 into 100. My dear lovable students, 17.716 minus 16.105 comes to 1.611 divided by 16.105 into 100. Right, sir? Comes to 10% is the growth rate. Are you all really with me? G, I have find out. Paka? I can't compare this gap. But I can compare this gap. Because this rate will be rate for 5 years. I don't want the rate for. I want the annual growth rate. What growth rate? That's why I compared Y6 with Y5. Instead of I compare Y5 with Y1. I hope clarity. So dividend at the end of the current year is expected to be 17.716 per share. 15% preference shares with a face value of rupees 100 would realize 105 per share. Market price has been given 105. Can I proceed? Company proposed to issue 11-year 15% debenture, but the yield on debenture of similar maturity and the risk class is 16%. Brilliant. Flotation cost 2% on face value. Corporate tax 30%. You are required to determine the weighted average cost of capital, WACC. That means we have to calculate the KO of X Limited using both the weight. What is both the weight? Book value weighted, market value weight. Is market value given in the question? Yes, sir. Both weight they have separately given. Beautiful question. I will solve it. Don't worry at all. Be with me. Process your brain. Sir, cost of equity is KE. Yes, sir. KE, what is the formula for KE? DPS 1 divided by MPS 0 plus G. But since there is what cost? Flotation cost. I can't take the entire market price. Correct? Okay, man. What is the DPS 1? They themselves given 17 point. That's what 17.716. Divided by what is the current market price? 125. 125. But once you issue share, we are supposed to pay flotation cost. That's what 125 minus 5. Correct? Plus, my dear lovable students, 10% growth rate. We find out Y6 minus Y5. Yes, sir. Plus G we find out. Yes, sir. How much percent? 10%. So, calculator, man. 17.71. Okay, sir. 17.716. Right. 17.716 divided by 120 percentage plus 10 comes to 24.76 percentage is the KE. For that, we have used the growth rate of 10%. Sir, can you say how you find out 10% growth rate? DPS 6 minus DPS 5 divided by DPS 5 into 100. Everyone brain working? Sir, 17.715 minus 16.10 divided by 16.10 comes to 10%. Can I proceed? In every question, I will assume that KE is equal to KR if there is no flotation cost. But there is what cost? Flotation cost. My dear lovable students, hence the formula will change. Formula? That means DPS 1 divided by MPS 0 plus G. Enga sir formula change? Figures will change. Correct? What is DPS 1? 17.715 divided by MPS 0 will not be 125 minus 5. MPS 0 will be 130. 1. Go back and read. Equity shares are quoted at how much per share? 1. அப்ப இப்ப எவ்வளவுல போயிட்டு இருக்கு? 130ல போயிட்டு. And new issue priced at what? 125. கண்டிப்பா சார், if you issue more number of shares, pricing decreases, sir. Yes, sir. Yes, sir. And out of this 125, flotation cost will go for 5. Right? So that's why KR is cheaper than KE. Because in KR, you won't have flotation cost. But in KE, you will be having flotation cost. The denominator, that is the fund available from the equity will be less as compared to the KR. Sir, in KR, you can enjoy 130. But in KE, we can enjoy only 120. That means here I am paying this 17 point something in order to enjoy 120. But here I am paying 17 point something in order to enjoy 130. Clarity. Calculator man. 17.716 divided by 130 into 100, 13.62 plus growth rate 10%, 23.63, which will be less than KE because KE is costly. Why costly? Flotation cost. This flotation cost will not be there for KR. Can I proceed? That's it. I'm calculating the cost of preference shares. KP. Is the preference shares redeemable preference shares or irredeemable preference shares? Irredeemable preference because redemption value or life has not been given in the question. So which is nothing but KP is equal to PD divided by NP into 100. Correct? KP, PD, they themselves given how much percent preference share? With face value of 100 into 15%. 15 rupees, that's it. So 15 divided by, tell me, what is the net proceeds? 105 into 100 means 14.29%. Pakka? I'm coming to KD, the real essence of the question. This adjustment is important, man. Company proposed to issue how much year? That means it is a redeemable debt. How much percent debenture? That is the coupon rate. That is the, but the yield on debenture on similar maturity and risk class is 16%. That means, I will tell you, assume our company's face value is 100. Okay. We will pay an interest of 15%. 15 rupees will pay as dividend. Interest. But the similar type of company, same like our company, sir, exactly like our other company in the market is giving 16%. How much percent? Will any investor will come and invest with us? Avana mental ave. Ena market it is available 16%, but we are giving only, that means this rupees 15 should be 16%. Correct? Calculator 15 divided by 16% comes to 93 point will be the net proceeds. Are you really with me? Then they will give only 93.75, not 100 rupees. If they give 93.75, we will pay 15%. For them, it will be 16%. Then they will see it as, sir, indifference point. Whether I will go and invest in some other company or whether I will invest in this company, I am getting same return of 16%. Actually, what was missing in the question is the NP, net proceeds, what missing? What? But after how many year? 11 year, I have to repay 100 rupees. Purida? So with this, I am doing the question, man. KD is equal to I into what minus T? 1 minus T. Plus RV minus NP divided by N. Whole divided by RV plus NP divided by 2 into 100. Tell me, what is the I you are paying? 15. We are paying 15 only. There is no doubt. 1 minus T, tax rate is 30%. This is the revenue expenditure plus capex. What is the RV? 100 minus sir NP. Inga paru, we are going to pay 15 rupees 15. This should be 16% to the debenture holder. Pakka comes to 93 point. So we will get only 93.75. But we have to incur flotation cost of 2% on the, what is the face value? 100. 100 into 2%. 2 rupees. That means 93.75 minus 2 comes to 91.75. That's what 91.75. Clear point, clarity? Divided by 11. What is 11? Life, remaining life. Sir, divided by 100. What is 100? Redemption value. 91.75. Net proceeds divided by 2 average. When we solve, we will get 11.73%. Can I proceed? This one note, since yield on similar type of debenture is how much percent? Yield means return. So if a debenture holder is investing in some other company than this company, they are getting a return of, the company would require to offer debenture at a discount. Correct? If they issue at 100, no one will subscribe. Because if they invest 100, we will give only 15. So they will be having a return of only 15. Why they have to invest in our company? They will be investing in other company. Clarity. So we have to issue at a discount. Once we issue at a discount, we will end up with capex. Yes, sir. And we have to also incur the what cost? Flotation cost to the extent of 2 rupees. Can I proceed, sir? So my dear lovable students, so market price of the debenture using the approximation method. What method? I am going to pay 15, which will be 16% for the debenture holder. So total comes to 93.75. So sale proceeds from debenture is 93.75 minus 2. Sir, you will be getting 91.75. Can you proceed? The same 91.75 can be found out by using the present value method. What value method? Simple. Sir, how much interest you are going to pay? 15%. 15 rupees. 15 rupees. What is the expectation of the debenture holder? 16%. For how many years? So can I take cumulative present value factor? 11th year GT press பண்றதுக்கு முன்னாடி வெயிட் பண்ணு. 11th year reach பண்ணிட்டு GT press பண்றதுக்கு முன்னாடி வெயிட் பண்ணு. 1 divided by 1.16 is equal to அப்படி second year, third year, fourth year, fifth year, sixth year, seventh year, 8th year, 9th year, 10th year, 11th year. How much getting? 0.19. இங்க பாரு. This is what 0.1954. Because on 11th year, debenture holder will get redemption value. Correct? For the 11 years, he will get interest also. Yes, sir. If you press GT, you will get 5.0287. If you do like that, After GT, no need to again go back for 11 years. Or you have to do the memory recall or something. Hello? Okay, right. So, debenture holder is going to get 15 rupees for 11 years at an expected rate of 16% plus 100 rupees at the end of 11th year with an expectation of 16%. Comfortable? Sir, what is the value of an asset today? Present value of its future cash flow? Pakka? For future cash flow, 15 into 5.0287, I will get 75.4305. Comfortable? 100 into 0.1594, sir, 19.54. You will be getting 94.9705. From this, 2 rupa will be swaha. Another flotation cost, then 92.9705. Sir, answering a 92 worthy, answering a 91 worthy. It will not match because this is approximation method. For 11 years, you just, without considering the time value of money, you calculated. Clarity? But sir, here we have considered the what value of money? Time value of money. So this will be accurate and that will be approximate. Comfortable? So accordingly, the cost of debt can be calculated as follows. As per the book value of weight, can be equity shares already given in the question, 2 crore and 40 lakhs. Retained earning, 60 lakhs. Preference share, 72 lakhs. Debenture, 80 lakhs. Total 3 crore. Since the weight is book value weight, I will consider the what earning? Retained earnings. Comfortable. Calculator, 2 crore 40. That is 240 divided by 390 into 100 means 61.54% is the proportion. Like that for everything, I can find out the weight. Yes, sir. I calculated KE, individual cost of capital, 24.76. In every question, my dear lovable students, KE will be equal to KR. But this question we are having flotation cost. Since if flotation cost is there, KR will be less than KE. Concept clear? Yes, sir. That's why KR is 23.63% because the capital base will be more. Clarity? For preference shares, KP 14.29% and KD 11.73%. Now what I have to do? I have to find out the weighted KE. Sir, 24.76 into 61.54% comes to 15.24%. For retained earnings, sir, 23.63% into 15.38% comes to 3.63%. Comfortable? Sir, 14.29 into, sir, 18.46% comes to 2.64%. 11.73 into 4.62 comes to 22.05 is the WACC as per book value weight. Book value weight. Sir, when you are taking the KD net proceeds, why you have not considered 92.9705? Why you have considered 91.75? Purida. If I would have taken here 92 something, I would have got some other KD. Sir, KE approximation method. KP approximation method. Hence KD also approximation method. If one element I will do with the time value of money, there will be a comparison between coconut, sir, manga and tenga. Correct? So everything I'm going with the approximation method. Comfortable? Now I'm going to put the market value weight. Who will be absent? Retained earnings. Retained earnings will be absent. What is the total capital? 4 kodi, 4 crores. Look at here. In book value weight, you are having what and what? Equity and retained earnings. Right. That is 240 is to 60. 240 plus 60 comes to 300. So calculator, 240 divided by 300 comes to. So 80% of your book value comprises of equity and 20% of your book value comprises of retained earning. Is there flotation cost? In the question, is KR is equal to KE? No, sir. Then mandatorily I have to bifurcate this into 80 and 20%. Concept clear? If KR is equal to KE, When I am doing the question with what weight? Market value weight, I can ignore the retained earnings. Every student would have understood that. Okay, book value weight la pota enna varum? Retained earnings varum. Ana market value weight la pota retained earnings varadu. Varu equity mattum da varum. Tappu. That will hold good if KR is equal to KE. But if the KR is not equal to KE, I have to mandatorily bifurcate the market value of equity into equity, share capital, and retained earnings. Beautiful concept, right, sir? So 80% na total how much? 4 crores. 4 crores into 80%, 3 crore 20 lakhs. 4 crore into 20%, 80 lakhs. Comfortable? Preference shares, man. I have to calculate, man. How much is they themselves given? 6750 and 20 lakh 80. Nothing to calculate, right? Yes, sir. 67 lakh 50 and 20 lakh 80. Sir, this is the market value of the firm. This is the total is mistake. 3 crore 20 lakhs plus 80 lakhs plus 67 lakh 50,000 plus 20 lakh 80,000 comes to 4 crore 88 lakh 30,000. Comfortable? Are you all really with me? Come on, man. 3 crore 20 lakhs divided by 4 crore 88 lakh 30,000 into 100 comes to 65.53 is the proportion of the equity. Appreciating? Just this total only, just printing mistake. Simple, sir. If you want, you can write. If decimals are still going, you can write 320 divided by 488.3 like that. Okay. It won't make much difference. 1 or 2 decimals. Alright, sir. So, my dear lovable students, individual cost of capital, KE 27.76. Already find out. KR 23.63. Right, sir. If both are one and the same, no need to split. Otherwise, we are mandatorily liable to split. KP 14.29% and KD 11.73%. Comfortable? One thing we'll calculate, man. 24.76 into 65.53 comes to 16.23%. Pakka? 23.63 into 16.38 comes to 3.87%. Pakka? 14.29 into 13.82 comes to 1.97%. Pakka? 11.73 into 4.26 comes to 0.50. And the KO as per what value weight is 22.57 and here 22.05. Not much difference, but still difference is different. Right, sir? Sir, we have bifurcated the total value of the equity into equity and the retained earnings in the same ratio. There are 3 crore 20 lakhs and 80 lakhs. Done. Comfortable? Are you able to appreciate? I'm coming to the last question of this discussion, which is question number M. Calculate the WACC, again KO, using the following data by using what value weight? What value weight? Capital structure of the company, debenture 5 lakh, preference shares 5 lakh, equity 10 lakh, total 20 lakh, 110. Correct? Market price of these shares are debenture. How much per debenture? 105 per debenture. Preference shares 110 per preference shares. Equity, additional information. Rupees 100 per debenture, redeemable at par, 10% coupon rate, 4% flotation cost. How much year maturity? That means they are indirectly saying that the debt are redeemable debt. Rupees 100 per preference shares, redeemable at par, 5% coupon rate, 2% flotation cost, and 10-year maturity. That means preference are, if the debt is a redeemable debt, if the preference shares is a redeemable preference shares, then YTM will be applicable. ARR method is followed instead of approximation method. Equity shares have rupees 4 flotation cost and market price of 24%. The next year expected dividend is rupees how much? 1 with annual growth of 5%. So G is equal to, the firm has practice of paying all earnings in the form of dividend. Corporate tax rate 30%. Use what method to calculate the cost of debentures and the preference shares is a question. That means basically we have to calculate KD and we have to calculate KP by using the YTM, yield to maturity method. Everyone knows approximation method. If you prepare only that and go, then this will come in examination for 8 marks. Swaha. Can we calculate the KE? Yes, sir. KE, full form, cost of equity. What is the life of KE? Soliya. Infinite period. That's why YTM is not applicable to KE. In order to apply YTM approach, sir, life should be there. Correct? RV minus NP should be there. But there is no RV for the equity shares. So that's why, so KE is equal to formula DPS 1 divided by MPS 0 plus G into 100. Sir, have they given the next year dividend? The next year expected dividend, that means DPS 1 is equal to 1. That's what 1. So they will be expecting 1. In order to get that 1, they will be investing today how much per share? 24 per share. But out of 24, we will be paying 4 rupees what cost? So 24 minus 4 plus growth rate, they have mentioned as 5%. That means what is the KE? 10% is the KE. 1 divided by 20%. 5 plus growth rate of 5. 5 plus 5, 10%. Can I proceed? Now I am going to calculate the KD not by approximation method, by using the YTM method. Correct? KD, what is the current market price? Current market price of the debenture? 105. Can we enjoy 105 or we are supposed to pay the flotation cost? Flotation cost. How much percent? 4% of 105. Correct? That means 105 into 96% comes to 108 will be the cash outflow from the pocket of the debenture holder. Debenture? Sir, what is YTM? It is a rate at which present value of the cash inflow will be equal to present value of the... Sir, I don't know at what rate I have to discount. Use the approximation method. Solve the question as per approximation, which is KD is equal to I into 1 minus T plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Purida. What is I? 10. Correct? 10 into 1 minus tax rate 0.3 plus RV 100.8 minus NP 100 divided by RV 100.8. 105 is the current market price, man. 100 only RV, no. RV is only 100, no. Net proceeds only 108, liya. Yes, sir. Yes, sir. Tell me, what is RV? 100 minus NP 100.8 divided by N life whole divided by 100 plus 100.8 divided by 2 into 100. So tell me, 7 plus or minus minus 0.08 divided by 100.4 into 100. So 7 minus 0.08. 6.92 divided by 100.4 into 100 comes to 6.89% is what the KD as per the... That's why they are discounting at 5 and 7%. Appa 6 kadil nikida. Pakka? Come on. Sir, in year 0, there will be a cash outflow of 100.8. Have you all understood how 100.8? What is the present value for today? 1. So, sir, 1 into 100.8 outflow is 100.8. For 1 to 10 years, interest I into what minus T? 1 minus T. 7 rupees will be inflow to the debenture holder. Yes, sir. Will you take present value factor or cumulative present value? Cumulative present value factor. Calculator. 1 divided by 1.05. is equal to for 10 years. 2, 3, 4, 5, 6, 7, 8, 9, 10 GD. 7.722. Correct? So 7 into 7.722 comes to 54.05 is the present value of the cash inflow. Correct? And on 10th year, he will get a redemption value of 100. Sir, whether I have to take the cumulative present value factor or present value factor at the 10th year? Present value. I will get 61.4. If I add this, I will get the present value of the cash inflow. Minus outflow, 100.8. So I am getting positive NPV. Correct? I don't want positive NPV. I want zero NPV because IRR is a rate at which my cash inflow will be equal to cash. Can we discount at 7%? Because எனக்கு இங்க பாசிட்டிவ் NPV வர்றதுனால நான் ரேட் என்ன பண்ணிக்கணும், அதிகம் பண்ணிக்கணும் இல்லையா? சேம் ஒன் கால்குலேட்டர் 1 டிவைடட் பை 1.07. Second year, third year, fourth year, fifth year, sixth year, seventh year, eighth year, ninth year, 10th year, GT. 7 point into 7, 49.17. Comfortable? And I have to take the present value factor for the 10th year at 7%, which come to 0.508 into redemption value of 100. I will get 50.8. So I am getting negative NPV, right, sir? Can I interpolate, sir? At how much percent NPV? 7% discount rate. I am having negative of 0.083. 0.83 negative. But I want NPV of 0. At 5%, I am having positive 14.65. Comfortable? That means, my dear lovable students, 0.83 plus 14.65 upon 0.83 into 2 is the gap, because 5 minus 2, 7 is equal to 2. So 0.83 plus 14.65 comes to 15.48 upon 0.83. So 0.83 divided by 15.48 into 2 comes to 0.107. Right? So 7 minus 0.107 comes to 6.89% is the KD as per IRR method. 6.89 is the KD as per approximation method. Sir, ரெண்டு மேட்ச் ஆகுது. நீங்க தான் சொன்னீங்க approximation methodக்கு டிஃபெக்ட் இருக்கு. IRRல தான் என்னவா இருக்கும்? ஆப்டா இருக்கும். Are you really with me? Coincidentally, this question it is matching. Every question it won't match. But approximation method gives you an idea where to start the discounting and where to stop the discounting. Comfortable? The same I am going to do with KP also. Cost of what share? Preference share. Sir, current market price minus flotation cost. You tell me what is the current market price? 110 is the current market price. Right? What is the flotation cost? 2%. 110 into 2%. 2.2. So 110 minus 2.2. 107. That means preference shareholder will invest 107.8. That will be the cash outflow at year 0 for the preference shareholder, right? Every year he will be getting preference dividend. How much percent? 5%. On face value. 100 into 5? 5. Correct? So 5 ரூபாய் கிடைக்கும் 10 வருஷத்துக்கு. So first I have to discount at 3%. I don't know, sir. Again, approximation method. Sir, KP is equal to PD plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. Comfortable? What is the PD? 5 plus RV 100. NP just now calculated. 107.8 divided by life 10 years whole divided by 100 plus 107.8 divided by 2 into 100. Can I proceed? So 5 plus 100 minus a plus a. Instead of plus it will become minus. Correct? Minus 107.8 minus 100 divided by 10 means 0.78 divided by 100 plus 107.8 divided by 2 comes to 103.9 into 100. Comfortable? So 5 minus 0.78 comes to 4.22 divided by 103.9 into 100. Right, sir? Divided by 103.9 into 100 comes to 4.06% is the. That's why I am discounting at 3 and 5 because it's between 4. Easy? Otherwise, examination you will be blah blah blah. Right. Come on. So calculator, man. 1 divided by 1.03 for how many years? 10 years. Tell me GT. Gross total. 8.530. Comfortable? What is annual cash inflow? 5 rupees. So 8.530 into 5 comes to 42.65. Comfortable? At the end of the 10th year, preference shareholder will get the redemption value of 100. The present value factor at 3% for the will be 0.744. Correct? Which is 74.4. If you add these two, you will get the present value of the cash minus outflow. You will get positive NPV. Comfortable? 9.25. 9.25. Hello? I understood. My IRR is not 3% because if it is 3%, I'm getting positive NPV. I want 0 NPV, right? So I'm increasing the factor to 5%, right? Again, calculator 1 divided by 1.05 for 10 years cumulative present value factor 7.722 into 5 38.61 will be the present value of the cash inflow for the preference shareholders. Comfortable? And he will get how much rupees also? 100 rupees also at the end of the, which has to be discounted at 5%. Correct? So 0.614 into 100, 61.4. If you add these two, you will get the present value of the cash inflow minus outflow. You will get negative NPV. Yes, I want that because IRR. Can I interpolate? Yes, sir. If I interpolate, my dear lovable students, at negative NPV, we will have 7.79. I want 0. Correct? But here 9.25. Here at 5%. Here at 3%. So calculator. 7.79 plus 9.25 upon 7.79 into, what is the gap? 2. So 7.79 plus 9.25 comes to 17.04 upon 7. So 7.79 divided by 17.04 into 2 comes to 0.91. So from this 5 reduce 0.91. 5 minus 0.91 comes to 4.08 or 4.09%. Pakka? Look at here, 4.06%. Here 4.08%. Because values are not that much. Chinna value than Elia. Yes, sir. அதனால தான் அவ்வளோ பெரிய டைம் வேல்யூ ஆஃப் மணி ஒர்க் அவுட் ஆகாது. பிகாஸ் எல்லாமே இங்கே பாரு 5% தான் டிஃபரன்ஸ் இருக்கு. இன்ஃப்ளேஷன் ரேட் டிஃபரன்ஸ் இட் செல்ஃப் இஸ் 5%. Basically 4.08% only difference are there. So it will not make much variations. Can I proceed? Now the main answer. I am coming to the WACC using the what value weight? Book value weight. Come on, sir. 10% debenture. How much given? Book value. Already given in the question. Everything has been given. Correct? Yes, sir. Next one, sir. 5% preference share. 5 lakhs. Equity share. 10 lakhs. Total to total comes to 20 lakhs. Proportion 25, 25, 50. Correct? Just now we calculated KD using the YTM approach, 6.89%. KP using the YTM, 4.08. For KE, there is no YTM. Yes, sir. Which is only formula method are there. So if you, sir, multiply 6.89 into 25%, 1.723. 4.08 into 25 comes to 1.10 into 50% come to 5. Total comes to 7.743. is the WACC or 7.74% is the WACC. Comfortable? Using what value weight? Book value weight. I'm moving into the market value weight. Comfortable? எவ்வளோ டிபெஞ்சர் 5,000 டிபெஞ்சர் at the rate of 105. Market value 5,25,000. Preference shares எவ்வளோ preference share 5,000 at the rate of 110. Total 5,50,000. Equity, how much equity share? 1 lakh. Market price 24. Total comes to 24 lakhs. Total 34 lakh 75,000, and there is no confusion of reserves and surplus. It's sir. I can find out the proportion. 5 lakh 25 divided by 34 lakh 70. That's what 15.1. 5 lakh 50,000 into 34 lakh 70. That's what 15.8. 24 lakhs divided by 34 lakh 75,000. That's come to 69.1. Sir, KD I find out using YTM. KP I find out using KE I find out using formula approach. Comfortable? 6.89 into 15.10, 4.08 into 15.80, 10 into 69.10. Total comes to KO is equal to 8. That's the WACC. Sir, here it is 7.74 only. But in market it is 8.59. Hello? This is more realistic than the book value weight. That's it. Sir, we are done with the 3 questions from the what of capital. So we have completed the revision of the cost of capital and also the workout. What you are supposed to do, I will tell you. You start doing these 3 questions by your own, then you will get 1,000 doubt. All those doubt also will get settled immediately if you do now. This is the maximum advanced question from this chapter. Very, very good questions, right, sir? In the coming slot, we will be revising the very next chapter called as capital structure theories. Capital structure theories. If 2 firms are alike in all aspects, except capital structure, will the value of the firm change or not is the question. We are having NI approach, NOI approach, traditional approach, MM approach, that is Modigliani Miller approach. Right, sir? Complete 3 questions and come back. We will complete this part. Shall we apply our discussion into the question, sir? This is a RTP May 2022 question. Following data relating to 2 companies belonging to the same risk class. Yes, when 2 companies are alike in all aspects, except what structure? Capital structure. Will the value of the firm change or not is the question. Correct, sir? Sir, they are of same what class? Risk class. Same risk class. Hello, sir. Sir, when 2 firms are alike in what aspect only? All aspects only. I will do this chapter at all. Correct? Sir, this is B limited and this is C limited. B limited is having debt. That means B limited is a levered firm. Whereas C limited does not have debt. They are unlevered firm. What firm, man? Equity capitalization rate. My dear lovable students, 18% is the KE of the C limited. KE is equal to KO. Correct? And the expected net operating income, EBIT, is how much lakh? 9 lakh. Why both the company are having same EBIT? Because if 2 companies are alike in all aspects, except will the value of the firm change or not is our discussion. Right, sir? You have to determine the total market value. Total market value means value of the and equity capitalization rate. Equity capitalization rate means and weighted average cost of capital. That means KO for each company. Sir, assuming no taxes as per MM approach. No taxes as per, because there was defect in the NOI approach. That's why who came? MM approach came. I don't really with me. MM said that I will prove to you with the tax and without tax. And the second part of the question, determine the same total market value, determine the equity capitalization rate and weighted average cost of capital for each company, assuming 40% tax as per the MM approach. Right, sir? So same question, the MM is going to prove that when 2 companies are alike in all aspects except capital structure, just because of the reason that one person are having debt and another person are having does not have debt, that because of that the value of the firm will not change. Are you really with me? If you critically analyze B limited and C limited 2 company, my dear lovable students, inga paru, sir, this is with regard to company number 1. And this is with regard to company number 2, right, sir? What is the EBIT of the first company? 9 lakhs. Okay, what is the EBIT of the second company? Same 9 lakhs. Because, sir, risk and return should be one and the less what man interest. Sir, what is the interest paid by the first company? What is the interest paid by? Which is 27 lakhs into 12%. Am I right? 3 lakh 24,000. Yes, sir. So 3,24,000 is the amount of interest, right, sir? But the second company does not have what at all? Debt at all. Hence, there is no interest at all. Are you all really with me? Yes, sir. So, my dear lovable students, 9 lakh minus 3,24,000 comes to 5,76,000 is the profit before tax. Can I proceed? Whereas in the second company, 9 lakh rupees is the profit before tax. Why are you staring? Sir, there is no tax. Then why are you writing profit before tax? My dear lovable students, less tax, dash, dash. Okay, wow. So, my dear lovable students, what is a PAT? Profit after tax. The profit after tax in company number 1 is 5,76,000, right? And profit after tax of the second company is how much lakh? 9 lakh. Now, is asking a very logical question. If you are holding 100% of the company as a whole, will you enjoy interest? EBIT minus interest? EBIT? EBIT. That means if you are holding 100% of the company, you will get both interest and PAT. Am I right? What is the interest you will get? 3,24,000. What is the PAT you will get? 5,76,000. So 3,24,000 plus 5,76,000 comes to. That means if you are holding 100% of the first company, you will get 9 lakh. Right, sir? But if you are holding 100% of the second company, you won't have interest. The interest will be 0, but you will be having PAT of 9 lakhs. So then also you will be having 9 lakhs. That means, my dear lovable students, if there is no tax, if there is, according to approach, according to what? If there is no tax, value of the levered firm is equal to value of the unlevered firm. Value of the levered firm is equal to value of the, this is what the logic. This is what the logic. Are you really with me? Value of the levered firm will be equal to value of the unlevered firm. So always is asking that whether you are having tax, not having tax, start your calculation with the unlevered firm. Start your calculation with the. So I'm going to calculate, man, assuming there is no tax as per what approach? So calculation of value of firms, that is B limited and C limited according to hypothesis. Hello, sir. So the market value of the C limited, who's the second company? C limited. What is their specialty? Unlevered firm. is asking that always first value the unlevered firm because they don't have debt in their what structure? Capital structure. For them, KE is equal to KO. So KE already given as 18%. That means KO of that company will be also 18%. So I am going to value the market value of the firm, unlevered firm. Right, sir? Sir, value of a unlevered firm is equal to EBIT divided by KE or KO, whatever it may be. Hello, sir. Is the EBIT given in the question? If you are 100% owner of that company, you can enjoy EBIT of 9 lakh and your expectation is how much percent? 18%. So 9 lakhs divided by 18% comes to 50 lakhs. Sir, tax there, tax not there. The proposition of the Modigliani and Miller is if there is no tax, value of the levered firm is equal to value of the. If value of the levered firm is equal to value of the unlevered firm, technically means KO of the unlevered firm is equal to KO of the levered firm. Comfortable? So value KE of an unlevered firm given is equal to KO of unlevered firm is equal to 18%. Are you all really with me? Now, sir, I have completed the value of the dash firm, unlevered firm. If there is no tax, value of the unlevered firm is equal to value of the. Now I am going to calculate the market value of the B Limited. That is the first firm. That is what firm? Levered firm. Sir, actually, if there is tax, sir, value of the what firm is equal to? Levered firm is equal to value of the unlevered firm plus DT plus what? DT plus what? Sir, what is the value of the unlevered firm? 50 lakhs. Just now we calculated. Are you really with me? Plus you are having debt, but you are does not have the T. T stands for what rate? Tax rate. Ennappa? That means 27 lakhs into 0. So 50 lakhs will be the what of the firm. That means, sir, what MM's hypothesis is saying that MM, Modigliani Miller, can be classified into how many categories? Two category, without tax and with the tax. Are you really with me? If it is without tax means value of the unlevered firm is equal to value of the levered firm, because whatever income you are getting from the levered firm, the same income you will be getting from the unlevered firm. Enna clarity? Are you really with me? Whereas, my dear lovable students, if there is tax, the value of the levered firm is equal to value of the unlevered firm plus DT plus what? DT. D means debt. D means tax rate. Can you proceed, sir? So here debt is there, but tax is not there. Are you all really with me? That means 27 lakhs into 0 comes to 0. So 50 lakhs plus 0 comes to 50 lakhs will be the what of the firm. So are you all settled? The settled in the sense means if there is no tax, value of the levered firm is equal to value of the. Now I am calculating the equity rate. That is equity rate. Are you really with me? And the WACC. You tell me what is the B Limited? B. B means what firm? Levered firm. Sir, why are you not calculating for C Limited? They are already given in the question, which is KE is equal to KO. Sir, whose KE is not given? B Limited's KE is not given. Are you really with me? Yes, sir. So I have to calculate the KE of the whose limited? Levered firm. Can we calculate KE? What is the EBIT of the company? 9 lakh. On that, the first company is liable to pay interest of 3,24,000. Comfortable? From the 9 lakh, if you reduce 3,24,000, earnings available to the equity shareholders are 5,76,000. Comfortable? Yes, sir. As per NOI, first you have to calculate the value of the firm. Am I right? Sir, I already said that MM approach is an extension of NOI approach. NOI fails to give operational clarification. Correct? Now MM is coming and saying that I will explain to you how exactly it will offset. So even the MM is also traveling the same route of the NOI approach only. NOI 5-step. Calculate the EBIT and interest. Then you have to calculate the value of the firm. Sir, in order to calculate the value of the firm is equal to EBIT divided by KO. But the KO of the levered firm is not given in the. Immediately MM is asking that there is tax, there is no tax. There is no tax. If there is no tax, value of the levered firm is equal to value of the. That means KO of a unlevered firm is equal to KO of a levered firm. Accepting. Are you all really with me? That means, my dear lovable students, I have to adopt the KE as the KO of a unlevered firm. I have to adopt the KO of a unlevered firm as the KO of the levered firm. Puruncha? That means, my dear lovable students, 18% is the KO of the levered firm or unlevered firm, because there is no tax. If there is no tax, my dear lovable students, value of the levered firm is equal to value of the. So calculator man, sir, 5,76,000 divided by 18% comes to, sorry, 5 lakh, 9 lakh, sorry, 9 lakhs divided by 18% comes to 50 lakhs is the value of the levered firm, which is equal to value of the unlevered firm. Why? Because there is no tax. If there is no tax, value of the levered firm is equal to value of the. KO of a unlevered firm is equal to KO of the. Sir, inside this how much lakh? 50 lakhs. For an unlevered firm, only equity will be there. Am I right? But for a levered firm, both debt and equity will be there. In that, KD will be constant as per NOI. The same assumption is there for Modigliani and Miller approach also. Are you all really with me? That means out of this 50 lakh, how much is the debt included? 27 lakhs. So 50 lakhs minus 27 lakhs comes to 23 lakhs will be the market value of the equity. Market value of, that means, my dear lovable students, sir, in the levered form, is debt is there or debt is not there? Debt is there. If what is there, debt is there, then automatically the fear of equity shareholders increases. Then it will not be 18%, it will be more than 18%, correct? So I am going to calculate the KE. Sir, KE means expectation of the what shareholder? Equity shareholder, which is nothing but earnings available to the equity shareholders divided by value of equity. What is the earnings available? 5,76,000 divided by what is the value of equity? 23 lakhs. So calculator man, 5,76,000 divided by 23 lakhs into 100 comes to 25.04% is the KE. Let me ask you a question. What is the KE of an unlevered firm? 18%. What is the KO of an unlevered firm? 18%. Because there is no debt in the what structure? That means the equity shareholders of an unlevered firm does not have BIAM, but the equity shareholders of the levered firm are having BIAM. Since they are having BIAM, automatically the return expected by the equity shareholders will also be more. That's why it is not 18%. That's why it is 25.04%. But my dear lovable students, the KO of both unlevered firm and KO of both levered firm will be one and the same. How to calculate the KO, my dear lovable students? You can calculate the KO by, sir, what by what? EBIT divided by value of the firm. What is EBIT? 9 lakhs. What is the value of the firm? 50 lakhs. So 9 lakhs divided by 50 lakhs into 100 comes to 18% is the KO. 18% is the, sir, the same KO we can find out by using WACC table. In the levered firm, equity and debt is there. What is the market value of equity? 23 lakhs. Just now you find out, right? What is the market value of debt? 27 lakhs. What is the total value of the firm? 50 lakhs. That means here I am not putting the book value weight. I am putting market value weight. Are you really with me? I can calculate the WACC using book value weight and what is my weight? What is my weight? That is 23 lakhs divided by 50 lakhs into 100 comes to 46%. 27 lakhs divided by 50 lakhs into 100 comes to 54%. Can I calculate the individual cost of capital? This is KE and this is KD, correct? My dear lovable students, KD already given in the question as how much percent? 12%. You tell me KO, sir. KO of a levered firm will be equal to KO of an unlevered firm if there is no tax. Conceptual clear? So it should be how much percent? 18%. Calculator, 12% into 54% comes to 6.48%. Am I right? So calculator man, 18% minus 6.48% comes to 11.52% is the weighted KE. Is the what KE? So this should be 46%. Am I right? So calculator, 11.52 divided by 46% comes to 25.04% should be the full KE. Sir, here 25.04%. Are you able to appreciate? That means one line summary of the entire discussion is approach can be classified into two categories. Without taxes and with the taxes. Are you really with me? If it is without taxes, man, value of the unlevered firm is equal to value of the, hence KO of an unlevered firm will be equal to KO of the. Fine, fantastic to the core. I'm moving into the next one, man. Assuming 40% tax as per approach. Are you really with me? Can I proceed as per 40%? Sir, with the tax, without tax? With the tax. If there is tax, value of the levered firm will be equal to value of unlevered firm. Or value of the levered firm will be more than the value of unlevered firm. more than the value of unlevered firm. I will prove you, man. The same question I can prove you, man. There are two companies are there, right, sir? Company number 1 and company number 2. Please help me. What is the EBIT? 9 lakhs. What is the EBIT of the second company? 9 lakhs. Sir, is the first company liable to pay interest? Yes, sir. What is the interest? 3 lakh 24,000. Second company put a dash. So earnings before tax of the first company 5 lakh 20 5 lakh 76,000. Are you really with me? 5 lakh 76,000. And here it will be 9 lakh. Sir, less tax at the rate of 40%, which is given in the question. So calculator, man. 5 lakh 76,000 into 40% comes to 2,30,400 is the tax to be paid by the levered firm. Are you really with me? Whereas 9 lakhs into 40% comes to 3,60,000 is the tax to be paid by the unlevered firm. That means the PAT, profit after tax, 5,76,000 into 60% comes to 3,45,600 will be the PAT of the levered firm. Am I right with my calculation? 9 lakh into 60% comes to 5,40,000 will be the PAT for the what firm? Unlevered firm. Now Modigliani and Miller is asking a basic question. My dear lovable students, if you, sir, have tax, if you are holding 100% of the debt and equity, will you get interest from the first company? You would have got interest of 3,24,000, and from the second company you would have got 0. Am I right? Sir, equity, sir, you would have got 3,45,600, and here you would have got 5,40,000. So calculator, man, sir, total return from the company 3,24,000 plus 3,45,600 comes to 6,69,600 from company number 1 and 5,40,000 rupees from company number 2. Am I right? That means if there is tax, automatically the return generated from a levered firm should be more than the return generated from a unlevered firm. Then if there are two cows, one cow is giving a milk worth rupees 6,69,600 and another cow worth rupees 5,40,000, will you buy both the cow at the same rate? That's why is saying that if there is tax, value of levered firm is equal to value of unlevered firm plus DT. Plus what? DT. Plus what? DT. Are you all really with me? That means nothing but, my dear lovable students, look at here, man. Value. So calculation of value of firms, that is B limited and C limited according to hypothesis, market value of C limited always as per First value the dash firm, unlevered firm. First value the unlevered firm. So for unlevered firm, look at here, man. Simple, man. You have to be with me. Sir, in order to value the levered firm, first I have to value the unlevered firm. Correct? Sir, value of unlevered firm is equal to basically EBIT divided by KE. This was the earlier formula if there is no tax. Correct? But if there is tax, sir, the equity shareholders cannot enjoy what? EBIT. Equity shareholders can only enjoy PAT. Are you all really with me? That means the value of NF firm is equal to unlevered firm is equal to EBIT into 1 minus T. EBIT into 1 minus T divided by KE. Divided by what? Tell me, what is the EBIT of the second company? 9 lakhs. 9 lakhs is the EBIT into 1 minus T. What is tax rate? 40%. So into 0.14 divided by what is KE? 18%. So calculator, 9 lakh into, sir, 0.6 comes to 5,40,000 is what? Look at here. 5,40,000 is the PAT. Are you really with me? That's what I've reached. If there is no tax, value of unlevered firm is equal to EBIT divided by KE. But if there is tax, value of unlevered firm is equal to EBIT into 1 minus T divided by KE. Puri the difference. That means 5,40,000 divided by 80%. So 5,40,000 divided by 80% comes to 30 lakhs is the dash of the firm. Value of the firm. If there is tax. If there is, let me ask you a question, sir, to ensure that you are with me for the calculation. My dear lovable students, have you calculated value of the unlevered firm? Yes, sir. Without tax, Yes, sir. What was the value? 50 lakhs. How much lakh? 50 lakhs. What is the tax rate? 40%. That means from 100 rupees, 40 will go. Remaining 60 will be there. So 50 lakhs into 60% comes to that 30 lakh only you have achieved or arrived here. Are you all really with me? So without tax, if the value is 50 lakh, and if I am paying a tax rate of 40%, with the tax, the value of the firm will be 30 lakhs. Are you all really with me? Now I have completed the valuation of the unlevered firm. Now I am going to calculate the value of the levered firm is equal to value of the unlevered firm plus DT plus what? Tell me, my dear lovable students, value of unlevered firm, if there is tax, will be how much lakh? 30 lakhs. Is debt is there for levered firm? அதனால தான் அது levered firm கூப்பிடுறோம். கரெக்டா? What is the debt? 27 lakhs is the debt. 27 lakhs is the debt. What is the tax rate, my dear lovable student? 40%. That means how much lakhs plus 30 lakhs plus 27 lakhs into 40% comes to 10 lakh 80,000 will be the DT. Right, sir? Abdina 30 lakhs plus 10 lakh 80,000 comes to 40 lakh 80,000 will be the value of the levered firm if there is tax. If there is appreciating, that means, my dear lovable students, 40 lakh 80,000 is the value of the levered firm if there is tax. Correct? But value of the unlevered firm is equal to how much lakh? 30 lakhs. That means 10 lakh 80,000 is the difference between value of the what in what? Levered firm and the unlevered firm. Right, sir? If you see, sir, if there is tax, if you are holding 100% of the levered firm, you can have 6,69,600. But if you are holding 100% of the unlevered firm, you are having only 5,40,000. Up 6,69,600 minus 5,40,000 comes to, you will be having 1,29,600 extra. If you are holding 100% of the what firm? Levered firm. Can I proceed? Yes, sir. 1,29,600. Sir, why I am having extra 1,29,600? Because the levered firm have paid a tax of 2,30,400. Can I proceed? But the unlevered firm had paid a tax of 3,60,000. Correct? So 2,30,400 minus 3,60,000 comes to 1,29,600. This 1,29,600 extra is available with the levered firm. Comfortable? Why, sir, this guy has paid less tax? Why, sir, this guy has paid more tax? Because of interest. Because interest is a tax deductible item. Interest is a tax deductible item. Are you really with me? If you see the interest, if you see the question, they are saying that, my dear lovable students, 12% is the KD. 12% is the, sir, the second company is having 1,29,600. Is this for 1 year? Lifelong. Every year, this 1,29,600 will come. Every year, 1,29,600 will come. Right? That means the cash flow is a perpetual cash flow. What cash flow? The value of an asset today is equal to cash flow divided by R. The R is how much percent? 12%. So 1,29,600 divided by how much percent? 12% comes to 10 lakh. That is the difference between the first company and the second company, 10,80,000. That's what we are finding out as DT. That is a logic of debt into tax rate. Are you all really with me? Are you all really with me? So 40,80,000 is the value of the firm. Can I continue with the second part of the answer? So you tell me, sir, total value of unlevered firm, how much lakh? 30 lakh. Because if there is tax, the value of the unlevered firm reduces. Correct? What was the value of the firm if there is no tax? 50 lakh. From that, they would have paid tax of 40%. So 50 lakhs and 40 lakh, 40% pochina 30 lakhs. Abdi calculate panna koodadu. Are you really with me? You have to calculate as EBIT into N minus C, 1 minus T divided by KE. Can I proceed? Yes, sir. So KE of an unlevered firm is equal to KO of an unlevered firm is equal to how much percent? 18%. Are you settled? Now I am going to calculate the market value of the B limited. That is what firm? Levered firm. Ipa na yara value panna poren? Levered firm. If there is tax, value of levered firm will not be equal to the value of the unlevered firm. If there is tax, value of levered firm will be more than the value of the unlevered firm. Comfortable? Yes, sir. So value of levered firm is equal to value of the unlevered firm plus DT plus what? DT. What is the value of the unlevered firm? 30 lakhs plus what is the debt in the levered firm? 27 lakh. What is the tax rate? 40%. So 27 lakh into 40% comes to 10 lakh 80,000 plus how much lakh? 30 lakhs comes to 40 lakh 80,000 is the value of the levered firm if there is tax. Comfortable? Now, sir, the WACC, weighted average cost of capital of C Limited. Who C? Unlevered firm. For them, the WACC is how much percent? 18%. Because KE is equal to, now I am going to calculate the KE and I am going to calculate the KO. Are you all really with me? Yes, sir. What is the EBIT of the levered firm? 9 lakhs. Less interest. Is there any debt in the capital structure? Yes, sir. Debt value of 27 lakhs. And the 27 lakhs interest 12% comes to interest of 3,24,000. Are you able to appreciate, sir? From the EBIT 9 lakh, if you reduce 3,24,000, what is the earnings before tax? 5,76,000. Is the levered firm liable to pay more tax or less tax? Less tax because of charging interest. Am I right? So less tax at the rate of how much percent? So 5,76,000 into 40% comes to 2,30,400 is the tax. Comfortable? So you will be getting a PAT, profit after tax of 5,76,000 minus 2,30,400 comes to 3,45,600. Right? Already we calculated the what value of the firm. Always MM is saying that take the total value of the firm. In case yaar irkangana, tax irkangana, value of the levered firm will be higher than the value of the unlevered firm. Purida? That means already we calculated 40 lakh 80,000, which is much more than 30 lakhs. 30 lakhs was the value of the unlevered firm. Plus DT will be there for value of the levered firm. Sir, inside this 40 lakh 80, sir, debt value will be there and also equity value will be there. Can you reduce the market value of debt? Yes, sir. How much lakh? 27 lakh. That means, my dear lovable students, market value of equity will be 13 lakh 80,000. Can I proceed? That means, sir, to the equity shareholders, 3,45,600 is the earnings available to equity shareholders. In order to enjoy 3,45,600, they have to invest 13,80,000. So calculator man, 3,45,600 divided by 13,80,000 into 100 comes to 25.0% is the KE. Is the what? And can we calculate the KO, my dear lovable students? Yes, sir. What is the formula for KO? KO is equal to EBIT divided by value of the firm. What is EBIT? 9 lakhs. So 9 lakhs divided by what is the value of the firm? 40 lakh 80,000 into 100 comes to 22.05. Yeah, it's the KO. Sir, what is the EBIT? 9 lakhs divided by 40 lakh 80,000 into 100 comes to 22 point. But sir, is this, sir, weighted average N of capital, cost of capital, is this NI approach? No, this is Modiglian Miller. So KO is equal to, I have to use the WACC table, correct? Can we calculate the WACC table? Tax bottom. Yes, sir. Tax bottom. Tax bottom tally. Wait. Sir, can I use the WACC table? Yes, sir. Sir, we are having equity and what? Debt. What is the market value of equity? We just find out 13,80,000. What is the market value of debt? 27 lakh. So total value of the firm 40,80,000. Can I calculate the weight? Yes, sir. Can I calculate the, sir, K individual cost of capital? Already I find out KE as 25.04%. I will not take KD as 12% because tax is there. Correct? If tax is there, cost of capital should be after tax. Hello, sir. So 12 into 60 percentage comes to 7.2 percentage. Comfortable? If I calculate, I will get 13.23 percentage. If you want, by using formula method, don't take the KO as EBIT divided by value of the firm. This will work out only if there is no tax. Correct? If there is tax, EBIT will not be available to the what shareholder? To the all shareholders. Are you really with me? Actually, the KO means the total return. Correct? So don't use this formula, because this formula will be applicable only if there is no comfortable. Yes, sir. So the WACC will be 13.23 percentage. Sir, but the WACC of unlevered firm was how much percent? 18 percentage. Correct? But the WACC of, sir, levered firm is how much percent? 13.23 percentage. அப்ப ரெண்டு பேரோட WACC என்ன ஆவல? Match ஆவல. Match ஆவலனா WACC is changing. KO is changing. That means MM should be theory of relevance. MM cannot be theory of. That's why from there arbitrage process is starting. What MM is saying that if there is tax, surely initially value of the levered firm will be more than the value of the unlevered firm. And slowly people will start from the levered firm to the unlevered firm, called as primary arbitrage. Correct, sir? So we are having basically 4 theories are there. NI approach, NOI approach, traditional approach, and the Modigliani-Miller approach. Right, sir? If you ask me to tabulate the 5 theories, my dear lovable students, sir, number 1 NI, number 2 NOI, number 3 traditional, number 4 MM without tax, and MM with tax. Are you really with me? What NI 3 characters are there? KD, KE, and KO. Are you really with me? What NI is saying that KD will be constant, KE will be constant, and KO will be variable. Hello, sir. What is the rule? What is the rule of NI? NI is saying that try to inject. Try to inject more, and more debt into the capital structure. Into the capital structure. Since KD is the cheaper source of finance, KD is the cheaper source of finance, KD pulls down KO. KD pulls down KO. When KO reduces, value of the firm increases. When KO reduces, value of the firm increases. Are you all really with me? Yes, sir. Now coming to NOI, man, KD is constant, KE is variable, and KO is constant. KO is constant. The rule of NOI approach is saying that, what the theorem or the rule is saying that, if you inject debt into the capital structure, since KD is cheaper source of finance, KD reduces KO. But this but is the theory, correct? But fear of equity shareholders increases, and automatically KE increases, and it exactly offset. Hence, KO remain unchanged. Right, sir? Hence, KO remain unchanged. Come on, man. Traditional approach. What tradition is saying that KD is variable, KE is variable, hence KO is variable. Everyone is variable. Traditional approach is saying that when you inject more debt, when you inject debt into the capital structure, when you inject, debt into the capital structure, when you inject debt into the capital structure, initially, equity shareholders enjoy financial leverage. Equity shareholders enjoy financial leverage, and equity shareholders enjoy financial leverage. Equity shareholders enjoy financial leverage, and initially KO reduces. Initially KO reduces. Such point is called as optimum capital structure. Optimal capital structure. Optimal capital structure. Optimal capital structure. Comfortable? With regard to MM, without tax, if there is no tax, value of unlevered firm is equal to value of the levered firm. Value of unlevered firm is equal to value of the levered firm. Value of unlevered firm is equal to value of levered firm. Comfortable? Hence, KO of unlevered firm, is equal to KO of levered firm. Hence, KO of unlevered firm is equal to KO of unlevered firm. Here, KO is equal to EBIT divided by value of the firm. EBIT divided by value of the firm. EBIT divided by value of the firm. Here, if there is tax, value of unlevered firm will not be equal to value of the levered firm. Value of unlevered firm will not be equal to the value of the levered firm. Hence, value of levered firm is equal to value of unlevered firm plus DT. Value of levered firm is equal to value of unlevered firm plus DT. Value of unlevered firm plus DT. Okay, sir? Yes, sir. And if tax is there, value of the unlevered firm is equal to EBIT into 1 minus T divided by K. K or KO, whatever it may be. EBIT into 1 minus T divided by K. EBIT into 1 minus T divided by K. Comfortable? With this, my dear lovable students, the concept revision of the first chapter, that is capital structure theories, comes to an end. And we have done with question number 1, which is question number A. In the coming slot, we'll be solving again MM. You have to revise the theory, whatever we have done. The 2 questions we'll be solving, which we will be feeling it as very cakewalk to proceed, my dear lovable students. We will be, discussing a superb 2 question past examination and RTP question. Have a full revision of theory, NI, NOI, traditional, MM without tax and MM with tax. Are you all clear? Sir, very, very, very happy afternoon to all. So we are doing capital structure theories revision. We understood that mainly there are 5 theories are there. NI approach, NOI approach, traditional approach, MM without tax and MM with tax. Sir, what is the basics of NI approach? NI approach is saying that try to inject more and more and more debt into the capital structure. If you are increasing the proportion of debt in the capital structure, automatically, since the debt is the cheaper source of finance, sir, KD pulls down KO. So when the KO reduces, value of the firm increases. For that, the basic assumption of the NI approach is that, my dear lovable students, you inject whatever percentage or proportion of debt, the expectation of the debt holders will not change. That means KD remain constant. And you inject whatever may be the proportion of debt into the capital structure, the expectation of the equity shareholders will not change. That means KE is also constant. So since both are constant, we can enjoy an advantage of the low cost debt. So KD pulls down KO And when the KO reduces, automatically value of the firm increases. But NOI is having a criticism against NI, saying that how this theory will work. Because if you inject more debt into the capital structure, yes, debt is a cheaper source of finance. There is no doubt about it. But if you start injecting debt into the capital structure, automatically an unlevered firm will become a levered firm. Then the equity shareholders in a levered firm is having a financial risk. So they will start get fear, and automatically whatever benefit you have enjoyed by reduction in KO because of the KD, KE pulls up KO and KO remain constant. That means what NOI is saying that I don't want to analyze from the angle of the debt holders. KD will be constant, but KE will be variable, my dear lovable students. To what extent it is variable? To what extent KD pulls down KO? To that extent it will pulls up KO. So to that extent it will be variable, and KO will be constant, my dear lovable students. KO, if KO is constant, value of the firm will not change. That's why NI is a theory of relevance and NOI is a theory of irrelevance. Are you really with me? Coming to the next one, my dear lovable students, the traditional approach. What traditional approach is asking a question to the NOI approach, that if you inject 1% debt, 5% debt, 10% debt into the capital structure, the equity shareholders will not get feared. Equity shareholders will enjoy, because initially up to a certain point of limit, my dear lovable students, equity shareholders will be able to enjoy the financial leverage because of favorable effect of financial leverage. Sir, actually KD pulls down KO, and initially equity shareholders will not react, but they will start react. When they start react, not only the equity shareholders will react, but also the debt holders will be reacting. But the proportion or the percentage of reaction between the debt holders and the equity shareholders will be huge. That means equity shareholders will react so much multiple times as compared to the debt holders. So it will not exactly offset. So KO will never be constant. KO will be variable as per the traditional approach. Now, to extend the NOI approach, the has came. Said that I will explain to you how it will be exactly offsetting. He said that, sir, all your propositions are without tax. So I am starting without tax. There are two companies are there. Number one, sir, without tax for levered firm and for unlevered firm. If there is no tax for a shareholder, for a debt holder, what is getting the returns from the levered firm will be equal to what he will get from the unlevered firm. So if there is no tax, according to value of unlevered firm is equal to value of the levered firm. If that is the case, KO of unlevered firm will be equal to KO of the levered firm. Are you really with me? If both KO are same, if both the earnings available from both the company are one and the same, then why that those companies should have different value? So proved that if there is no tax, value of levered firm is equal to value of. That means it is irrelevant whether one company is having debt in their capital structure or does not have debt in their what structure? Capital structure, my dear lovable students. And come up with a beautiful formula of KO is equal to EBIT divided by value of the firm. KO is equal to EBIT divided by. This is the formula we will be using to find out the value of the unlevered firm. Are you really with me? Yes, sir. But is having a difference of opinion. is saying that my theory is a theory of irrelevance. But if tax is there, tax benefit or tax savings will be there for a levered firm. Because of they paying interest for the debt, that interest will be debited to the P&L account. Because of that, a levered firm will be able to enjoy a tax benefit or tax shield. Are you really with me? Then, my dear lovable students, if there is tax, value of unlevered firm will not be equal to value of the levered firm. So, levered firm's value will be little higher than the value of the unlevered firm. That's why proposed a formula that value of levered firm is equal to value of unlevered firm plus dt, which is nothing but D stands for debt and T stands for tax rate. Are you all really with me? And how to find out the value of unlevered firm? My dear lovable students, value of unlevered firm is equal to, I can't take EBIT because EBIT into what minus T? 1 minus T will be the earnings available to the equity shareholders. Are you really with me? So EBIT into 1 minus T divided by K. Here, better to write that value of unlevered firm is equal to EBIT divided by K. Correct? Whereas here value of unlevered firm, if tax is there, EBIT into 1 minus T divided by K. This is what yesterday we have done. And from this, my dear lovable students, we have solved one question, question number 1. And I'm moving into the next two questions, question number 2 and question number 3. And we will finish it off this part called as capital structure theories. Can we? Sir, Blue Limited, an all-equity finance company, is considering the repurchase of 275 lakh equity shares and to replace it with 15% debenture of the same amount. My dear lovable students, this company is an all-equity company. So this company is a levered firm or unlevered firm? This company is a unlevered firm. Are you really with me? For unlevered firm, 100% of the share capital will be equity, but they are going to inject debt into the what structure? Capital structure. To the extent of how much lakh? 275 lakh. And to replace it with how much percent debenture? 15% debenture. That means KD is equal to 15%. Am I right, sir? Of the same amount. Current market value of the company is 1750 lakh. That means current market value of the company means market value of the firm or market value of the equity, because the firm is a unlevered firm. Since a firm is an unlevered firm, current market value of the equity with its cost of capital is how much percent? That means KO is equal to KE is equal to 20%. My dear lovable students, companies' earnings before interest and tax, EBIT, are expected to remain constant in what year? Future years. That means whether I inject debt or not into my what structure? Capital structure. Will the EBIT change? No, sir. Because EBIT is an operating result, not a financial result. Correct? Company also has a policy of distributing its entire earnings as what? Dividend. Okay, fine. Assuming the corporate tax rate as how much percent? You are required to calculate the impact on the following on account of change in the what structure? Capital structure. As per the approach, market value of the company, overall cost of capital and cost of equity. Basically what is saying that now the company is a all equity company. Now the company does not have debt at all, but please inject a debt of 275 lakhs into the what structure? Capital structure. Since tax is there, this company was an unlevered firm before. Correct? So the value will be X. But since tax is there, if you inject debt into the what structure? Capital structure. Initially, my dear lovable students, value of the levered firm will be more than the value of the unlevered firm. So I am going to analyze this question, man. Currently, this question is this company is a what type of company? Unlevered firm. What is the value of the firm? 1,750 lakhs. Are you really with me? Sir, this 1,750 lakhs consists of how much equity and how much debt? Zero debt and 100% equity. Am I right, sir? Why, sir, 100% equity? Because this company is a all equity company. That means for an all equity company, if there is tax is there, they said that value of equity is equal to value of firm as 1750 lakhs. And KE is equal to KO is equal to 20%. That means, my dear lovable students, sir, we all know that, sir, KE is equal to earnings available to the what shareholder? Equity shareholders divided by value of equity. That means KE is how much percent? 20% is equal to earnings available to the equity shareholders divided by 1750 lakhs. Am I right? So earnings available to the what shareholder is equal to 1750 into 20% comes to, sir, 350 lakhs is the earnings available to the equity shareholders. Can I proceed? Is this profit before tax or profit after tax? Profit after tax. There is tax in the company, correct? So 350 lakhs is the PAT. Are you all really with me? So I want the profit before tax. So 350 lakhs divided by 1 minus 0.3 comes to 500 lakhs is the earnings before interest and tax. That means this is what they have done here. Just be with me. Market value of equity is equal to earnings available to equity shareholders divided by KEA. That means 1750 lakh is equal to, sir, earnings available to equity shareholders divided by KEA. That means earnings available to equity shareholders is equal to 1750 into 20% comes to 300, and this is the PAT, profit after tax. Because in this question there is tax. I want to convert into profit before tax, which is nothing but EBIT. Because this company is a all equity company, there won't be any interest. So 350 lakhs divided by 1 minus 0.3 comes to 500 lakhs is the earnings before interest and tax. Sir, let me ask you a question. If the company from the status of all equity company, if the company has become a levered firm, will the EBIT change or will not change? That's why whether EBIT under all equity option and EBIT under the equity and debt option are 500 lakh. But if you inject debt of 275 lakh at an interest rate of 15%, sir, 275 into 15, you will pay 41.25 lakhs as the interest. But when you was a dash equity company, all equity company, my dear lovable students, this was not there. Are you really with me? So the earnings before tax of all equity company is 500 lakhs. Whereas earnings before tax of the levered firm will be EBIT minus interest. On that earnings before tax, pay tax at the rate of 30%, which comes to 150 and 137.63. So the income available to the equity shareholders, earlier equity shareholders were able to enjoy 350 only total. But now 321.12 plus 41.25 comes to 362.37 is what the total owners of the company will be able to enjoy. Because once you inject debt into the what structure? Capital structure. Sir, interest is a tax deductible expenses. Because of that, your tax outflow reduces. Am I right? So I am going to calculate the market value of the company. My question to you, sir, when the firm was a unlevered firm, what was the value? 1750 lakhs. Are you really with me? Once you inject debt into the what structure? Capital structure. An unlevered firm will become levered firm. Sir, if there is tax, is value of levered firm is equal to value of unlevered firm? No. The value of levered firm will be more than the value of the unlevered firm. So the market value of the what firm? Levered firm is equal to value of unlevered firm plus tax advantage, which is nothing but DT. Sir, what is the value of unlevered firm? 1750 lakhs. How much tax debt you have injected now? 275 lakhs, right, sir? Into 30% comes to 82.5. So 82.5 lakhs will be the additional value because of changing from what company to what company? Unlevered firm to levered firm. This is nothing, sir. This first company, when you are an unlevered firm, you paid a tax of 150 lakhs. But now you are paying only a tax of 137.63. So 150 minus 137.63 comes to, sir, 12.37 lakhs is the extra money available with the levered firm because of injecting debt into the capital structure. Comfortable? And the debt percentage is how much percent? 15%. This divided by 15 that is 12.37 divided by 15 comes to 82.50 lakhs. That's what the extra 82.50 lakhs getting. Are you able to tally? So what MM is saying that if you convert a unlevered firm into levered firm, if there is tax, always the value of the levered firm will be much more higher than the value of the unlevered firm. Can I proceed? That means, my dear lovable students, now the value has become 1832.5 and earlier the value is 1750. So there is an addition of 82.5. We already analyzed why there is a reason. So this is what the first requirement of the question. What is the impact on the market value of the firm? If there is tax, the market value of the firm increases. So the impact is that market value of the company has been increased by 82.5 lakhs due to replacement of what with what. Fine, sir. Sir, I am going to calculate the overall cost of capital, sir. Overall cost of capital, which is nothing but KO. First of all, I am going to calculate the market value of equity. After you changed from unlevered firm to levered firm, have the value increases? Have the value increases? Yes, sir. Yes, sir. Sir, from how much lakhs value? 1750 lakhs value. It has been increased to 1832.50 lakhs. Correct? According to MM, this comprises of value of debt and value of equity. You know the value of debt, how much you have injected. What is the value of debt? 275. From the total value of the firm, if you reduce debt of 275 lakh, you will get 1557.50 lakhs is the market value of equity. Are you all really with me? If you invest this much amount in the company, you can enjoy, sir, profit after tax of 321.12 lakhs. Am I right? That means you can calculate the KE as earnings available to equity shareholders divided by market value of equity into 100. Can I proceed? Tell me, my dear lovable students, what is the earnings available to equity shareholder after you become a levered firm? 321.12 divided by what is the market value of equity? 1557.50. Getting it? That means, my dear lovable students, the KE is 20.62%. The analysis, when the company was a unlevered firm, correct? The value was just 1750 lakhs. And the KE of the company is 20%. Hence, the KO of an unlevered firm is also 20%. Can I proceed? But now, you converted the unlevered firm into levered firm. Sir, if you convert the unlevered firm into levered firm, you are injecting debt into the capital structure. Automatically, the equity shareholders of the levered firm will start get fear. Yes, sir. That's why from KO of 20%, they have shoot up to 20.62%. Comfortable. Is tax there or not there? Tax is there. Sir, if tax is there, I will not take KD as the coupon rate. I will not take KD as the. Generally, KD in capital structure theories, KD is equal to coupon rate. Correct? But only in one situation, that is MM approach with the tax. Since you are having tax benefit on interest, my dear lovable students, KD should be I into 1 minus T. KD should be, what is the I, man? 15% is the I. 1 minus 0.3 comes to 0.7. So 15 into 0.7 comes to 10.5 is the KD after tax. It's not KD. KD. Now I am going to calculate the WACC. First, before I calculate the WACC, sir, when the company was a unlevered firm, what was the KE of the company? 20%. That means what was the KO of the company? 20%. Sir, what was the value of the firm? 1750 lakhs. Right, sir? But once the company has become levered firm, you tell me KE increases from 20%, it has been increased to 20 point. The reason or the logic is you have converted an unlevered firm into a levered firm. That means the equity shareholder of the levered firm start getting fear. So automatically their expectation increases. That's why KE increases. Comfortable? My dear lovable students, sir, now the value of the firm has been increased from 1750 or decreased? Increases. That's why value of the firm become 1832. 1832.5. Am I right with the figure? Sir, if the value of the firm increases, KO should reduces. Are you really with me? Because if the KO reduces, only value of the firm increases. Can I proceed? My dear lovable students, that means earlier KO was 20%. Now the new KO should be less than. With this mindset, I'm going to work out the KO. Are you understanding what I'm talking to you? So what is the equity, man? Market value of equity comes to 1557.5. Correct? Market value of debt is 275. Comfortable? That means the total comes to 1832.5 is the market value of the firm. Which firm? Levered firm. Which is more than the value of the unlevered firm. Now, have I calculated KE? Yes, sir. Which is 20.62%, which is much, much higher than KE of the unlevered firm. And KD, sir, I will not take the coupon rate as KD. Since tax is there, I will be taking KD is equal to I into 1 minus T. Are you really with me? That means 85% of my equity represent the total capital employed. 15% of the equity, sir, capital structure represent the debt. So calculator, man, 20.62 into 85% comes to 17.53%. Can I proceed, sir? And 15 into 10.5% comes to 1.58. And the KO of the levered firm, sir, dropped from 20% to 19.11%. That means there is a fall in KO of 0.89%. That is why there is a increase in the value of the firm. Can I proceed? That's it. So this is what the impact in the cost of equity. So the impact in the cost of equity is raised by how much percent? 0.62%. Why the equity has to be increased? Because you have injected debt into the what structure? And you have converted the unlevered firm into a, automatically the equity shareholders of the levered firm will start fearing. Are you really with me? That's why their expectation has been raised from 20 to 20.62 due to a presence of what risk? Financial risk. That is introduction of debt into the what structure. Sir, the impact of the cost, yes sir, cost of capital. Sir, that's it. We have analyzed the, sir, impact on the value of the firm. You look at the coming to the answer, man. Sir, when you analyze this, market value of the company increased. Because, sir, because of conversion from the unlevered firm to the levered firm, sir, always if there is tax, value of the levered firm will be higher than the value of the unlevered firm. Comfortable? Overall cost of capital reduces. Because if the value of firm increases, sir, overall cost of capital should reduces. And cost of equity increases from 20%. KE has become 20.62%. Are you really with me? Sir, the same question can be worked out by using formula method. Are you really with me? What Modigliani and Miller is saying that, my dear lovable students, cost of capital. What is cost of capital? KO. And cost of equity. What is cost of equity? KE can also be calculated with the help of following formula. Though there will be no change in the what answer, final answer. So till now, I have applied the table approach. Now I am going to apply the formula approach. MM said that cost of capital, that is KO, is equal to KE of a unlevered firm. Sir, if there is no tax, value of levered firm is equal to value of the unlevered firm. KO of a unlevered firm is equal to KO of the levered firm. That's why, sir, MM is also saying, if there is no tax, my dear lovable students, E of a unlevered firm should be the KO of the levered firm. Am I right? But if there is tax, my dear lovable students, because of tax shield, because of the tax benefit available to the debtor, sir, the value of the levered firm, sir, will increase. That means KO of the levered firm decreases. Are you really with me? That's what saying that into, sir, 1 minus TL. 1 minus what? L stands for leverage. L stands for what? Leverage means debt divided by debt plus equity. Debt divided by So the same thing we can calculate by this formula very easily. We already calculated the KO by using WACC table. ஞாபகம் இருக்கா? Just now we saw and we got the answer as 19.11%. Can I proceed? My dear lovable students, what is the KO or KE of an unlevered firm? 20%. Generally, if there is no tax, my answer over. Because value of a levered firm is equal to value of the, and KO of an unlevered firm is equal to KO of the, but here there is tax. So I am having tax benefit. I am having tax shield. Correct? How much tax benefit or tax shield I will be having in my capital structure? How much debt is there? That much only I can enjoy the capital structure, right? So my dear lovable students, sir, 275 is the debt. Hello, sir. So what is the total value of the firm? 1832.50. Are you really with me? So out of 1832.50, 275 divided by 1832.50 means 15% is the proportion of debt in the what structure? Capital structure. So for that 15%, I will get 30% tax benefit. Are you really with me? So into 0.3 means 4.5% will be the tax saving or tax benefit. Are you all really with me? So into 20% comes to 19 point into 0.0 into, sir, 0.0 minus 1, correct? Yes, sir. Sir, 275 divided by 1832.5, you will get the proportion as 15%. For this 15%, you will get the what benefit? Tax benefit. Minus 1 into, sir, 20% comes to 19.10% is the KO as per formula method. Are you really with me? The same 19.10 we have derived by using the WACC also 19.11. Only, sir, round of difference are there. Are you really with me? So tell me, as per approach, we can calculate the KO of a levered firm is equal to KO of a unlevered firm into 1 minus TL. 1 minus T stands for tax rate and L stands for leverage, which is nothing but debt divided by debt plus equity. Comfortable? Now I am going to calculate the KE of a what firm? Levered firm. KE of a levered firm means you are a shareholder in a levered firm, correct? If you are a shareholder in a levered firm means do you have risk? Yes, sir. You are having more risk than a shareholder to be in an unlevered firm, correct? If I am a shareholder in a unlevered firm, I will be expecting only KE of an unlevered firm. This is my RF, risk-free return. Because if I was a shareholder in a what firm? Unlevered firm, there is no risk there, there is no debt there, so I will be expecting a RF, risk-free return. But if I am shareholder in a levered firm, there is debt in the what structure? Capital structure. So I want risk premium. What premium? Risk premium is nothing but, my dear lovable students, KE of an unlevered firm minus KD. This is nothing but, sir, RM minus RF. What minus what? RM minus RF. What minus what? Into debt divided by equity is the proportion. Am I right? Since there is debt in tax in the concern, so into what minus T? 1 minus T. Only for debt tax benefit will be there. Only for debt, sir, tax savings will be there. That's why they have put in numerator debt into 1 minus T. You can put debt divided by equity into 1 minus T also, still you will get the same answer. Am I right, sir? So, sir, apply it. What is the RF? Sir, if you are an equity shareholder in an unlevered firm, what is your expectation? 20%. Sir, will you expect same 20 or more than that? More than that. For the amount of the, sir, debt. How much is the amount of debt in the capital structure? 275. Out of, what is the equity? 1557.5. Am I right, sir? Yes, sir. Into, my dear lovable students, what is the tax rate? 0.7. Because 1 minus T. Yeah. Yes, sir? Yes, sir. Into what is the risk premium you are taking? 5%. So into 5 comes to 0.62 is the risk premium for this level of debt. That means 20 plus 0.62 comes to 20.62% is the KE of the levered firm. Correct? We already calculated KE of the levered firm by using the formula. Then also we got KE as 20.62%. Now under the direct formula method also we are getting 20.62%. Are you able to appreciate? Are you able to appreciate? That's it. So under Modigliani and Miller approach, we have studied that we can add that, sir, the under Modigliani and Miller, we can classify the things into two categories. Number one, value of unlevered firm, value of unlevered firm, and value of levered firm. Sir, value of unlevered firm, tell me what is the value? How you will find out the value? Sir, you have to classify into two categories. Tax there, tax not there. If tax not there, na, EBIT divided by KE, KE or KO. Sir, if tax is there, na, sir, EBIT into 1 minus T divided by, can I proceed, sir? Coming to the value of the what firm, man? Levered firm. Again, you are having what, man? Sir, no tax, there is tax. If there is no tax, value of the levered firm is equal to value of the unlevered firm. Can I proceed? My dear lovable students, if there is tax, then the value of the levered firm will not be equal to value of the unlevered firm. Value of the levered firm is equal to value of the unlevered firm plus GT. Right? And the KO of the levered firm is equal to KE of the unlevered firm into 1 minus TL. Are you really with me? And KE of the levered firm is equal to KE of the unlevered firm plus KE of the unlevered firm minus KD into debt divided by equity into 1 minus T. If the same formula you are applying for without tax, please ignore 1 minus T. Are you really with me? If no tax, 1 minus T should be ignored. 1 minus T should be ignored. Comfortable, sir? That's it with regard to question number 2. We are moving into the last question from this area, which is question number 3. Jordan Limited has net operating income of how much lakh? 5 lakh. That means EBIT of 5 lakh. And total capitalization of how much lakh? 50 lakhs. That means total capital employed is 50 lakh. During the current year, company is contemplating to introduce debt financing in the what structure? Capital structure, and various options for the same. Following information is available at different level of debt to value. You tell me, my dear lovable students, sir, if Z Limited's net operating income is 5 lakh and their capital employed is 50 lakh, my dear lovable students, companies contemplating to introduce debt into the capital structure means இப்ப இருக்கிற capital structureல யார் இல்ல? Debt இல்ல. That means now the company is a all equity company or unlevered firm. Correct? Yes, sir. Following information. If the debt is 0%, sir, KE will be 10% only because there will not be buy-in to the equity shareholders. But if you inject debt of 5 lakh, the KD will be equal to 6% and KE will slightly increase from 10 to 10.5% because you are injecting debt into the what structure. Sir, if you are injecting 10 lakh rupees debt into the what structure? Capital structure, KD will be same, whereas KE will slightly increase from 10.5 to, if you are again injecting debt of 15 lakh, sir, KD will start reacting from 6, it will move to 6.2 and KE will from 11 to 11.30. Comfortable? Sir, if you are making the debt value as 20 lakh, then KD will be equal to 7% and the KE will be equal to 12.4%. Comfortable? Sir, if the value of debt is 25 lakhs, my dear lovable students, KD will be equal to 7.5% and KE will shoot up to 13.5%. But if you are making the value of debt to 30 lakh, the KD will be equal to 8% and the KE will be equal to 16%. Can I proceed, sir? Assume no tax. Oh my God, there is no tax. And that the firm always maintain books at what value? Book value. There is nothing to do with the market value. You are required to calculate amount of debt to be employed by firm as per what approach? What is the rule of traditional approach? Traditional approach is saying that at every capital mix, you'll be having different KO. You have to choose a capital mix having the lowest KO that will be treated as the optimum capital structure. Only under the traditional approach, we are having the concept of optimum capital structure. Whether under NI approach or NOI approach or the MM approach, we don't have a concept of what at all. And equity capitalization rate, that is KE, if MM approach is followed. Can we calculate the amount of debt to be employed by firm as per traditional approach? That means under every option, we are supposed to calculate the KO and we have to find out an option which is the least KO. Purida? First one. What is the total capital employed? 50 lakhs. You tell me in option number 1, there is no what at all, debt at all. That means the, sir, debt divided by total capital employed is 0%. Not even 1% debt is there in the what structure? If there is no debt in the capital structure, entire value represent equity only. That means then weight of equity will be 100%. Weight of equity will be. But out of the capital, total capital employed of how much lakh? 50 lakhs. If I am injecting debt of 5 lakhs, 5 lakhs divided by 50 lakhs means 10%. Correct? Correct? From 50 lakhs, if I reduce how much lakh? 45 lakhs will be the equity value and 90% will be the weight of the equity. That means in second option, out of my capital structure, 10% is debt and 90% is equity. Can I proceed? The same way we have to repeat for the remaining cases. If the capital employed is how much lakh? 50 lakhs and the debt is 10 lakh. How much percent debt? 20% debt. If 20% debt na 80% equity. Can I proceed? Out of 50 lakhs, if you are injecting debt of 15 lakhs divided by 50 lakhs comes to 30% of debt, then 70% of equity. Can I proceed? My dear lovable students, out of 50 lakhs, if you are injecting 20 lakhs as debt, 40% of KD debt and remaining 60% of equity. Can I proceed? Out of 50 lakhs, if you are injecting 25 lakhs of debt, 50% of and 50% of out of 50 lakh, my dear lovable students, if 30 lakhs, if you are injecting as debt, 60% is debt and 40% is the equity. Are you done with the proportion? Now I am going to calculate the WACC under the traditional approach. What is the theory? What is the theory of traditional? Under every capital mix, we have to find out the KO. And we have to choose a capital mix which is the lowest KO. Able to follow? Come on, man. Sir, in the first one, situation number 1. Sir, what is the KE? KE, how much percent proportion? 100%. That is 10% was the individual cost of capital. Yeah. That's what they have written, 10%. Look at the question. Sir, second situation, 10.5%. Third situation, question, 11%. Then 11.3%, 12.4%, 13.5%, 16%. That means if you keep on inject debt into the what structure? Capital structure. The fear of the equity shareholders increases and the KE increases. Can I proceed? Okay, sir. What is the weight of the equity, sir? First one, 100%. It was what only? All equity only. Situation number 1. But in situation number 2, we injected 10% debt. So 90% become the weight of the, then 80, then 70, then 60, then 50, then 40. Can I proceed? Sir, come on. What is the KD, individual cost of capital? In the first situation, KD is nil because in the first situation, in the capital structure, yare illa, debt illa. Then you injected 6%, 6%, 6.2%, 7%, 7.5 and 8%. As per traditional approach, KD is not constant. If you inject more and more debt into the what structure, even KD will also increases. Are you agree with me? KD increases, KE increases, hence KO increases. That is why my theory is the theory of relevance. If two companies are alike in all aspects, except what structure? Yes, what will change? Come on, man. What is the value of debt? First one, 0%. Because NAV illa, debt illa. Then slowly you start, sir, reducing from the equity. 10%, 20%, 30%, 40%, 50%, 60%. Can I calculate the individual cost of capital? That is KE into weight of the KE. What was the KE? 10%. What was the weight? 100%. 10 into 100%? 100%. Sir, here KD, there is no KD at all. Correct? So the cost of capital is how much percent? 10%. 10% is the KO. Can I proceed? In second situation, you have to participate and tell me what was the KE individual cost? 10.5. What is the weight of the KE? How much percent? 90%. So 10.5 into 90% comes to 9.5%. 9.5% is the weighted KE. Weighted? What was the KD? 6%. What is the proportion? 10%. 6 into 10%? 0.06%. Otigrani. Plus 0.06 comes to, tell me, 10.05%. That's what they are round off 10.1%. Hello, sir. My dear lovable students, that means if you inject how much percent debt into the capital structure? 10% debt into the what structure? Capital structure. Sir, KO increases. KO? If KO increases, value of the firm decreases. That means this is not the right option. This is not the. Now again I am injecting debt into the what structure? Capital structure. You have to quickly tell me what is KE? 11%. 11 into proportion? 80%. So 11 into 80% comes to 8.8%. Enna follow pandriya? What is KD? 6%. What is the proportion? 20%. 6 into 20% comes to 1.2%. So 8.8 plus 1.2 comes to 10%. That means this is equal to this. This is indifference point. If you are an all equity company or if you are a levered firm with a 20% debt, your value will be same. Because KO did not change. Da? Are you able to appreciate? Da? Appreciate panna mudiyudha? Next one, KE become 11.3. But the proportion fall down to, so 11.3 into 70 means 7.91%. Can I proceed? And my dear lovable students, KD 6.2 into 30% comes to 1.86%. Right? So points are 1.86 plus 11.7.91 comes to 9. அவங்க round off போட்டதனால தான் அந்த மாதிரி வருது. ஓகேவா? This is better because earlier the KO was 10%. Now because of injecting how much percent debt? 30% debt. Sir, KO reduces. If KO reduces value of the firm, so according to me, as of now, it's better to inject how much percent debt in the capital structure? 30% debt in the capital structure. Onal appreciate panna mudiyudha? So this is the best option. Actually, at this option, the value of firm will be highest. That is why this is called as optimum. Now, okay. அப்ப நான் இப்ப திருப்பி என்ன ஆரம்பிச்சிட்டேன்? டேட்டா இன்ஜெக்ட் பண்ண ஆரம்பிச்சிட்டேன். 12.4 into 0.6% comes to 7.4%. Sir, 7% into 40% comes to 2.8%. So 7.4 plus 2.8 comes to 10.2. ரிவர்ஸ் அடிக்க ஆரம்பிச்சிச்சு பாரு. என்னன்னா முன்னாடி கம்மியான கேவோ இப்ப என்ன ஆரம்பிச்சிச்சு? திருப்பி என்னதான் ஆகும்னா இன்க்ரீஸ் தான் ஆகும். ஸோ இதுக்கப்புறம் டெட் இன்ஜெக்ட் பண்றது ஒரு ரைட் ஆப்ஷன் கிடையாது. Correct? So the amount of debt to be employed is 15 lakh because WACC is minimum at this debt of 9.8%. So this is the best WACC. Pakka? Are you really with me? That's it. That's what the traditional approach. So by this question, they are testing, do you know the theory of the traditional approach? What traditional approach is saying that if you inject debt into the what structure? KD changes. அப்புறம் KE also change. இவங்க ரெண்டு பேர் என்ன ஆவறதுனால சேஞ்ச் ஆவறதுனால KO கட்டாயமா சேஞ்ச் ஆவதான் செய்யும். பட் இவங்க சேஞ்ச் ஆவற விதம் வேற மாதிரி இருக்கும். உடனே KD சேஞ்ச் ஆக மாட்டாங்க. உடனே KE சேஞ்ச் ஆக மாட்டாங்க. லைட்டா தான் KD சேஞ்ச் ஆவாங்க. லைட்டா தான் KE சேஞ்ச் ஆக ஆரம்பிப்பாங்க. பட் ஒன்ஸ் சேஞ்ச் ஆயிட்டாங்கன்னா தடபுடன்னு சேஞ்ச் ஆயிடுவா. யாரு? KE. ஹலோ சார், இது இல்லாம NOI அப்ரோச் சொன்ன மாதிரி எக்ஸாக்ட்லி என்ன செட் ஆவாது. ஐ அம் கண்டினியூயிங் வித் தி செகண்ட் பார்ட் ஆஃப் தி क्वेश्चन. equity capitalization rate, if what is followed? MM approach is followed. Sir, as per MM approach, that is Modigle onion, cost of capital, KO remain constant because tax there, no tax. If there is no tax, value of the levered firm is equal to value of the, and cost of equity increases linearly with the debt. MM is saying that yes, pa, it is exactly offset. It is exactly. நீ நினைக்கிற மாதிரி எக்ஸ்ட்ரா எல்லாம் இன்க்ரீஸ் ஆகாது. Arul, really with me. Sir, do you know, sir, can you say what is the value of the firm formula? If there is no tax as per MM, value of the firm is equal to EBIT divided by KO. Is the EBIT of the firm net operating income given in the question? Yes, sir. How much lakh? 5 lakh. Is the value of the firm total capital employed given in the question? How much lakh? Up 50 lakhs is equal to 5 lakhs divided by KO. Up KO is equal to 5 lakhs divided by 50 lakhs into 100. Comes to 10%. 10% is the existing KO. Correct? That means as per MM, if there is no tax, who will not change? Value of the firm will not change. Rather, who will not change? KO will not change. Value of the firm will not change, na? That's why KO column is same as per MM. Napa? As per traditional approach, I wrote KE, I wrote KD, I find out KO. But as per MM approach, if there is no tax, na, value of the levered firm is equal to value of the concept. Kadikida? Okay, sir. Super, sir. So in situation number 1, what was the debt? 0 debt. What is the equity? 50 lakhs. What is the debt bar equity? There is no proportion of debt at all. What was the KO of the firm? 10%. What is the KD? 0. So KO minus KD, 10%. That means K is equal to 10%. Enapa comfortable? Situation number 2 will make you understand, man. Sir, what is the debt? How much debt you injected? 5 lakh. Then equity will become 45 lakhs. So now the debt divided by equity, na, sir, 5 lakhs divided by 45 lakhs into 100 comes to 11% is the proportion. Yes, sir. Yes, sir. Sir, what is the KO? 10%. What is the KD? 6%. What is KO minus KD? KO, euro percent? 10. Minus 6 comes to 4%. Am I right, sir? So can I calculate the KE? KE of a levered firm is equal to RF plus beta into RM minus RF, which is nothing but KO plus. What is the KO? 10%. Plus. What is the KO minus KD? It will change. It will change. Keep on change. Yeah. Eவ்வளோ percent in the case? 4%. Into what is the debt by equity proportion? 11%. Am I right? That means, sir, 4 into 11% comes to 0.44 plus 10 comes to 10.44 is the KE. Appreciating. That means what? MM is saying that if there is no tax, value of the levered firm will be equal to value of the, and KO of unlevered firm is equal to KO of the, and KE of a levered firm is equal to KO of a unlevered firm plus KO of unlevered firm minus KD of the levered firm, or rather KD into what by what? Debt by equity. Tax there, tax not there. If tax is there, I would have put 1 minus T. If tax is not there, I will avoid this 1 minus T in our calculation. Clear concept. Sir, come on, man. Sir, I'm going to inject debt of how much lakh? 10 lakhs. Then what will be the equity position? 40 lakhs. 10 lakhs divided by 40 lakhs means 25% is the debt component. Pakka. Come on. What is the KO? Will change? Will not change? Will not change. What is the KD? 6%. Even that is also will not change. 10 minus 6, 4%. Can I calculate the KE? Tell me what is the formula for KE? KO plus, what is KO? 10 plus KO minus KD, 4 into proportion, 25%. 4 order 25. 1%. Apply பண்ண முடியுதா? Yes, sir. 4 order 25%, 1%. Correct? Then plus 10 comes to That's it, game over. Like that, we have to put, sir, if I inject 15 lakhs as debt, automatically equity will become, sir, 15 divided by 35, 43%. Anyway, this will not change. But KD is increasing, correct? Yes, sir, comes to 6.2%. Now, KO minus KD will also increase. Because KO will not change at any cost, man, as per MM. But KD may increase. What MM is saying that, according to me, KD increase matter. Because NI said that KD is constant. Correct? Sir, I said that KD is constant. Are you really with me? But traditional approach said that KD is variable. MM saying that it is irrelevant for me. For your capital structure, if KD increases, okay, I'm ready to accept the KD is increasing. If KD is not increasing, no problem. Because automatically my formula will take care, my dear lovable students. Are you really with me? Yes, sir. My formula is RF plus, sir, beta into RM minus. So I am least bothered about whether KD is what or not, increasing or not. Sir, sir. Sir, tell me. What is KO 10 minus 6.2 comes to 3.8 into proportion 43%, which is 1.634 plus 10% comes to 11.6%. This is the KE of the, it will exactly offset, my dear lovable students. Can we finish it off? Yes, sir. Sir, if you inject debt of 20 lakh, equity will become, proportion will become, proportion 67%. Correct? 20 lakhs divided by 30 lakhs, 67%. 30 lakhs, 67%. Yes, sir. KO remain constant, 10%. Sir, KD 7%. Can we calculate, sir? So 10 minus 7, 3%. Come on, sir. 3 into 67% comes to 2.01. 2.01 plus 10% comes to 12.01. Is the KE of the what firm? Last two situation, 25-25 na, 50-50 Yes, sir. That means 100% it shows the debt because 25 divided by 25. Correct? Yes, sir. Sir, inga 10 irukku. Sir, KD becomes 7.5. 10 minus 7.5, 2.5. 2.5 yoda full up 2.5 vandrum. 10 plus 2.5 is 12.5 is the KE. Enna clarity? And here 30 lakhs and 20 lakhs, sir, become 150%. Obba. Because, sir, equity vada debt enna irukku? Adhigama irukku. Sir, KO remain constant. That means KD is how much percent? 10 in the 8 pochna? 2%. 2 order 150 comes to 3. 10 plus 3 comes to 13%. That's it. This is how you are supposed to work as per the MM approach. Good question, good application. Are you all really with me? Are you able to conceptually understand what is happening, my dear lovable students? That's it with regard to the 5 theories of capital structure theories. NI, NOI, traditional approach, MM without tax and MM with the tax. What NI is saying that try to inject more and more debt into the capital structure. KD pulls down KO. Once KO reduces, value of the firm increases. That's it, game over. Whereas NOI is saying that FD sir, KD reduces KO and KE pulls up KO. KO remain constant. That's it, game over. What traditional approach is saying that, sir, it will not be exactly offset. Initially, there will be financial leverage, but later it will start NSR increasing. But KE will increase steeper than KO, so it will not exactly offset. Hence, KO will not be constant, KO will be variable. Once the KO changes, value of the firm changes. MM is saying that if there is no tax, value of the levered firm is equal to value of the unlevered firm. And if there is tax, value of the levered firm will be more than the value of the unlevered firm. Now, people start a question to MM that if there is tax, if value of the levered firm is higher than the value of the unlevered firm, then your theory is a theory of relevance. Then why are you saying my theory is a theory of? MM said that I will answer you through a process called as arbitrage. What process? Through the arbitrage, he explained what is primary arbitrage and what is secondary arbitrage. The coming slot, we are going to talk about what is primary arbitrage and what is secondary arbitrage is the target. Are you all really with me? Have a revision of the, sir, provisions, what we discuss, and also the 3 question you try. Come back, we will complete a next beautiful concept called as arbitrage process. There are 2 companies, man. One is N Limited and M Limited, having same earnings before interest and tax of how much rupees? 20,000. Sorry, 2 companies are alike in all aspects. Then only this chapter will be applicable. So M Limited and N Limited, man, EBIT of 20,000 and 20,000. Can I proceed? M Limited is a what company? Levered company, having debt of how much lakh? 1 lakh. At how much % rate of interest? The cost of equity of N Limited is 10 and M Limited is 11.5. Compute how arbitrage process will be carried out. Understand very clearly, man. You have to answer to me. You have to shout along with me. What is the EBIT of M Limited? 20,000. EBIT of N Limited. Sir, M Limited is a dash firm, levered firm, whereas N Limited is a, my dear lovable students, M Limited debt how much lakh? 1 lakh. 1 lakh. What is the KE of the M Limited given in the question? 11.5%. And here it is only because this is an unlevered firm. There is no debt at all. Equity shareholders does not have buy-in. Whereas M Limited is having debt in its what structure? Capital structure. Equity shareholders will feel buy-in. So the expectation of the equity shareholders will be higher than the N Limited. Right? That's why they are having 11.5%. And the KD, cost of debt, comes to 7%. Now I am going to calculate the value of equity. What of equity? Value of equity means market value of equity is equal to earnings available to the equity shareholders divided by K. Comfortable? Sir, I am going to calculate, man, the value of the equity of the company M Limited. Can I? Yes, sir. What is the EBIT? 20,000. Sir, if the debt is how much lakh? 1 lakh. And KD is 7%. So 1 lakh into 7% come to 7,000. They are supposed to pay to the debt holders. Can I proceed? Appa 20,000 evlo pochuna? 7,000 pochuna. 13,000 rupees will be the earnings available to the equity shareholders. Are you all participating? So 13,000 divided by 11.5% is their expectation. So 1,13,043 is the market value of equity of levered firm. Enna participate pandringla? Coming to the, sir, value of equity of the unlevered firm. Correct? What is the EBIT? 20,000. Are they liable to pay any interest? No, sir. That means 20,000 rupees is the EBIT. Yeah. Yes, sir. What is the expectation? 10%. So what is the value of market value of equity? Sir, enna sir, idu 1,13,000 da irukku, 2 lakh da irukku. Sir, there only equity I have considered. Sir, here equity plus dash has to be added. Debt has to be added. So the value of firm is equal to market value of equity plus market value of data. Just now you calculated for a levered firm, value of equity is 1,13,043. Yeah. Plus 1 lakh is the debt. So 1,13,043 plus 1 lakh comes to 2,13,043 is the value of the. I am going to, sir, picturize that in my table. 2 firms are there. One is what limited? M Limited and N Limited. M Limited is having equity and N Limited is having debt. Sir, for equity, what is the value of equity? 1,13,043. Are you all really with me? 1,13,043. What is the value of debt? 1 lakh. So the value of the firm is equal to 2,13,043. But in N Limited, value of debt is 0. And value of equity comes to 2 lakhs. So 2 lakh plus 0 comes to 2 lakhs is the what of the firm? Value of the firm. So as exactly MM said that value of the levered firm is higher than the value of the unlevered firm. Correct? So people will start flying from the levered firm to the unlevered firm. Right? Now I will tell you how the arbitrage process will work. If you have 10% shares of M Limited, you have to answer to me. Is M, my dear lovable students, levered, unlevered? So in levered, equity 10% you are holding. Your value of investment in equity shares is 10% of 1,13,043. That means 11,304.3 you are holding. That means in this 1,13,043, you are holding how much percent? Up 1,13,043 into 10% comes to 11,304.30 is your present investment. Correct. And return will be how much percent? 10%. Actually, now this company, levered firm, is having EBIT of 20,000. Yes, sir. Out of that, 7,000 they paid us interest. So 13,000 is the earnings available to the equity shareholder. If you are holding 100%, they will give 13,000 rupees, right? But if you are holding only 10%, so the present return you are enjoying is 1,300. Can I proceed, sir? Now, what is the alternate strategy? You will jump from the levered firm to the, sir, sell your 10% shares of the what firm? Levered firm at how much rupees? 11,304.3. So first step number 1, sell it. So you will get 11,304.30. Getting it? Yes, sir. And borrow 10% of the levered firm's debt. Correct, sir? Tell me, man, sir, is a levered firm is having data? How much? 1 lakh. 1 lakh into how much percent? So second step should be what? Borrow. How much borrow? 10%. So my dear lovable students, sir, 11,304 plus 10,000 comes to 21,304. 3 rupees will be there in your pocket. And invest the money, that is 10% in the unlevered firm stock. What is the value of the unlevered firm? 2 lakh. So out of this money available, you have to invest. You are going to invest 2 lakh into how much percent? That means from your pocket, how much money will go? That means, sir, 21,304.3 minus 21,000 means 1,304.30 will be there still in your pocket. This is called as arbitrage gain. Comfortable? So the total resource or money we have will be totally 21,304.3 will be there in your pocket. Picturizing. Yes, sir. Yes, sir. Solle. And invest 10% of 2 lakhs comes to how much? So out of the money available of 21,304.3, if you invest 20,000, still you are having 1,304.3. Yeah. Yes, sir. Now I am going to find out the net income, my dear lovable students. Earlier, I was 10% equity shareholder in levered firm. Earlier, I enjoyed 1,300. I already find out, man. Now, I am a 10% equity shareholder in the unlevered firm. What is the EBIT of the unlevered firm? 20,000. There, how much I am, sir, holding? 10%. So, 20,000 into 10% comes to, I will get dividend of 2,000. But I am having personal borrowing. What borrowing? Because I have borrowed. How much I borrowed? 10,000 I borrowed. For that, I have to pay KD. What is the KD available in the question? 7%. So tell me, 10,000 into 7% comes to 700. So from 2,000, if how much goes? I will be getting 1,300. Exactly the same. Are you all really with me? That means because of the what process also, arbitrage process also, my income has not been. So your return will be 10% EBIT of the what form? Minus interest to be paid on the borrowed fund. Correct? Up 20,000 or 10%. Will we get 2,000? And we borrowed 10,000. For that, are we liable to pay 7%? So 700. So 2,000 minus 700, 1,300 will be the net income. Even after you moving from levered firm to the unlevered firm. Still in your pocket, 1,304. Excess money will be there. For that 1,304, can you eat ice cream? Now your returns remain the same 1,300, which you can getting from what limited? Before investing in M limited, but still you have 1,304 excess money available with you. Hence, you are better off by doing the arbitrage. Comfortable? If you see the key moments in this match, in the above example, you have not invested the entire amount received from sale of shares of levered plus amount borrowed. Correct? Because the total money available with you was 21,304. You invested only 20,000. Number 2, you maintain same level of earnings and reduced investments. Correct, sir? Alternatively, you could have invested entire amount in the what company also. Sir, instead of keeping this 1,304.3 as idle in your hand, If there is no good projects with you as an investor, you can park even this money also in the unlevered firm and you can enjoy KE there. Then automatically you will be having higher return, correct? In that case, annual earnings would have been. I'm moving into illustration number 2. And can we finish off the second question from the leverage? We are having two type of leverage are there. One is arbitrage are there, primary arbitrage and the secondary arbitrage. Comfortable? The same question. Following data is available in respect of two company having same business risk. Capital employed how much? 2 lakh. EBIT how much? 30,000. KE how much? 12.5. Look at here, man. This is levered company and this is what? Unlevered. They take 10%, my dear lovable students. How much lakh? 1 lakh. Equity 1 lakh. 1 lakh plus 1 lakh. That's why here it is 2 lakh because capital employed should be same. If two companies are alike in, an investor is holding 15% shares in what company? Calculate the increase in annual earnings of investor. If he switches his holding from lever to the, if you want to know increase in what earning? Annual earnings, 100% of the money should be invested in the unlevered firm. Can we do? Yes, sir. Sir, everything actually they have given. Sir, tell me. I'm going to value of the firms. Tell me, this is levered firm and this is unlevered firm. What is the EBIT? 30,000, 30,000. Will both the company have same? Yes, sir. Less interest. Only levered firm is liable to pay interest. Correct? Yes, sir. What is the debt? 1 lakh. 1 lakh or 10% comes to 30,000, 10,000 levered firm மட்டும்தான் less பண்ணணும். யாருக்கு less பண்ணக்கூடாது. So earnings available to equity shareholder is 20,000 and 30,000. Can I proceed, sir? You tell me what is the KE, sir. KE is how much percent? 12.5%. Right, sir? So 12.5 is the KE of the levered firm and also KE of the unlevered firm. Because specifically they have not bifurcated what is the KE. Last question they have given separately. Hello, sir. So calculator man, sir, inga 30,000. I'm first calculating unlevered firm and 30,000 divided by 12.5% comes to 2,40,000 is the value of the, whereas my dear lovable students, value of equity, correct? What is the earnings available to the equity shareholder? 20,000 because after 30,000 you are liable to pay 10,000. But 20,000 divided by 12.5% comes to 1 lakh and sir, to this I have to add n of debt, value of debt. How much value of debt? 1 lakh. But here value of debt will be 0. So the value of firm will be value of equity plus value of debt comes to 2 lakh and, but here 2 lakh 40 plus 0 comes to 2 lakh 40. Correct? In this situation also, the value of the what firm? Levered firm is higher than the value of the unlevered firm. That means here also what arbitrage will work? But last question 10% was the holding. Here you are holding 15%. So come on, man. So in this 1,60,000 you are holding 15. 1,60,000 into 15% comes to 24,000 is what the amount you are holding. Correct? You sell it, you borrow it, you will be having sufficient money with you. You invest 100% in the unlevered firm. Correct? Then your net income will increase. Same increase. Come on, man. Analysis. Now the value of levered company is more than that of the Purida. Therefore, investor will sell his shares in what company? Levered company. And buy shares in the unlevered company. To maintain the level of risk, he will borrow proportionate amount and invest that also in the shares of the what company. Because question 1, how much is the increase in income? That means in order to enjoy more income, my dear lovable students, you should not keep anything in your hand. Can I proceed up? So investment and borrowing. Come on. Sir, what is the current equity share capital of the levered firm? 1,60,000. Adod evlo percent? 15%. That means now you are holding 24. What is the debt of the levered firm? 1 lakh. Adod evlo percent borrow pannid? 15%. 1 lakh into 15% come to 15,000. So what is the total money available with you? 39,000. Sir, actually, ideally, what is the value of unlevered firm? 2,40,000. On that also you are going to invest, sir, 15%. So 2,40,000 into 15% comes to 36,000. But in place of 36,000, I am going to invest 30. That means 3,000 extra I am going to invest. For this 3,000 extra, I will get additional return. Are you really with me? Now, my dear lovable students, I totally invested 39,000 where? Unlevered firm. Unlevered firm, I should get KE. What is the KE of unlevered firm? That means I will totally get 4,875. Enapa clarity, yeah. Sir, on that, can I enjoy entire 4,875? Yeah? Or I have to pay my interest on personal borrowing? What is my borrowing? 15,000. What is the KD? 10%. 15,000 into 10%. Out of 4,875, 1,500 I should pay as interest. Purida? So the net income in my pocket will be 3,375. When I was in levered firm, their earnings available to the equity shareholders was total எவ்வளோ ருபீஸ் அவங்களோட EBIT 30. அதுலேருந்து 10,000 போச்சுன்னா இந்த 20,000 15% எனக்கு கொடுத்துருந்தாங்களா? அப்போ சார் எவ்வளோ இன்டு எவ்வளோ? 20,000 into 15% comes to 3,000. Are you able to appreciate? So the incremental income, extra income, what I am enjoying because of shifting from levered firm to unlevered firm is 375 rupees. Right? Sir, the ideal investment what I am supposed to be make is only 36,000. But I have made extra investment of, for this 3,000, can I enjoy KE in unlevered firm? KE is 12 point. So 3,000 into 12.5% comes to 375. By that way itself, this answer can be find out shortcut. Comfortable. Instead of going this much NSR around, sir, நம்ம அங்கே நம்ம ஆன்சர் போடலாம். Last shortcut, have you understood? I'm moving to the last question, man. Illustration number 8. When the value of unlevered firm is more than the value of what firm? This is our secondary arbitrage. What arbitrage? So if the arbitrage is a primary arbitrage, value of the levered firm will be more than the value of the முதல்ல செல் பண்ணு, அப்புறம் borrow பண்ணு, அப்புறம் invest பண்ணு, அப்புறம் net income calculate பண்ணு, compare பண்ணு. Are you really with me? Yes, sir. Sir, if the value of the unlevered firm is higher than the value of the levered firm, please don't borrow. What man? Please don't. What you are supposed to do is, நீ sir, first one sell it. என்ன பண்ணு? Sell பண்ணு. Hello, sir. Sell பண்ணதுக்கு அப்புறம் sir, don't borrow. What man? Don't borrow. Are you really with me? Because already you are having higher investment. Because you are having 10% equity in the unlevered firm. Hello, sir. And you want to invest only 10% in the levered firm. So you are having sufficient money with you. Yes, sir. Then you have to invest. You have to what? In both debt and equity. In both what and what? Debt and equity. In both what and what? In debt equity ratio. In what ratio? Then calculate the net income and compare. And calculate the net income and, hey, are you all really with me what I am talking to you? My dear lovable students, I am moving into the next question and make you understand the secondary arbitrage. There are two companies, U Limited and L Limited. Hello, sir. Yes, sir. Sir, having same EBIT of 20,000 each. That L Limited is a what firm? Having debt of how much lakh? At 7%. And cost of equity of U Limited are 10% and 18%. Compute how arbitrage process will work. Hello, sir. Yes, sir. First one, unlevered firm. Who's unlevered? U and L. They are unlevered. U Limited unlevered. Abdina, who's levered? L. Are you really with me? Okay, man. Come on. What is the EBIT for both the company? 20,000, 20,000. Sir, always it will be same. Sir, who is having debt? L. L is levered. How much lakh? 1 lakh. KD, 7%. But KE, they have given different. Correct? Here it is 10 and here it is 18. Yes, Nyayam. Because in a levered firm, what is there? Debt is there. They will be expecting more return. That's why it is how much percent? 18%. Come on, man. Value of what share? Equity share. Which is nothing but, man, sir, earnings available to the equity shareholders divided by KE. Here, EBIT will be the earnings available to equity shareholders. 20,000 divided by 10% comes to, here, out of 20,000, debt 1 lakh into 7%, 7,000 they have to give it as interest. Appa 20,000 7,000 pochuna will be the earnings available to the calculator, sir. 13,000 divided by 18% comes to 72,222 is the value of equity. Hello, sir. Can I calculate the value of firm? For an unlevered firm, sir, value of firm is equal to value of equity. Can I proceed? For a levered firm, value of equity plus value of debt, which is 1 lakh plus 72,222 comes to 1 lakh 72,222. Look at the situation. Here the value of the unlevered firm is higher than the value of the, that means people will start fly from the unlevered firm to the levered firm. Sir, this is how arbitrage process will happen. If you have 10% shares of what firm? Unlevered firm. That means 2 lakh oda evlo percent? 10%. உன் கையில உனக்கு எவ்வளவு கிடைக்கும்? That is an investment of 20,000 is with you, comfortable. And you are getting 10% return. On this 20,000 EBIT, you can enjoy 10%. Up 20,000 into 10% comes to 2,000. Investment will be 10% of the earnings available to equity 1,000. How much? 2,000. That means in the present company, in the unlevered firm, you are having 20,000 equity. You are enjoying 2,000 rupees. Now you can, sir, jump from the unlevered firm to the levered firm. Sell your share. First you have to unlevered firm. How much you will get? 20,000. And buy 10% shares of levered firm. Equity plus what? Debt. Because in unlevered firm, only what was there? Equity was there. Now you are shifting from unlevered to in levered. What and what is there? Equity and debt is there. So in the debt equity ratio, you have to go and invest. Can I? Come on, man. Sir, what is the total market value of equity? 72,222. Adoda 10% invest panniko, which come to 7,222. Comfortable? What is the market value of the debt? 1 lakh. Adoda 10% invest panniko. Total 10,000. So the total investment in the levered firm is required is only 17,222. 17,222. Are you really with me? But you are having how much rupees in your hand? 20,000. Wow. Are you really with me? But in order to shift from dash firm to dash firm, unlevered firm to levered firm, I need only 17,222. So I will be having surplus money available. So 20,000 minus 17,222 comes to 2,778 extra money will be with you. Now I am checking what will be my return before arbitrage process and after arbitrage process. Correct? What, man? Ippo, you are in levered firm. 10,000 rupees, 1 lakh rupees is the market value of debt. On that you are holding 10%. Abdina, 10,000 you are holding. For that you will get KD of 7%. 700 rupees will come to you. Ennapa? And you are holding 10% of equity. What is the market value of equity? 7,222. Adoda 10% comes to 7,222. Correct? Adoda KE you will get. What is a KE of the levered firm? 18%. Up 7,222 into 18% comes to 1,300. Look at here, 1,300. That means total return will be how much? 2,000. This will be the return from the levered firm now. Correct? When you are in a firm, unlevered firm, you were holding 10%. Correct? What was the EBIT of that company? 20,000. Idoda 10%. Now also you are getting 2,000. That means your income has not been changed. But still in your pocket 2,778 is there. This is called as what gain. So in both the case, the return received is how much? 2,000. And still you have excess cash of 2,778. Hence you are better off by doing what? Arbitrage. That means you will start selling the what company share and buy dash company share, thereby pushing down the value of shares of unlevered firm and increasing the value of levered firm till what is reached. So in the above example, sir, have you invested 100%? No, sir, because you are having still money. Yes, sir. Sir, we have not invested entire amount received from sale of shares of what company? Sir, we have the same level of earnings along with the reduced investment. Am I right? Yes, sir. Alternatively, we could have invested entire amount in the what company? If we have invested entire amount in the levered company, we would have got extra interest and we would have got extra dividend and our earnings would have been increased. Comfortable? That means if you want, you can invest this extra 2,778 also. எங்க லீவர்ட் கம்பெனியில் டெட்டிலையா ஈக்விட்டிலையா போத் மிக்ஸ் என்ன மிக்ஸில் டெட் ஈக்விட்டி மிக்ஸில் அப்போ ஆட்டோமேட்டிக்காக முன்னாடி இருந்த இன்கம்மை விட இப்போ இருக்கிற இன்கம் என்ன ஆகும் அதிகமாகும் அப்படின்னா உனக்கு ஆர்பிட்ரேஜ் கெயின் இருக்காது அந்த ஆர்பிட்ரேஜ் கெயினை நீ வந்து ஃபுல்லாக கொண்டு போய் என்ன பண்ண போறேன்னா இன்வெஸ்ட் பண்ண போறேன் ஹலோ with this primary arbitrage and secondary arbitrage comes to an sir in order to work primary arbitrage value of the levered firm should be higher than the value of the unlevered. Then people will start sell the shares of the levered firm and they will borrow if required. Then they'll be having lot of money will be with them. The entire money they will not be investing in the levered firm, but even after the arbitrage process they will be having same income and extra money will be with them. That extra money is called as arbitrage gain. Alaga puriyada? Appreciate pandriya? But at any chance, if the value of the unlevered firm is higher than the value of the levered firm, such a situation is called as secondary arbitrage. People will start selling the shares of the unlevered firm and they will start investing in the shares of the levered firm. Automatically it will, sir, the shareholder will be having the same income with extra money in his hand. That extra money is called as arbitrage gain. With this, we can say that we are through with the revision of cost of capital. We are with the revision of capital structure theories. And the third one, arbitrage process. Are you all really with me? We are moving into the coming slot of discussion is EBIT and EPS analysis, my dear lovable students. That is also a part of this chapter where, sir, you have to find out the indifference point. Such a question may come in examination. We will discuss the concept of EBIT-EPS analysis and will be doing past 3 examination questions from EPS, EBIT analysis. Comfortable? Have a revision up to this, redo the questions and come back. We will continue with the discussion of EBIT and EPS analysis. In my capital structure, how much percent should be equity? How much percent should be debt? How much should be preference? Sir, taking such a decision is called as capital structure decisions. First question we are going to do from that area. This is a May 2022 past examination question. Look at the length of the question. So if you are preparing for your examination, we can't have an assumption that like this question and all will not come. This is a very past examination question. So that respect we have to give to this area. The particulars relating to Raj Limited for the year ended 31st March are given as follows. Output units at normal capacity 1 lakh unit. That means this company or the firm is having the capacity to produce 1 lakh unit. Selling price per unit 40. 1 unit can be sold for 40 rupees. Variable cost is 20. So 40 minus 20 will be 20 will be the contribution per unit. Fixed cost already given as 10 lakh. Capital structure of the company as at 31st March. That means already existing company man. Equity share capital total 10 lakh with equity shares of 10 each at the rate of 1 lakh at the rate of 10 each. They are having reserves and surplus of 5 lakh. They are having current liabilities of 5 lakh. Total comes to 20 lakhs. So 20 lakh is the existing capital employed. Raj Limited has decided to undertake an expansion project to use the market potential that will involve another 20 lakh. That means company is going to do a project. To do new project, company need fund. So how much is the capital required? 20 lakh. Company expects an increase in output by 50%. Currently, number of units is 1 lakh. But if the company doing this project, instead of 1 lakh, they can sell 1,50,000 units. Fixed cost will be increased by rupees 5 lakh. Already existing fixed cost of 10 lakh. If I do the new project, it will increase for another 5 lakh. And variable cost per unit will decrease by 15% because of economies of scale. That means if I am producing less number of unit, automatically per unit cost will be higher. If I am going to manufacture more number of unit, to my supplier, I can bargain for discount. This much units I am purchasing. No, please provide me what? Discount. So automatically raw material cost per unit will reduce. The additional output can be sold at the existing selling price without any adverse impact on the market. Still demand is there in the market. If we increase the number of units also, there are so many customers are ready to buy the product. Following alternative scheme for financing the proposal expansion program are planned. Alternative number 1, alternative number 2, alternative number 3. How much lakhs we need? 20 lakhs. Debt 5 lakh, that means balance equity 15 lakhs. Debt 10 lakh, that means balance equity 10 lakhs. 14 lakh debt, balance equity. Current market price per share is 200 rupees. In market, now the shares is going at 200. Slab-wise interest rate, sir, for fund borrowed is as follows. If you are borrowing debt up to an amount of 5 lakh, interest rate applicable will be 10%. Over 5 lakh, up to 10 lakh, KD will be 15%. Over 10 lakh, KD will be 20%. Find out which of the above mentioned alternative would you recommend for Raj with reference to EPS, assuming a corporate tax rate is 40%. So company is an existing company. Company will be having already EBIT. Company is going to do a new project with an additional capital of 20 lakh. When they put 20 lakh, they will get additional EBIT. Once they get additional EBIT, sir, in which option out of the 3 proposal, under which proposal my EPS will be higher is what the decision I have to take. So I am having how many alternative? 3 alternative. Alternative number 1, alternative number 2, alternative number 3. What is alternative number 1? Raising debt of 5 lakh and equity of, because 5 plus 15 total 20 lakhs. Alternate number 2, raising debt of 10 lakh and equity of, which comes to 10 plus 10 comes to 20 lakhs. Alternate number 3, raising debt of 14 lakh, balance equity of, so 14 plus 6 comes to 20 lakhs. Are you really with me? So what I am going to calculate the earnings per share. Earnings per share. Because I have to choose an option where my EPS is higher. My EPS is higher. So can I calculate the expected EBIT? Yes, sir. Sir, I am going to calculate the expected EBIT. By seeing the question, you say, how much number of units currently we are selling? 1 lakh. 1 lakh units. If I pump additional 20 lakh into my business, I can increase the production. And my output will increase by 50%. So my new number of units will be 1,50,000. 1,50,000 unit. And they said that even though the number of units increases, sale price will not get affected. So what is the selling price per unit? 40. 40. Sir, what is the old variable cost? 20. Because of increase in the production, we can enjoy the economies of scale. Sir, because of economies of scale, variable cost per unit reduces by 15%. That means new variable cost will be 85% of the existing. Correct? So 20 into 85% comes to 17 rupees. Comfortable? So the new contribution will be how much lakh? 23 lakhs. 23 rupees. 23 rupees per unit. Per unit. How many unit you are going to sell? 1,50,000. So 1,50,000 into 23 comes to 34,50,000 is the total contribution. Total contribution. Right, sir? You know marginal costing, sales minus variable cost, contribution, minus fixed cost, profit. Now I reach the contribution. I have to reduce the fixed cost. Already I am incurring fixed cost of 10 lakh. When I do the new project, I have to incur additional fixed cost of 5 lakh. Total fixed cost I have to incur will be 15 lakh. So from 34,50,000 minus 15 lakh, 19,50,000 will be my new EBIT. Let me ask you a question. Whether you are doing the project by all equity or fully debt or equity and debt, will the EBIT change? No. The EBIT is not a financing decision. It is an operating decision. Right, sir? So my dear lovable students, 19 lakh 50, 19 lakh 50, 19 lakh 50 is the EBIT, earnings before interest and tax. Sir, am I going to employ same debt in all option or different debt in different option? Different debt in different option. So if the debt changes, automatically interest changes. And the debt, here it is performing as per traditional approach. Because traditional approach said that if you inject more and more debt into the capital structure, even the KD increases. So the KD, as per the question, is a traditional approach question. Right? In option number 1, I am going to borrow to the extent of only 5 lakh. And they said that if I borrow only 5 lakh, so the interest rate will be 10%. So 5 lakh into 10%, 50,000 will be the interest for option or alternate number 1. Can I proceed? But they specifically said that if I am borrowing over and above how much lakh? 5 lakh up to 10 lakh, my interest will raise to 15%. It's slab system. It is what? Slab wise. Sir, if you are traveling through optional tax regime, up to 2.5 lakhs nil. Sir, 2.5 lakhs to 5 lakh at 5%, 5 lakh to 10 lakh at 20%, more than 10 lakh at 30%. Right, sir? Let me ask you a basic question. My income is 5 lakh. If my income is 5 lakh or above 5 lakh, will the entire 5 lakh will be taxed at 20%? Or I can still enjoy the basic exemption limit? The same what the slab wise meaning is all about. If it is more than 5 lakh up to 10 lakh, you have to calculate slab wise. That means for alternative number 2, for the first 5 lakh into 10%, 50,000. For the next 5 lakh into 15%, come to 75,000. Students will do a mistake here. They may apply entire 15% on the 10 lakh because they said that slab wise. So 50,000 plus 75,000 comes to lakh and 25,000 is the total interest under option number 2. Coming to alternate number 3, my dear lovable students. Sir, I am going to employ 14 lakhs debt. Correct? If you employ 14 lakhs debt over and above 10 lakh, how much percent? 3 slabs will come. First slab up to how much lakh? 5 lakh at the rate of 10% comes to 50,000. Next 5 lakh at the rate of 15% comes to 75,000. Comfortable? And 4 lakhs into 20% comes to 80,000. Are you all really with me? So 50 plus 75,000 plus 80,000 comes to 2,05,000 will be the interest in third option, alternate number 3. Sir, have I finalized EBIT? Same EBIT under all the option or different EBIT? Now I have to reduce the interest. Same interest, different interest. Why different interest? Different debt. So different interest. Right, sir? In option number 1, 50,000. Comfortable. Option number 2, 1,25,000. And option number 3, 2,05,000. So you'll be getting earnings before tax. From 19 lakh 50, if you reduce 50,000, you will get 19 lakh. From 19 lakh 50, if you reduce 1,25,000, 18 lakh 25,000. From 19 lakh 50, if you reduce 2,05,000, you will get 17 lakh 45,000. Pay the tax at the rate of, sir, I am not calculating 40, I am straight away calculating 60. Can I? So my dear lovable students, 19 lakhs into 60% comes to 11 lakh 40,000. Sir, 18 lakh 25,000 into 60% comes to 10 lakh 95,000. 17 lakh 45,000 into 60% comes to 10 lakh 47,000. Are you all really with me? Now, if one part of the capital required if I raise by debt, the other part has to be raised by equity. Already I am having number of equity. Yes, sir. Already I am having number of equity shares are there. And now I am going to raise fund by issuing additional equity. Right, sir? So what is the number of equity share to be issued? My dear lovable students, what is the total capital employed? 20 lakhs. Out of that, in alternate number 1, debt, 5 lakhs. Up at 20 lakhs minus 5 lakh, 15 lakhs. So 15 lakhs has to be raised by way of equity. And for every equity share, 200 rupees is the market price. So 15 lakhs divided by 200. 7,500 additional shares I have to issue. Comfortable? Are you really with me? Already you are having existing number of shares. Can you say how much is the existing number of share? 1 lakh. Whether it is alternate number 1, alternate number 2, alternate number 3, the existing number of share will not change. Clarity? In alternate number 1, I have to raise additional equity share of 7,500. So the total number of equity share will be 1,07,500. Why are you calculating? Then only I can calculate EPS. Because EPS means residual earnings divided by number of equity share. But if I am traveling through alternate number 2, sir, there the debt increases. Out of 20 lakh, 10 lakh, I am raising by way of debt. That means balance 10 lakh, I have to raise by way of equity. And for every equity share, the current market price is 200. So 10 lakh divided by 200 means 5,000 number of equity share I am supposed to issue. Comfortable? Already I am having 1 lakh share, additional share 5,000, and the total number of equity share will be 1,05,000. In alternate number 3, even I am injecting more debt. That means out of 20 lakh, if I inject 14 lakh debt, balance 7 lakh, 6 lakhs will be the equity to be raised. Are you all really with me? And every share in the market is 200. So 6 lakhs divided by 200 comes to 3,000 shares is what I'm supposed to issue. That means if debt increases, equity reduces. If equity reduces, automatically number of equity shares also reduces. So existing 1 lakh plus 3,000 comes to lakh and 3,000. Sir, I already have PAT. Now number of equity shares. First case 1 lakh 7,500. Second case 1 lakh 5,000. Third case 1 lakh 3,000. So in first case, sir, 10.6 is the EPS. In second case, 10.43 is the EPS. And in third case, 10.17 is the EPS. You tell me which is the option having highest EPS. That's what you have to write as conclusion, man. Alternate number 1, raising debt of 5 lakh and equity of 15 lakh is recommended, which maximizes the EPS. If your goal is to increase the EPS, please follow alternate number 1. That will give you the best EPS. Automatically, the wealth of the equity shareholders will be increasing. So in examination, such type of question will be asked, my dear lovable students, where you have to take a decision where under which option your EPS is the highest. Such decision taking chapter is called as capital structure decisions. Capital structure decision. By this question, you know what decision I have taken? I have taken a decision where in my capital structure, 5 lakh should be the debt and 15 lakh should be the equity. I am talking about the new one. Out of 20 lakh, 5 lakh should be the debt and 15 lakh should be the equity. That means till now we were worrying that there is no law in the FM saying that this much should be the percentage of equity, this much should be the percentage of debt, this much should be the preference, and this much should be the preference reserves and surplus. Taking such a decision is called as capital structure decisions. Comfortable? From this question number 1, we have completed, my dear lovable students. I am moving into the second question, which is illustration number N from this area. Can we? Sir, the management of RT Limited wants to raise its fund from market to meet out the financial demand of its long-term project. So this company need fund. Company has various combination of proposal to raise its fund. Yes. Proposal P, proposal Q, proposal R. Proposal P 100% from equity shares. That means it's an all equity option. All equity option. All equity option. Because I don't know whether they are having currently debt or not. The option is called as all equity option. Whereas with regard to Q, if you are traveling through option Q, 50% equity, 50% debt. It's 1:1 debt equity ratio. Are you really with me? If you are traveling through R, 50% equity share and 50% preference shares. These are the other information. Cost of debt, KD, and preference shares is how much percentage? 12% each. KD is equal to 12% and even KP is equal to 12%. Generally, like this will not come. Because KD will be having tax benefit, whereas KP will not have tax benefit. KD should be cheaper than KP. Correct? Question if they said that both are 12, I can't change it and all. Tax rate is 40%. Equity shares of the face value of 10 each will be issued at a premium of how much per share? That means issue price will be 10 plus 10 comes to 20. Total investment to be raised is 80 lakh. How much lakh? 80 crore. 8 crores. 8 kodi. 8 kodi. So 8 crores I have to raise. Expected earnings before interest and tax, which is EBIT, is equal to 3 crores 60 lakhs. Right, sir? From the above proposal, management want to take advice from you for appropriate plan after computing the following, which is EPS. As an advisor, you have to choose a plan which is having the highest EPS and financial break-even point. What break-even point? What is the financial break-even point of the company? In costing, sir, you are calculating the operational break-even point. It can be calculated in number of units, fixed cost divided by CPU, or in value, fixed cost divided by PVR. Are you really with me? Yes, sir. Compute the EBIT range among the plan for the indifference. This is the third requirement of the question. So there are 3 requirements are there, and this is an RTP November 19 question. Very good question, where you are hearing about the financial what even point and indifference. This is the maximum variety from this chapter you can get is capital, sir, in a sir, structure decisions. Can we? My first question to you, sir, whether you are adopting the plan PQR, based on that, will the EBIT change? Will not change. Because EBIT is not a financing decision, it's an operating decision. Can I proceed? So 3 crore 60 lakh, 3 crore 60 lakh, 3 crore 60 lakhs. Are you really with me? What is plan number 1? It's all equity plan. It is what? All equity plan. What is the total capital required? 8 crores. Sir, so equity is equal to 8 crore. In plan number 2, equity 4 crores and debt 4 crores. Are you really with me? And with regard to R, my dear lovable students, sir, equity 4 crores and preference shares 4 crores. Always right at the Monday. Then it will be very easy for you to calculate the interest and workings and all. You will never go wrong. After writing this, you start even the EBIT also. You tell me less interest charge. In situation number 1, sir, in alternate number 1, will interest come? No, because it's a all equity option. In second, sir, second one, will interest come? Yes. My dear lovable students, what is the debt? 4 crores, 2, 4, 6, into what is the 12% comes to 48 lakhs is the interest. In the third option, there is no debt at all. Then how interest will come? So the earnings before tax will be 3 crore and 60 lakh. 3 crore 60 lakh minus 48 lakh comes to 3 crore 12 lakh and 3 crore and 60 lakhs. Comfortable? Less tax at the rate of 40%. Sir, 3 crore 60 lakhs into 40% comes to 1 crore 44 lakhs. Getting it? 3 crore 12 lakhs into 40% comes to 1 crore 24 lakh 80,000. 3 crore 60 lakhs into 40% comes to 1 crore 44. What is the PAT, profit after tax, at the rate of 60%? Balance only. 3 crore 60 minus 1 crore 44, 2 crore 16, 1 crore 87, 20,000, 2 crore 16 lakh. Less what dividend? In option number 1, there is no preference share capital at all. In option number 2, there is no preference share capital at all. But in option number 3, for this 4 crore, you are liable to pay the same 48 lakhs will be the preference dividend. Right? Mathematically should be same. So you will be getting earnings available to the equity shareholders. 2 crore 16 lakhs. 1 crore 87 lakh 20,000. 1 crore 68 lakhs. Comfortable? Now I have to calculate the number of equity shares. Can I calculate the number of equity share? Already number of equity shares there are not there. Have they said anything about the existing? No, sir. No, sir. So the entire 8 crores you are going to raise by way of equity means 8 crores divided by 20. Calculator. 8 crores divided by 20 means 40 lakhs is the number of equity share. In the second case, 4 crore divided by 20 comes to 20 lakhs is the number of equity shares. Getting it? In third case, for again same 20 lakh because the remaining was preference shares. Can I proceed? So the EPS earnings per share 2 crore 16 lakhs divided by 40 lakhs comes to 5.4 per share if you are going with all equity. Always all equity will not give the best option because financial leverage will not work. Trading on equity will not work. So better to go with debt. So 1 crore 87 lakh 20,000 divided by 20 lakhs comes to 9.36. Are you really with me? Sir, 1 crore 68 lakhs divided by 20 lakhs comes to 8.4. So the best option is option 2. Option Q. I am taking this opportunity to explain one small concept. Sir, I introduced 4 crore debt. I introduced 4 crore preference. Correct. Both are having same KD, same KP. Still under the debt option, we are having the highest EPS. Because for debt, we are having tax benefit. But for preference shares, we don't have. That tax savings will be, sir, go to the equity shareholders. Go to the, if you see my dear lovable students, since I have adopted debt in my what structure? Capital structure, I have paid interest to the extent of 48 lakhs. 48 lakhs. Since I have debited 48 lakhs to my what account? P&L account. Sir, this 48 lakhs would have saved tax at the rate of 40%. At the rate of. So 48 lakhs into 40% comes to 19 lakh 20,000 would have been the tax saved, which is nothing. 1 crore 87 lakh 20,000 and 2 crore 16 lakh. Look at the difference. 2 crore 16 lakh minus 1 crore 87 lakh 20,000 comes to, sorry, tax. I wrongly took. 1 crore 44 lakh minus 1 crore 24 lakh 80,000. 1 crore 44 lakh minus 1 crore 24 lakh 80,000 comes to 19 lakh 20,000. 19 lakh. So this extra money will be there with financial plan Q. But this extra money won't be there with financial plan R. Right? This 19 lakh 20,000 will be enjoyed by the 20 lakh equity shareholders. Correct? So divided by 20 lakhs means 0.96 extra EPS the equity shareholders can enjoy. What is 8.4 plus 96 comes to? This is what 9.36. Look at here the exact EPS we have derived. Are you already with me? This is what happening inside in the financial structure. That's it. First part of the question done. The second part, financial break-even point. First understand what is the concept financial break-even point. It is a level of EBIT where your EPS should be 0. Your EPS should be 0. That means I am having some level of EBIT. With that I will pay interest. With that I will pay preference dividend. I won't have anything to the equity shareholders. Equity shareholders is saying that you paid interest, you paid preference dividend, and you paid tax on preference dividend. Are you totally with me? So in proposal number 1, there is no what at all? Debt at all. If there is no debt, if there is no preference, there is no question of financial break-even point at all. That's why it is 0. Comfortable. In second situation, second scenario, how much is the interest you are going to pay? 48 lakhs. That means if my EBIT is 48 lakh, I will pay that 48 lakhs as interest. Then my EBT will be 0. If there is no EBT, there is no tax. Then PAT will be 0. If 0 is the PAT, automatically EPS will be 0. Comfortable? So in the situation number 2, 48 lakhs will be the financial break-even point. That means if I am having an EBIT of 48 lakhs, my EPS will be 0. In situation number 3, I don't have interest. I have to pay preference. But in order to pay preference dividend, I have to pay tax on preference dividend. That is called as tax on preference dividend. Clarity? That means how much preference dividend I am going to pay? 48 lakhs. This will be, my dear lovable students, sir, 60%. Am I right? 60%. So calculator. 48 lakhs divided by 60% comes to, if I earn 80 lakhs of EBIT. Look at here. EBIT is how much lakh? 80 lakh. What is the interest I am supposed to pay? 0. Because in that option there is no debt at all. So the earnings before tax will be 80 lakhs. Right, sir? Less tax at the rate of 40%. So 80 lakh into 40% comes to 32 lakhs. Are you really with me? So 80 lakhs minus 32 lakhs comes to 48 lakhs is the profit after tax. That I will pay as preference dividend 48 lakhs, then automatically my residual earnings will become 0. If residual earnings is 0, EPS will be 0. Such a level of EBIT is called as financial break-even point. So 80 lakhs. Second part of the question also done. So through this question we have explained one concept called as financial. Then I'm moving into the computation of indifference point between the proposal. How many proposal? 3 proposal. Understand the concept of indifference point. Sir, I'm having 3 alternatives, sir. Alternatives classified into 3 categories. Alternate number 1, alternate number 2 and alternate number 3. My dear lovable students, if I am traveling through alternate number 1, sir, I should have an EPS. I should have a EPS. The same EPS I should get in alternate number 2. The same EPS I should get in alternate number 3. So, there is a level of EBIT. There is a level of EBIT where EPS under these 2 options will be one and the same. EPS under these 2 options will be one and the same. EPS under these 2 options will be one and the same. That means at that level of EBIT, if you are choosing option number 1 or option number 2, you will be having same EPS. You will be having same EPS. That is called as indifference point. Now I am calculating indifference point. What point? Indifference point for alternate number 1, alternate number 2 and alternate number 3. Right, sir? But you can compare only 2 alternatives at one time. You cannot compare all the 3 alternatives at the same time. Sir, if they ask indifference point in question, nothing, just write the EBIT minus interest. Minus what? Interest. You will get earnings before tax. Less tax at the rate of 40%. You will get what? PAT. Profit after tax. Profit after tax. Pay the preference dividend. You will get the residual earnings. Residual earnings. Divided by number of equity shares. Number of equity shares. You will get the EPS. Earnings per share. Earnings per share. Comfortable? My dear lovable students, sir, you know the EBIT, you don't know the EBIT. Because indifference point is a level of EBIT where the EPS is same. If the EPS is 0, that is financial break-even point. If the EPS is same, that is indifference point. That is the only difference between 2 concepts. Comfortable? Sir, in case number 1, it's a all equity option. There is no interest. But in case number 2, you are paying an interest of 48 lakhs. Yes, sir. In case number 3, there is no what at all. That means earnings before tax will be EBIT. Here EBIT minus 48 lakh. Here again EBIT. Right, sir? Sir, 0.4 EBIT I have to pay as tax. Sir, here 0.4 EBIT minus 48 lakhs into 0.4 comes to 19 lakh 20,000 I should pay as tax. Here 0.4 EBIT I should pay as tax, right? From 1 EBIT, if I pay 0.4 EBIT, 0.6 EBIT will be with me. Here from 1 EBIT, if I pay 0.4 EBIT, 0.6 EBIT will be with me, minus 48 lakh minus 19 lakh 20,000 comes to 28 lakh 80,000. Comfortable? Here from 1 EBIT, if I pay 0.4 EBIT, then 0.6 EBIT will be with me. There is no preference dividend for first two case. But you are going to pay a preference dividend of 48 lakhs for the last case. Correct? So here 0.6 EBIT will be the residual earnings. Here 0.6 EBIT minus 28 lakh 80,000 will be the residual earnings. Here man 0.6 EBIT minus 48 lakh will be the residual earnings. Comfortable? Under option number 1, how much is the number of equity share? 40 lakhs. We already calculated. Correct? Under option number 2, how much is the number of equity share? And in option number 3, how much is the number of equity share? So my EPS, earnings per share is equal to 0.6 EPS divided by 40 lakhs. Basically residual earnings divided by number of equity shares and residual earnings divided by number of equity shares. Now I am going to calculate the indifference point for financial plan 1 and financial plan 2. Are you all really with me? That means 0.6 EBIT divided by 40 lakhs should be equal to 0.6 EBIT minus 28 lakh 80,000 divided by 20 lakhs. Are you all really with me? Straight away this 40 lakhs and 20 lakhs. Straight away cut. This is 2 and this is 1. Pakka? So rewritten as 0.6 EBIT divided by 2 is equal to 0.6 EBIT minus 28 lakh 80,000 divided by 1. Comfortable? That means, sir, 0.6 EBIT is equal to 1.2 EBIT minus 28 lakh 80,000 into 2. Come to 57 lakh 60,000. Can I proceed? That means 1.2 EBIT minus 0.6 EBIT is equal to 57 lakh 60,000. Comfortable? That means 0.6 EBIT is equal to 57 lakh 60,000. So EBIT is equal to 57 lakh 60,000 divided by 0.6 comes to 96 lakh. That means if you are having an EBIT of 96 lakhs, whether you do the project with full equity or debt and equity, you will have the same EPS. Right? Immediately apply into the table. Don't write and all. If the EBIT is 96 lakh, residual earnings is 60% of 96 lakhs. So 96 lakh into 60%. 57 lakh 60,000. Following divided by number of equity share 40 lakh. So 1.44 is the EPS. In situation number 2. Take 60% of EBIT, which is 57 lakh 60,000 minus 28 lakh 80,000. Balance will be 28 lakh 80,000 divided by 20 lakhs comes to 1.44. Sir, magic, sir. Are you really with me? It's not magic, it's logic. Are you really with me? My dear lovable students, at the EBIT of 96 lakhs, whether you are doing the project with all equity or whether you are doing the project with equity and debt, you will be having EPS, same EPS of 1.44. Same EPS of. Now, for what purpose this topic I am studying? Chumma putting table, chumma finding answer. Is there any application? Yes. I will tell you what is the application. My dear lovable students, if the project, the new project, what you are going to do is actually having an EBIT of 96 lakh, I am indifferent. I am indifferent. Whether I go with the first option or second option, I will be having the same EPS. If my actual EBIT is less than 96 lakh, the finance manager is saying that if we do this project, we will be having an EBIT of less than 96 lakhs. I will only go with option number 1. I will not take the risk. I will always go with all equity option. Always go with all equity option. Sir, if the actual EBIT is more than 96 lakh, I will never choose all equity option. I will choose the equity and debt option because I am having more EBIT. That means I can bear the interest. I can bear the interest. Then my trading on equity will work. So this is very important for examination for your perspective. If they ask one more step forward, you will be in big trouble. Finding out the indifference point, okay, fine. Edu calculate pandra? Some table I put E. So my dear lovable students, you have to compare with the actual what? EBIT. Actual EBIT. Your actual EBIT may be equal to the indifference EBIT. Paka? Then your decision is indifference. That is. Whether I choose the equity option or whether I choose the debt option, I will get the same EPS. But if the actual EBIT is more than the indifference EBIT, then I will go with the debt option. Are you all really with me? If the actual EBIT is less than the indifference EBIT, then I will go with the all equity option. All equity option. This is the decision you are supposed to take. That's it. So we have calculated the indifference point between P and Q. We got the answer as 96 lakhs. The same thing only I have done, but I used to do using table approach. They used to do using formula approach. Better if you are feeling table, go with table. If you are a sir CV Raman, go with the sir mathematics. I don't have any problem. Are you all really with me? Yes, sir. Now the doubt is who is CV Raman? Go and Google it. Come on. Coming to the next one, man. Sir, I have to still perform 2 more projects between dash and dash. A2 and A3. That's what smartly I have done for all the project one table. Otherwise, every time you have to repeat. 3 hours will be swaha. So tell me, sir, 0.6E minus 28 lakh 80,000 divided by 20 lakh equity share should be equal to 0.6E minus 48 lakhs divided by 20 lakhs. Here, my dear lovable students, 0, 0 cancel 1, 1. Right, sir? That means 0.6E minus 28 lakh 20,000 should be equal to 0.6E minus 48 lakh. 48 lakh. Are you really with me? If I solve this, sir, I can bring 0.6E minus 0.6E is equal to minus 48 lakh plus 28 lakh 80,000. Mathematically right. So this will be equal to 0 and this you will be getting some figure. 19 lakh 20,000. So 0 is equal to 19 lakh 20,000. That means between these two options, there is no concept of what at all? Indifference point at all. There is no level of EBIT where for plan 2 and plan 3, your EPS will be same. That match. Okay. A2 and A3, there is no indifference point. That's what the next one, man. Between proposal P and proposal Q, proposal Q and proposal R, sir, EBIT will be cancelled and become 0. So combination of proposal Q and R is not possible. But I have to calculate the 1 and 3 now. 1, 2 patachu, 2, 3 patachu, 1, 3 pakanum. Which is 0.6E divided by 40 lakhs should be equal to 0.6E minus 48 lakh. 0.6E minus 48 lakhs divided by 20 lakhs. Can I cancel? Yes, sir. 2, 1. Hello, sir. Yes, my dear lovable students. 0.6E divided by 2 is equal to 0.6E minus 48 lakhs divided by 1. That means 0.6E is equal to 1.E minus 96 lakhs. Can I proceed? So 1.2E minus 0.6E is equal to 96 lakhs. Can I proceed? 0.6E is equal to 96 lakhs. So E is equal to 96 lakhs divided by 0.6 comes to 160 lakhs is the EBIT. So at 160 lakhs EBIT, whether you are doing project with option 1 or option 3, you will be having the same EPS. Comfortable? Brilliant question. This question should be LDR for your examination. Last day before the exam, try this question. Because, sir, EPS, IS-EPS decision, financial break-even point concept, and also EBIT-EPS analysis. Are you really with me? Indifference point. What point? Indifference point. So this is a beautiful question, man. A brilliant. This question should be tried before the day of examination. Can we try one more question from this area? With that, the slot will come to an end. Current capital structure of XYZ Limited is as follows. Equity share capital of how much lakh? 7 lakh. Of face value of how much each? 20 each. Reserves and surplus of 10 lakh. 9% bonds of 3 crore. 11% preference shares of 3 lakh. Of face value of 5 each. Additional fund required for XYZ Limited are 5 crore. Totally 5 crore additionally we need. XYZ Limited is evaluating the following alternatives. Proposed alternative number 1. Raise the fund via 25% equity capital and 75% debt. 5 crore or 25%? 1.25 crores. 75%? 3.75 crores at 10% KD. PE ratio in such scenario will be 12. That means if I do this, market will react. Correct? I can't do whatever I want in my company because equity shareholders will be seeing like this. If I inject more debt into the capital structure, they will say that because you increase the risk. Proposed alternative number 2, raise the fund via 50% equity and rest from 12% preference shares. PE in such scenario will be what? 11. Any new equity share would be raised at a face value of, and any new preference share will be issued at a face value of 20 each. Tax rate is 34%. Determine the indifference point under both the alternatives. Indifference point. So, before I prepare the indifference point, let me calculate the basic data. Basic data. You tell me, today in market, what is the current market price of an equity share? 20 rupees because 20 each. How much number of equity shares are there? 7 lakhs. So 7 lakhs into 20 comes to 1 crore 40 lakhs is the equity share capital. Can I? Already company having reserves of 10 lakhs. Sir, already company having 9% bonds of 3 crore. Already having company having 11% preference shares of 3 lakh at the rate of 5 comes to 1 crore 50 lakhs. Yellati add pannena 6 crore is the total capital employed. That means presently the company is having a value of 6 crore. It's a 6 crore company. Now we are going to additionally raise 5 more crores with 2 options with proposal number 1 and proposal number 2. Right, sir? So capital to be raised under both the proportion is 5 crores and 5 crores. Clarity? My dear lovable students, what is the proportion? In situation number 1, 5 crore into 25%, 1.25 crore and 5 crore into, sir, 50%. Angus, no man, debt. No, 25 and 75 and 50 and 50. Right? Sir, in proposal number 1, 25% equity means remaining 75% should be debt. Debt. Are you really with me? That means if 1.25 crores is equity means 3.75 crores should be debt. Debt. Total 5 crore. 5 or 6? 5 crores. 5 crores. Sir, here in proposal number 2, 50-50. 2.5 crores and 2.5 crores. Are you really with me? Yes, sir. Sir, so now what is a combined capital? combined capital. Already you are having an equity of 1.4 plus reserves of 10 comes to 1.5, correct? Plus you are raising 1.25. So 1.5 plus 1.25 comes to 1.5 plus 1.25 comes to 2.75. But they have written 2.65, which is nothing. Reserves they have not clubbed. Yes, sir. So nothing. Old equity share capital 1.4 crores. Sir, new 1.25 crores. Total 2.65 crores. Able to follow? Anga. Already equity 1.4 crores. New 2.5 crores. Total 3.9 crores. This is the combined. Reserves anyway not going to change. All reserves will continue 10 lakh, 10 lakh. 9% bond will not change 3 crore, 3 crore. 10% debt will change. Sir, 10% debt, sir, proposal 1, 3.75 crores and there 2.5 crores. Sir, that's what? 3.75 crores. Right, sir? Debt. Paka? In proposal number 2, inga vande debt ku badala yaru varva? Preference with 12% preference share capital. So 12% preference dash and 2.5 crores, which is new part, second part, 50%. And 11% preferences, you are already having 1.5 crores and the total capital employed will be 11 crore because already you are having capital of 6 crore plus additional capital, total 11 crore. This is a proposition of the 11 crore. Clarity? What is the interest for proposal number 1? I am supposed to pay, sir. Interest means, sir, 3 crore into 9% and 3.75 crore into 10%. So 3 crore into 9 plus 3.75 crore into 10. Total comes to 27 lakh and 37 lakh 50,000 come to 64 lakh 50,000. I should pay as interest if I am traveling through the proposal number 1. But in proposal number 1, do you have any preference share capital? Yes, sir. What is the preference share capital? 1 crore 50 lakhs into preference dividend of 11%, 16 lakh 50,000 should be the preference dividend. That's it. Proposal 1 calculations done. Interest for proposal number 2, simple. Sir, 3 crore into 9%. That's it. 27 lakhs. Comfortable. Preference dividend for proposal 2. Already I am having preference shares of 1 crore 50 lakhs. This into 11%. 2 crore 50 lakhs. This into 12%. Correct? So 1 crore 50 lakhs into 11% comes to 16 lakh 50,000 plus 2 crore 50 lakhs into 12% comes to 30 lakhs. Total comes to 46 lakh 50,000. Comfortable? That's it. Now all the basic data has been done. This I will not solve. I will be doing the table approach. How many options? 2 options. Only 2 options. So 1 indifference point. I have to write that EBIT minus interest. I will be getting earnings before tax less tax at the rate of 34%. Are you really with me? Yes, sir. You will be getting PAT, profit after tax, less preference dividend. You will be getting residual earnings divided by number of equity shares. You will be getting the EPS, earnings per share. Can we? I don't know EBIT, that is the suspense. Sir, interest under option number 1. 64 lakh 50,000. Under option number 2, 27 lakh. Up in 64 lakh 50,000 and 27 lakh. So it is E minus 64 lakh 50,000. E minus 27 lakhs. Can I? So 0.34 E minus 64 lakh 50,000 into 34%. 21 lakh 93,000. Following. Again 0.34 E minus 27 lakhs into 34% comes to 9 lakh 18,000. Can I proceed? That means, sir, 101 minus 0.34 comes to 0.66 E minus 64 lakh 50 minus 21 lakh 93,000 comes to 42 lakh 57,000. Again 0.66 E minus 27 lakhs minus 9 lakh 18,000 comes to 17 lakh 82,000. Comfortable? Under option number 1, there is preference dividend. Please note the preference dividend properly. Under option number 1, preference dividend is 16 lakh 50. And option number 2, preference dividend is 46 lakh 50. Please help me. What is the option number 1? 16 lakh 50,000. 46 lakh 50,000. Comfortable? My residual earnings will be 0.66E minus 42 lakh 57,000 plus 16 lakh 50,000. 59 lakh 7,000. Is my calculation right? 0.66E minus 17 lakh 82,000 plus 46 lakh 50,000, which comes to 64 lakh 32,000. What is the number of equity shares under option number 1? We have to calculate. 2 lakh 65,000 divided by 20. Correct then? So 2 crore 65 lakhs divided by 20 means 13 lakh 25,000 is the number of equity share for option number 1. Whereas for option number 2, 3 crore 90 lakhs divided by 20 comes to 19 lakh 50,000 should be the equity for option number 2. Sir, if we have added the 10 lakhs to this, our number of equity shares will be swaha. Correct? That's why they have showed it separately. You are not calculating WACC using market value weight. If that is the case, we could have included there. Fine. So I got the formula, which is residual earnings divided by number. Residual earnings divided by number. You should help me to solve this. Sir, 0.66E minus 59 lakh 7,000 divided by 13 lakh 25,000 should be equal to 0.66E minus 64 lakh 32,000 divided by 19 lakh 50,000. Right? First 3030 cancel. So 0.66E minus 59 lakh 7,000 divided by 1325 should be equal to 0.66E minus 64 lakh 32,000 divided by 1950. Ella 0 cancel பண்ணிட்டு 3 0 தான் cancel ஆகும். By mistake, if you put 195, that's it, gone. John, you are gone. So 1325 divided by 5. Can I write this as 265? 1950 divided by 5. Sir, can I write it as 390? Still 5 la povulya. 365 divided by 5 comes to 53 or 73. Sorry, 265 divided by 5 comes to 53. That's the max I can do, correct? 53. And 390 divided by 5 comes to 78. I can cross multiply straight away. Is there any common number 53, 78 and all? No, sir. Better cross multiply. LCM. Alright, sir. So 78 into 0.66 comes to 51.48E minus 59 lakh 7,000 into 78 comes to 46 or 4 crore. 4 crore 60 lakh 74,000. I know. 46 crores 7 lakh 46,000. Number yes, sir. Yes, sir. Yes, sir. Leave it. So we have done it. No, should be equal to, sir, 0.66 into 53 comes to 34.98E minus 64 lakh 36,000 into 53 comes to 64 lakh 32,000 into 53 comes to 34 crore 8 lakh 96,000. 96,000. Hello, sir. Is denominator comma or over? How sir? Even now, can I bring all the E? 51.48E minus 34.98E should be equal to, sir, 46 crore 7 lakh 46,000 minus 34 crore 8 lakh 96,000. Fine. So 51.48 minus 34.98 comes to 16.5E should be equal to 11 crore 98 lakh 50,000. Example on the doubt or answer correct. E is equal to 11 crore 98 lakh 50,000 divided by 16 point E 72 lakh 63,636 point. At this EBIT, EPS of both the option will be one and the same. 72 lakh 63,636.36. Are you all really with me? Appreciating, huh? Sir, you know, this is a RTP May 23 question. May. Same question may be picked for examination. If you are having the courage to say that, that's your choice. Your life. My dear lovable students, sir, like these questions will be coming, you have to practice this type of question by your own. Surely, you will ask one question. If you yourself are solving all that, how I will practice? Redo those questions. Don't worry, you are having another 3 questions for your practice. Sir, the same type of question, Akash Limited. This is a RTP May 2019. Try by yourself and check the answer. I have attached the answer for you. Then, number 2, Alpha Limited question. My dear lovable students, this is ICAI study material question only. Book back. ICAI book back only. You can try by yourself and you yourself can put the EBIT. You try everything if you hear when you will try. You try by your own. I have arranged the questions to you. And question number M, the financial advisor of Sun Limited. Even this question is also a ICAI book back question. Are you all really with me? Then you check yourself where you are going wrong. And these 2 questions are ICAI book back question. The same can be lifted for examination also. So don't take a risk. With this, officially we can declare that we are through with capital structure decisions, my dear lovable students. Are you really with me? First do the 3 questions which I have solved. Then do the next 3 questions which I ask you to try. We'll meet at the appropriate time with a different chapter. Till that, thank you. Bye-bye from ANM. Sir, very, very, very happy evening to all. Yes, sir. Sir, in the last class, we have done, my dear lovable students, the EBIT-EPS analysis. In that, I have given 3 questions for your checking. I believe that you would have tried. If someone is suffering from why this step has been done like that, I will quickly go through the answer for your easy benefit. Akash Limited provides you the following information. EBIT is 2,80,000. Less interest on debenture, 40,000 at the rate of 10%. So, they will be having debt of 4 lakh. EBT, 2,40,000. Less tax at the rate of 50% comes to 1 lakh. And so, the PAT, profit after tax, is 1 lakh and number of equity shares given 30,000. So, 1,20,000 divided by 30 comes to 4 per share. Price earning ratio, 10. Price earning ratio 10 times. Company has reserves and surplus of how much lakh? 7 lakh. And required 4 lakh further for modernization. 7 lakhs plus 4 lakh is the total capital required. Return on capital employed is constant. That means whatever return on investment you are enjoying now, the same return on investment you will get for the new project also. Debt, that is debt bar, debt by debt plus equity ratio higher than 40% will bring the PE ratio down to 8. That means now 10 is the price earning ratio. If you are injecting more debt into the what structure, equity shareholders will start fear and it will start reflect the price earning ratio and the interest rate on additional debt to 12%. You are required to ascertain the probable price of the share. Probable price of the share. If additional capital is raised as only debt or if amount is raised by issuing equity shares at the ruling market price. This is a RTP May 2019 question. Can we? What is the additional fund required? 4 lakhs. Total 11 lakhs. Anyway, we are having reserves and surplus of 7 lakh. So, monetary money required. So, plan number 1, if the 4 lakh is raised as debt, Plan number 2, if 4 lakh is raised by issuing equity shares. Right, sir. What is the earnings before interest and tax? Sir, have they given anything? Yes. Now the currently profit, sir, EBIT of how much? 2,80,000. Can we calculate? Yes, sir. Tell me, man, what is the, this will complete and come up. What is the existing equity share capital? Existing equity share capital, 3 lakhs. Already given in the 10% debenture, we calculated by reversing the interest rate. Total comes to reserves and surplus, already given in the question as, so total capital employed is 14 lakh. Existing. Correct? For an investment of 14 lakh, we are getting a return of 2,80,000. That means the return on capital employed will be 20%. They said that the return will be same even for the new project. Yes, sir. New project value 4 lakhs plus 7 lakh, 11 lakhs. 11 lakhs into 11 lakhs is the value of the new project. Illa sir, only 4 lakhs. Velil vaangiradhu. 7 lakh already there as reserves and surplus, means part of the old project or part of the new project? Part of the old project. That means new project require only capital of 4 lakhs. Right? So you tell me, Ingava, when you do the new project, come on, let me. When you do the new project, I can't do for old project company number 1. For new project company number 2. It's all are happening in one company only, one share only, one share market only. Clarity? So what is the total capital, existing capital employed? 14 lakh. To that capital employed only I can add the new capital of how much lakh? 4 lakh. So 18 lakh will be the total capital employed of the existing company. Yes, sir. Yes, sir. So into how much percent? 20%. So 3,60,000 will be the EBIT. Don't take the extra EBIT. Take the full EBIT. That is from the old project plus the new project. Right? Less interest on old debenture. Already you are having debenture. Yes, sir. How much value? 44 lakh. Into 10%? 40,000. Enough clarity. Less interest on the new debt. How much is the debt? 4 lakh. Into 12%? 48,000. Second case, there is no what at all? Debt at all. So earnings before tax, 2,72,000 and 3,20,000. Let's tax at the rate of 2,72,000 into 50. 1,36,000. 3,20,000 into 50. 1,60,000. What is the earnings available to equity shareholder? 1,36,000 and 1,60,000. Right? In option number 1, we have not raised equity at all. So the existing number of equity shares will be the new equity shares. Comes to 30,000. So 136 divided by 30. 4.53. 4. But in option number 2, we have raised the equity. Right, sir? So number of equity shares to be raised in plan number 2. What is the additional capital? 4 lakh. What is the existing market price? 40. How much number of equity share? Already you are having 30 plus 10 comes to, that's why denominator, sir, in second case 40,000. Comfortable. Which comes to EPS of 4 per share. Sir, is the price earning ratio given, not given? Given. So you know that price earning ratio is equal to EPS. Super. Sir, what is the existing? If you inject debt into the capital structure, PE will fall to 8. Is equal to MPS. I don't know. That's what they want in the question. Divided by EPS. I know. How much EPS? 4.53. Apo 4.53 into 8 comes to 36.24. Correct? But if you are injecting what into the capital structure? Equity into the capital structure, the price earning ratio will be same at 10. So 10 is equal to MPS divided by EPS. What is EPS? 4. 4 into 10, 40. What is the existing, sir, market price? 40. Same. Are you really with me? Yes, sir. That's it with regard to that question. So debt equity ratio, if we raise 4 lakh as debt, so total capital employed 18 lakh. Out of that 8 lakh will be debt. How 8 lakh? Already 4 lakh plus new debt 4 lakh. 4 lakhs plus 4 lakh comes to 44.44%. Right, sir? Is there any cutoff given in the question? Yes, sir. Yes, sir. If the debt is higher than 40%, then only PE will come down. Yes, sir. Now the debt in the capital structure is 44 point. As the debt equity ratio is more than 40%, PE ratio will be brought down to 8 in plan number 1. Comfortable. I hope that you also got the right answer. If you are stuck anywhere, why this has happened, this is explanation for that question. I'm coming to illustration number 2, the second question. Alpha Limited require fund amounting to how much lakh? 80 lakh for its what project? New project. So already existing company, man. For new project, 80 lakhs requirement. To raise the fund, company is following 2 alternatives. To issue equity shares of at par amounting to, and borrow balance amount at the rate of 12%. Up 80 lakhs, 60 lakhs pochna, 20 lakhs by way of debt. Or to issue equity shares at the rate of and 12% debenture in equal proportion. That means 40 lakhs equity. Income tax rate is, identify the point of indifference between the available 2 model of financing the state. Which option will be beneficial in different situation? Sir, same simple question, sir. Can we go through, sir? Amount, what is the loan? 80 lakhs. Plan number 1, equity 60 lakh, debt. Plan number 2, equity 40 lakhs, debt 40 lakhs. Plan number 1, interest payable, debt 20 lakh into 12% comes to 2 lakh 40,000. Plan number 2, debt 40 lakhs into comes to 4 lakh 80. We have to find out the point of indifference. That table we have to put. E minus interest, you know, correct? E minus 2 lakh 40, E minus 4 lakh 80. Sir, pay the tax at the rate of 30%. You will get the PAT, which is on the 0.7 E minus some X figure, whatever it may be, 1,44,000. 0.7 E minus 4,80,000 3,36,000. Yes, sir. Is there any preference dividend? No, sir. So this will be the residual earnings divided by number of equity shares. Case number 1, 60,000. Case number 2, 40,000. You will be getting some equation. Correct? Close it. Sir, you will get EBIT of 9,60,000. This is for both the plans. Now, what they want? What they have asked? Identify the point of indifference between the available 2 model of finance and state which option will be beneficial in different situation. So for that, we have to calculate the EBIT-EPS. Can we? EBIT same, different? Same. Hello, sir. Less interest at 12%. Padana calculate panna. 2 lakh 40 and 4 lakh 80. Same na? Nothing has been given, man. Wait. Sir, wait, sir. You got a EBIT of 9,60,000. That is the what point? Indifference point. At what point? Indifference point. Sir, both options are one and the same. So I am assuming that EBIT to be 9,50,000, which is less than indifference point. Sir, some assumed figure. Sir, can I take 9,40,000? Daralama. Anything less than 9,60,000. Hello, sir. Why? I am going to prove something. Wow. Sir, what is the EBIT? 7,10,000 and less tax at the rate of 30%. You will get a PAT. 4,97,000 and 3,29,000. Number of equity shares. Sir, we already find out 60 and EPS 8.28 and 8.23. So, what is the comment? This is very important. In situation A, when expected EBIT is less than EBIT at what point? Then plan 1 is more viable because it is having higher EPS. The advantage of EPS would be available from the use of equity capital and not from the debt capital. If the yesterday only I told, yes sir, if the actual EBIT is exactly equal to indifference point, you choose whatever plan you want. You put a toss, plan number 1 or plan number 2, whatever coming, you choose it. But if the actual EBIT is less than, choose equity option. But if the actual EBIT is more than, come on, example, EBIT is assumed to be 9,70,000. What is the specialty of that? More than? EPS அதிகமா வரும். Debt option la varum. Plan number 2, look at it, 8.58. If you want 970, less interest fixed, you will get the earnings before tax, you have to pay the tax, you will get the PAT, same equity share, you will be getting the EPS. Comment. In situation B, read it. When expected EBIT is more than the EBIT at the indifference, then plan 2 is more viable, hence it is have a higher EPS. The use of fixed cost source offer would be beneficial from EPS viewpoint. In this case, financial leverage would be favorable. The problem can also be worked out assuming any other figure of EBIT, Kandipa, which is more than 9,60,000 and any other figures less than 9,60,000. Alternatively, the answer may also be based on the factors or governing the capital structure like cost, risk, control, etc. principles. Hello, sir. Very easy question. Basically, this should be the first concept question of this. Because for what purpose we are using the EBIT is depicted by this question. Correct? I hope that you are able to appreciate. The last question from this. The financial advisor of Sun Limited is confronted with the following two alternative financing plan for raising 10 lakh that is needed for planned expansion and modernization. Total money required 10 lakh. I am having alternate number 1, alternate number 2. Okay, 1. Issue 80% of fund with 14% debentures. Face value 100. At par and redeemable at premium of 10% after how many year? 10 year. And balance by issue equity share as 33.1/3 premium. Be very clear with the terms. Okay, evlo lakhs theve? 10 lakhs. 14% debenture. 8 lakhs. Right? Face value of 100 at par. And redeem at premium of 10%. Oh. So when I redeem, I should pay 8,80,000. This is the redemption value. This is the net proceeds. Okay, and balance by issue equity share at 33.1/3 premium. Balance how much? 2 lakhs. 2 lakhs divided by 3. But 2,66,667 is the net proceeds. Redemption value 0 da. Because I will not redeem equity share ra. Sir, if I do like this na, 10,66,667 will get. I don't need that. I want only 10 lakh. Correct dane? Yes, sir. Wait. Alternate number 2. Raise 10% of the fund required by issuing 8% irredeemable debenture. 10% at par. And remaining by issuing equity shares at the current market price of 125. Currently firm has an EPS of 21. Okay. Modernization and expansion program is expected to increase the firm's earning before interest and tax by how much annually? Apo, firm's condensed balance sheet for the current year is given below. Balance sheet. Current asset 16 lakh. Plant and equipment 34 lakh. Total 50 lakh. Current liability 5 lakh. 10% long term loan 15 lakh. Reserves and surplus 10 lakh. Equity share capital 20 lakh. Total 50 lakh. Additional information. Mudikli no question. Okay, right. However, the finance advisor is concerned about the effect that issue of debt might have on the firm. Average debt ratio for the firm industry is how much percent? He believes if this ratio is exceeded, Kandipa, P ratio of the company will be 7 because of the potentially greater risk. Right? If the firm increases equity capital by more than 10%, he expects P ratio of the company will increase to irrespective of the debt ratio. Assume tax rate of 25%. Assume target payout ratio under each alternative to be 60% for the next year. And growth rate to be 10% for the purpose of calculating cost of equity, that is K. Suggest with reason which alternative is better on the basis of each of the below given criteria. EPS and the MPS. Financial leverage. Weighted average cost of capital and marginal cost of capital using book value weight. Sirappana, Taramana, Sambo. If the same question comes in examination, sir, ennadan nee solla vandirukke appdin puriyadhukku kaalam konjam aagum. This is a book back question which is there in the ICAI study material. Just answer to me the details. Calculator. Calculation of equity share capital and reserves and surplus. Alternate number 1. You tell me what is alternate number 1. Enna panna pora? 8 lakhs of debt. 2 lakhs of equity. Right? Okay, sir. Wow. Equity share capital. Already how much there? Respond pannunga ellarume. 20 lakh. How much you are going to issue? 2 lakhs. So total, this is at premium. How much premium? So this will be 133.333333. So the into 100 will be 1 lakh. Total man 21 lakh 50,000. FD sir, because this 20 lakh will be 20 lakh itself. It's debt cost, past. Only for this 2 lakh, don't issue 2 lakh. Because if you are issuing 1 lakh 50,000 equity itself, I will get 2 lakh. Calculator 1 lakh 50,000 into 133.33333333, I will get 1 lakh 99,999. That's why 2 lakh. Sorry, because if I issue equity of 2 lakh, I will get more than 2 lakh. And the extra cash வச்சு நான் என்ன பண்ணுவேன்? Correcta? Unnecessary KE will come. Hey, Purida. So, just issue 21 lakh 50. Reserves. Already I am having. Then. Premium. Reserve could add out. Sir. Security premium increase out. In the balance sheet, sir, because you are going to issue only 1,50,000 of equity. Hello, sir. Then reserves. 50,000. Purida. Yes, sir. So 10,50,000. Total. 30. Okay. Hold capital. 30 lakhs total. Extra. 2 lakh tallied. Because out of 10 lakh, 8 lakh is a debt, remaining 2 lakh is equity, but not entire 2 lakh. Accounts எல்லாம் டெஸ்ட் பண்ணிருக்காங்க, அவ்வளவுதான், வேற எதுவும் இல்ல. They are saying that book 1,50,000 rupees under the equity and balance 50,000 rupees under the reserves and surplus. Can I proceed? Alternate number 2. What is alternate number 2? 10% debt, 90% equity. Our 90% 9 lakh. But, sir, share capital will change, sir. Issue price will change, sir. Wow. Calculator 9 lakhs divided by 125 into 100 comes to 7,20,000. Hey, getting up 20 lakh plus 7 lakh 20. 27 lakh 20 will be the equity, but you will be issuing 9 lakh minus 7 lakh 20. 9 lakh minus 7 lakh 20 comes to 10 lakhs plus 1 lakh 80. 11 lakh 80,000. I hope concept clear. Keep a capital structure plans. Alternate number 1 and alternate number 2. Come on. Equity share capital. இப்பதான் finalize பண்ண 21 lakh 50,000. 27 lakh 20,000. Reserves and surplus. Finalize பண்ணிட்டேன். 10 lakh 50. 11 lakh 80. Matching. Yes, sir. Madam? Yes, sir. 10% debt. Already given. 15 lakh. 15 lakh. All is existing. Will not change. 14% debenture. New. Under option number 1. 8 lakh. அது premium கிடையாது. Only redemption premium. Sir, இங்க dash. Sir, 8% irredeemable debenture. 1 lakh. ஏன்னா 10 lakh into 10%. முடியல கீர்த்தன். Total capital employed. Tell me. 55 lakhs, 55 lakhs. Clear? Calculation of present EBIT. What is the EPS given? 21. Total number of shares available. Existing. 20,000 la? 20? Illa. What by what? 20 lakhs divided by 20,000. Calculator. What is the earnings available to equity shareholders? 20,000 into 21. 4 lakh 20,000. Reverse working da? EBIT minus interest. EBIT. All those stuff. So what is the tax rate? 25%. So this will be 75. Correct? 420 divided by 75%. 5 lakh 60,000. Ennappa? Yes, sir. Now I am the profit before tax. Liya? Yes, sir. I have to add interest. Existing interest. 15,000. 1,50,000. Existing EBIT. 7,10,000. Right, sir. They themselves given the addition in the EBIT as 2 lakh. So total EBIT 9,10,000 will be the new EBIT if I accept the project. Appada va. Evaluation of financial plan based on EPS, MPS, financial. Everything I am going to calculate. Appa. EBIT. Purincha. Already interest. Super. 1,50,000. 1,50,000. 1,50,000. 1,50,000. Sir, new debenture 14%. எவ்வளோ இஷ்யூ பண்ண? 8 lakhs. KD? 8 lakh into 14. 1,12,000 nil. என்னப்பா 88% irredeemable debenture value 1 lakh into comes to 8,000. Profit before tax you will get. Apply tax at the rate of 25%. You will get the PAT. Correct? Number of equity shares தெளிவு. Existing 20, equity 1,50,000 divided by market value 100. அப்படின்னா 1,500. 21,500. புரியுதா? எப்படின்னா existing 20, new 1,000, total comes to right. Next one, existing 20, new total increase 9 lakhs security premium irka 7,20,000 divided by 100 7,200 அப்ப 27,200. Comfortable? This is the EPS man. SR, which is nothing but PAT divided by number of equity shares. Sir, applicable PE ratio I have to calculate. Can I calculate that? Can I calculate the applicable PE ratio? Yes, sir. Fun பண்றாங்க boys இங்க. Right. Sir, debt 15 lakhs existing plus new total 23 lakhs. Then 15 lakhs plus 1 lakh 16 lakhs. புரியுதா? Total capital employed 55 lakhs already we worked out. இப்போ வா debt equity ratio calculator. Debt 23 lakhs divided by 55 lakhs into 100. 41.82% debt. Here 16 lakhs divided by 55 lakhs comes to 29.09% debt. என்னப்பா எவ்வளோக்கு மேல போனா பிரச்சனைப்பா? ரீட் பண்ணி சொல்லுங்க. அப்போ வா, what is the change in equity? 1,50,000. Super. Second case, change in equity. Brilliant. 7,20,000. Can I change the percentage change in equity? 1,50,000 divided by 20 lakhs into 100 comes to 7.5%. Next one, 7,20,000 divided by 20 lakhs into 100 comes to 36%. First case 10% மேல போல. அப்படின்னா what is the existing P ratio? 7 will follow. Yes sir. ரெண்டாவதுல போச்சு 8.5. Already given man. இப்போ மேல வா. Applicable P ratio. What? I am having EPS P ratio. Can I find out the market price? எவ்வளோ? Multiply பண்ணி சொல்லியா? 22.60 into 7. 158.2. 20.74 into 8.5. 170. 20.74 ஃபுல்லா வரலையா? நிறைய இருக்கா? அதாவது 5,64,000 divided by 27,200 ஃபுல்லா போடுங்க. ஃபிராக்ஷன் வருது. into 8.5. 176.25. கரெக்டா? Do you know the financial leverage formula? மறந்துட்டியா? தெரியும். என்ன ஃபார்முலா? EBIT divided by EBT. What is the EBIT? 9,10,000. EBT 6,48,000. So 9,10,000 divided by 6,48,000 comes to 1.40. அங்க 9,10,000 divided by 7,52,000 comes to 1.21. எல்லாமே எடுத்தாச்சா? I have to calculate the cost of equity. Hello? Can we calculate the KE? Because they want WACC. WACC calculation கேட்டிருக்காங்கல்ல? Come on. Full FM revision by this one question. Yes sir. Because leverage, cost of capital, capital structure theories, everything will come. Come on. Cost of equity. What is the EPS? Alternate number 1. 22.6. இங்க இருக்கு 20.74. ரைட்டா? சார், dividend payout ratio given EPS into how much percent? அப்படின்னா calculator 22.60 into 60%. 13.56 and here 12.44. Correct? Growth already straight away given in the question as. Sir, MPS 0 just now you find out. Under option number 1, 158.2, 176.29. Purida. Now this formula I should come. Sir, don't ask me from where this formula came. Sir, cost of capital K is equal to DPS 1 divided by MPS 0 plus G. Correct? What is the DPS 1? 13.56 is DPS 0. Correct? into 110 percentage comes to 14.916 divided by existing market price 158.2 percentage 9.43. Correct? Or doubt? K is equal to DPS 1 divided by MPS 0 plus G போட்டிருக்காங்களா? Yes sir. Go to question. What is the logic? Assume tax rate to be 25%. Assume target dividend payout ratio under each alternative to be 60% for the next year. And growth rate to be for the purpose of calculating cost of it. What? Next year also perpetual should be there, no growth. What is the logic? Why they have not put no notes, nothing? What is the dividend payout ratio? Abdina 40% they are holding. That means there should be growth. Perpetual growth should be there. But they have not considered growth. Sir, actually, do you know this formula? DPS 1 divided by MPS 0 plus G. Why this formula has not used? Why DPS 1 divided by MPS 0 has been used? Introduce பண்ண போறாங்க, right? %60% this year they gave dividend, 40% they are holding. What sir? Ama sir. Yes sir, correct sir. Either I have to choose alternate number 1 or alternate number 2. If I add the growth, let me ask you a question. Is the DPS is same or different? Then automatically G will also be different. That will affect my decision. Because this is not one and the same man. Yes sir. இதுக்கு மேல 10% போடுறதும் இதுக்கு மேல 10% போடுறதும் difference இருக்கு. Correct? So don't consider that growth. But I can't consider DPS 1 எடுக்காம இருக்க முடியாது. Because dividend will grow. I can't see the perpetual growth. When I will get perpetual growth? Only after I take the decision. I am going to take the decision. அப்ப decision எடுக்கும்போது when I consider, if I consider the growth, my decision may go wrong. So they said that DPS 1 divided by MPS 0. So 13.56 into 110% comes to 14.916 divided by 158.2 comes to 9.43% is the KE under option number 1. Option number 2, 12.44 into 110% divided by 176.29 into 100 comes to 7.76 will be the KE under option number 2. Mudile, I have to finalize debt. So many debt are there. 10% term debt, easy. 7.5%, which is nothing but I into 1 minus T. Second one also I into 1 minus T, because existing only, no. 14% redeemable debenture. I have to calculate. Yes, redemption. Redeemable debenture. KD is equal to I into 1 minus C, which is 14 into 1 minus C plus RV minus NP divided by N whole divided by RV plus NP divided by 2 into 100. What is RV? 110 minus NP life 10 years. Average liability. Hello sir. I will get 10.95. This option I don't want. 8% irredeemable debenture. Irredeemable. First option not there. Sir, 8 into 25% tax rate will be there. Up 8 equal to 25% remaining 6 man. A 1 minus T man, I into 1 minus T man. Now everything pakka. Now, sir, whether I can calculate the WACC? Yes, sir. This is under alternate number 1 and this is under alternate number 2. Alternate number 1, can we? Equity share capital, weight. We have to calculate weight. Everything, total. You have to say equity. The pathway. This one. This you take photo or something when I go down. 21,50,000 divided by 55 lakhs comes to 39.09. That's what they have written here as 39.09. Like that, you have to calculate weight for everything. Just now KE done. KR is equal to KE. Hello? Existing debt 7.5. New debt 10.95. Sir, calculate the WACC. You will get 9.12. Comfortable. Alternate number 2. Weight will change. But individual cost of capital will also change. New KE yes, sir. Automatically WACC will change. Right, sir? Automatically KO will also change. Correct? Sir, have they asked any decision? Suggest with reason which alternate is better. You have to write conclusion. Sir, as per EPS, market price, MPS. So you have to write EPS. What is the EPS for alternate number 1? 22.60. Correct, ama? Nambalama 22.60. Alternate number 2. 20 point. Conclusion. Alternate number 1. Based on EPS. Number 2. MPS. Wait. MPS 158.2. 176.29. A2. Alternate 2. Train bogi solra. Financial leverage. Yes. 1.4. 1.21. A1. Better having highest financial leverage. Right, sir? Next one. Back. 9.12. 7.66. K1 na. KO should be less. Hey, capital structure theories and two firms are alike in all aspects except capital structure. You will choose highest KO. No, sir. Every company should choose lowest KO. Thambi? Yes, sir. A1 or A2? A2. This summary table you should write. And which is having highest? Equal. Tell me, sir. 1.21. Highest, sir. Sir, combined leverage should be less, sir. Operating leverage should be less, sir. Financial leverage should be highest, sir. Because you are having EBIT more than indifference point, sir. Trading on equity work out, sir. Financial leverage, equity shareholders. Sir. Sir, debt kammiya irundha eppadi sir? Debt kammiya irundha nashtam dana sir. Tax benefit sir. EPS sir. Ella doubt ellarku varudhu. Because this is not a sir EBIT-EPS. This is FM question. Yes sir. Do only a student who knows financial management will be able to solve this. Sir, clear sir? Doubt clear sir? Yes sir. Inga vaanga sir. KO highest lowest sir. Lowest KO should be chosen. Right sir? This is the conclusion you should write, sir. Any doubt before I close this part? Madam? Clear, sir. Everything clear, sir. Okay, sir. Sir, you said it. But 1 second, sir. Sir, with this, all the 3 questions comes to an end. Right, sir. Check your answers. The first question is a RTP November 2022 question. Debu Limited currently has an equity share capital of 1 crore 30 lakh, consisting of 13 lakh equity shares. Company is going through a major expansion plan requiring to raise fund to the extent of 78 lakh. That means additional capital required is to finance the expansion. The management has the following plan. Plan 1, 2, 3, 4. Already EBIT, EPS analysis, we have taken care of such things. Correct? Issue 7,80,000 equity shares of 10 each. So 7,80,000 into 10, 78 lakh. Or issue 5 lakh equity shares of 10 each, that is 52 lakh. And balance through long-term borrowing at 12% interest per annum. So balance na 78 lakh minus 52, 26 lakh at the rate of 12%. Issue 3,90,000 equity shares of 10 each. So 39 lakhs plus 39 lakhs, that is, sir, 39 lakhs at the rate of 9% debt. 39 plus 39, 78 lakhs. Issue 3,90,000 equity shares of 10 each comes to 39 lakh and balance through 6% preference shares. Again 39 lakh at the rate of 6%. EBIT of the company is expected to be how much lakh? So because of the financing decision, will EBIT affected? No, sir. Considering corporate tax rate at the rate of 40%, you are required to calculate the EPS in each of the above plans. Easy. Ascertain financial leverage in each plan and comment is what the question is all about. Can we? Sir, first we will analyze what is the present equity. Whatever may be the plan, the present equity remains at how much lakh? 13 lakhs. Can I proceed? 1 crore. Number of equity shares? 13 lakhs. Because, sir, 1 crore 13 lakhs, they themselves given 13 lakh equity shares. Right, sir? Yes, sir. New issue, my dear lovable students. Sir, plan number 1, we decided to issue new issue. How much, man? 7,80,000. Right, sir? Plan number 2, 5,20,000. Plan number 3, 3,90,000 and 3,90,000. So, existing plus new issue will be the total equity share capital. So, already 1 crore 30 lakhs is there. Plus 78 lakh you are going to issue. So, 1 crore 30 lakhs plus 78 lakhs comes to 2 crore 8 lakhs will be the new equity. And a plan number 2, sir, 1 crore 30 lakhs is there. Plus 52 lakhs you are going to raise by way of equity na 1 crore 82 lakhs. If I go with plan number 3, sir, 1 crore 30 lakhs plus 39 lakhs of equity means 1 crore 69 lakhs. Sir, here 1 crore 30 lakhs plus 39 lakhs comes to 1 crore 69 lakhs. Are you comfortable up to this? Yes, sir. That means once I go with plan number 1, the total number of equity share with me will be 2 crore 8 lakhs divided by 10. What is the face value? So 20 lakh 80,000 equity shares will be there. Yes, sir. Adi inge add pannirkalam. Because 13 lakh plus 7 lakh 80,000 comes to, yes, sir. 13 lakhs plus 5 lakh 20,000 comes to 18 lakh 20. 13 lakhs plus 3 lakh 90 comes to 16 lakh 90. 13 lakhs plus 3 lakh 90, 16 lakh 90. Sir, if I am going with second plan alone, I am going to raise debt with 12% long-term debt to the extent of 26 lakhs. If I am going with third plan alone, I will be raising 9% debenture of 39 lakh. If I am going with fourth plan alone, I can raise the preference shares by 39 lakhs. Appreciate Pandrani. So I am going to calculate the EPS and the financial leverage. You tell me, if the plan change, will the EBIT change? So whatever may be the plan, EBIT 52 lakh, 52 lakh, 52 lakh, 52 lakh. Less interest at the rate of 12%. That will be only there for plan number 2. 26 lakh into 12% comes to 3 lakh 12,000 is the interest you are supposed to be paid. Less interest at the rate of 9%. That will be available only for plan number 3, which is 39 lakh into 9% comes to 3 lakh 51,000. You will be getting earnings before tax. Right, sir? From the EBT, pay tax at the rate of 40%. So, EAT at the rate of 60% will be there. Straight away put EAT. 52 lakhs into 60 comes to 31 lakh 20. 48 lakh 88,000 into 60% comes to 29 lakh 32,800. 48 lakh 49,000 into 60% comes to 29 lakh 9,400. And 52 lakhs into 60% comes to 31 lakh 20,000. Comfortable. Sir, if I am traveling through plan number 4, I am having preference dividend of 6%. So 39 lakhs into 6% comes to 2 lakh 34,000. Comfortable. So my earnings available for the equity shareholders will be 31 lakh 20. 29 lakh 32,800, 29 lakh 9,400, 31 lakh 20 minus 2 lakh 34 comes to 28 lakh 86,000. Enapa comfortable? Divided by number of equity shares already find out just now. Sir, 20 lakh 80, 18 lakh 20, 16 lakh 90, 16 lakh 90,000. Can I proceed? Sir, I can easily find out EPS, which is nothing but earnings available to the equity shareholders, which is residual divided by number of equity shares 1.5, 1.61, 1.72, 1.71. First requirement of the question comes to an end. Hello. Now I am going to calculate the financial leverage because of whom you will be having financial leverage, interest and preference dividend. In option number 1, I don't have what at all? Interest and preference dividend. So there is no what at all? Financial leverage. That means my EBIT will be equal to EBT. Then 1 rupees will be the financial leverage. That means if you are getting 1 as the financial leverage, there is no interest, there is no preference dividend. Hello. In second case, I am having interest, but I don't have preference dividend. So only orala mattu paatha podulya. Calculator, what is EBIT? 52 lakhs divided by 48 lakh 88,000 comes to 1.06 is the what leverage? Financial leverage. Who is there? Interest is there. Who is not there? But in situation number 3, same. Who is there? Who is not there? Interest is there. Preference dividend is not there. What is the EBIT in case number 3? 52 lakh. What is the EBT? 48 lakh 49,000. So 52 lakhs divided by 48 lakh 49,000 comes to 1.07. But in situation number 4, you are having both. Yaru irka. Interest is not there. Yes, sir. Only who is there? Preference dividend is there. But still we have to give effect to preference dividend. That's why logic I have discussed for this formula. What is the formula? EBIT divided by EBIT minus interest, 0 to go. Preference dividend divided by 1 minus 3. Comfortable. What is the EBIT of case number 4? 52 lakh. Divided by EBIT, 52 lakhs. Interest, 0. Divided by preference dividend, 2 lakh. 30. This will be 70%, right? Sorry, 40%, 60% after tax, correct? So 1 minus 0.4 comes to 0.6. So 3 lakh 90,000. 52 lakh minus 3 lakh 90. 48 lakh 10,000. 52 lakhs divided by 48 lakh 10,000 comes to 1.08 is the financial leverage if there is preference dividend. Are you all really with me? And they want comment also, but comment is missing. What comment? You should say that, sir, under 1.72 is the best option. This is the option where you are having highest EPS. Correct, sir? Whereas this is the option where you are having highest financial leverage. Highest financial leverage. Are you really with me? So it's better to go with option number 3, plan number 3, because under that plan you are having highest EPS. Are you able to appreciate? I'm moving into a beautiful question from question number N. It's a November 2021 past examination question. Don't think that like this and all question will not come. A student, what I'm expecting from you is, if you are just simply listening to the video and understand that if there is a chapter called as leverage, you will not understand anything. After the video, do this 3 question and try to solve ICAI illustrations and book back, especially book back. Then your preparation for the examination will be done. Information of A Limited is given below. Earnings after tax, which is PAT, 5% on sales. Sir, is question sales expressed, not expressed? So can I take X as sale? X into 5%, 0.05x. So the PAT will be point. Income tax rate will be degree of operating leverage. Operating leverage is equal to 4. What is operating leverage formula? Contribution divided by EBIT. 10% debenture in capital structure, 3 lakh. So 3 lakh into 10%, 30,000 will be the interest. Variable cost, how much lakhs required? 6 lakhs. So can I take here 0.05x? Income tax at the rate of 50%. So this will also be 0.5x. Correct? Sir, because 50-50 man. Yes, sir. So if inga 100 ரூபாய் இருந்தா 50 ரூபாய் tax கட்டி 50 ரூபாய் மிச்சம் இருக்கும். அப்ப this 50 is equal to this 50, right? Then my dear lovable students, 0.1x, 0.10x is the EBT. Interest expense already we calculated 30,000, right, sir? Then EBIT will be another 30,000 plus 0.1x or 0.1x plus 30,000. Technically correct. Correct. Is fixed cost given in the question? No. But they have given operating leverage as how much time? 4 times. Now I am having EBIT in my hand, right, sir? They said that variable cost is 6 lakhs. 6 lakh. And I know that sales I have taken as, so automatically contribution will be x minus 6 lakhs. Now I am having contribution. Now I am having EBIT. I can easily find out the fixed cost. Able to appreciate? Simple man. So operating leverage is equal to contribution divided by EBIT. 4 is equal to x minus how much lakhs? 6 lakhs divided by 0.1x, 0.1x plus 30,000. Can I put by 1? Yes, sir. Can I cross multiply? 4 into 0.1. 0.4x plus 30,000 into 4. 1,20,000 should be equal to x minus 6 lakh. Cross multiplication. Correct? So my dear lovable students, I'm bringing every x and all here. So x minus 0.4x is equal to 6 lakhs minus 1,20,000. Correct? This is like minus 1 6. Plus 1,20,000. Right, sir? Yes, sir. So my dear lovable students, 1x minus 0.4x, 0.6x is equal to 7,20,000. Comfortable? So x is equal to 7,20,000 divided by 0.6. 12 lakhs is the x. What is x? I can say the sales as 12 lakhs. Right? Okay, man. Again writing 12 lakh. Already given, sir, variable cost of 6 lakhs. From 12 lakh, 6 lakh gone. 6 lakh. Fixed cost. Sir, just now I can calculate. EBIT I have calculated. Illa. 0.1x, that is 12 lakhs into 0.1 comes to 1,20,000 plus 30,000 comes to 1,50,000. Enaba clarity? Appa 6 lakh minus 1,50,000, 4,50,000 is the fixed cost. Comfortable? Less interest will be same 30. So EBT 1,20,000. Sir, 60,000 will be the income tax. 60,000 will be the PAT. That's it, game over. What they want? Calculate financial leverage. Do you know what is financial leverage formula? Financial leverage is equal to EBIT divided by EBT. Hello, sir. What is EBIT? 1,50,000 divided by EBT. 1,20,000. Hello, sir. So 1,50,000 divided by 1,20,000 comes to 1.25 times is the financial leverage. What is the interpretation of this? If 1% change in EBIT will lead to 1.25% change in EPS. Can I come to combined leverage? Sir, combined leverage is equal to operating leverage into financial leverage, because operating leverage is given in the question. 4 into 1.25 comes to 5 times. What is the meaning? If there is a change in sales of 1% will lead to 5% change in EPS. You can apply formula also for combined leverage. Contribution divided by EBT. What is the contribution? 6 lakh. EBT 1,20,000. So 6 lakhs divided by 1,20,000 comes to 5 times. Same 5 I am getting here. Right, sir? Calculate the percentage change in EPS. If sales increase by 5%. The relationship between sales and EPS is what? Combined leverage. We are having combined leverages how much time? அப்போ 1% sales மாறினா 5 times யார் மாறுவா? அவங்க என்ன சொல்றாங்கன்னா 5% மாறினா அப்போ 5 into 5 is equal to 25% will be the new change in EPS. If there is 5% increase in sales, that means if sales increase by EPS will increase by 25% because the combined leverage is 5 times. Check the answer, man. Income statement of A Limited. Sir, they also got the answer. Component of X sales is 12 lakh. Have you got? Yes, sir. Sir, computation of leverage, operating leverage 4 times. Have you got operating leverage 4 times? Given in the question. They have just cross-checked. That means the figures computed whether it is cross-tallying with 4 times or not. Yes, sir. Financial leverage. Sir, have we got a 1.25 times? Yes, 1.25 times. Getting it. And combined leverage. Have we got as 5 times? Yes, sir. 5 times is the combined leverage. Clarity. That's it. What is the percentage change in EPS? Sir, 25%. FD, sir. Because 1% change in sales will lead to 5% change in EPS. Up 5% change in sales will lead to 5 into 5, 25% change in EPS. That's it. Hence, if sales increase by 5%, EPS will increase by 25%. Clarity. I'm moving to the last question from this area. Super fantastic to the core. This is a May 2022 past examination question. Details of company for the year ended 31st March are given below. Sales, how much lakh? 86 lakhs. This is the sale. Sir, profit volume ratio, that means contribution, 35%. Right, sir? Sir, fixed cost, excluding interest expenses, 10 lakh. 10% at 55 lakhs. So, 55 lakhs into 10%, 5 lakh 50,000 is the interest. 75 lakhs is the equity. Divided by 10 comes to 7 lakh 50,000 is the number of. Income tax rate is everything as basically given in the question. So basically sales minus variable cost contribution minus fixed cost EBIT. What is the sale? 86 lakh. What is the variable cost? Directly we will go to contribution. 25 lakh 80,000. 30 lakh 10,000. 30 lakh 10,000. Comfortable? Sir, fixed cost given in the question as 10 lakh. Upon 30 lakh 10,000 minus 10 lakh, 20 lakh 10,000 is the EBIT. Can I reduce interest? 5 lakh 50,000 as the interest. Getting it? So I will be getting EBT of 14 lakh 60,000. Correct, sir? Less tax at the rate of 40% comes to 5 lakh 84,000. Comfortable? Can I get the PAT? 8 lakh 76,000. Right, sir? Super, fantastic, sir. There is no preference dividend, all, nothing. Determine, sir, divided by number of equity shares. So PAT divided by number of equity shares comes to 7 lakh 50,000. Sir, 1.168 per share is the EPS. Can I proceed? Determine company's return on what employed? Capital employed. Pre-tax and EPS. We just calculated the EPS 1.168. So the EPS is 1.168. Now I have to calculate the return on capital employed. Do you know the formula return on capital employed? EBIT divided by capital employed. What is the EBIT? 20 lakh 10,000. Capital employed means debt plus equity. Correct? Yes, sir. Equity 75 lakh. Debt 55 lakh. 75 plus 55. So 1 crore 30 lakhs. We invested 1 crore 30 lakh. We received 20 lakh 10,000. Comes to 15.46%. This is the return on capital employed. Right. First part of the question done. Second part. Does the company has a favorable what leverage? Financial leverage. What is the financial leverage? We have to find out. So financial leverage is equal to EBIT divided by EBT. Correct? Yes, sir. What is the EBIT? 20 lakh 10,000 divided by EBT 14 lakh 60,000 comes to 1.38 times. What is the meaning of this? If 1% change in EBIT will lead to 1.38% change in EPS. Good only. This is called as favorable, right, sir? Sir, return on capital employed is 15.46 and KD is only, that means my business is generating 15.46% return, whereas the KD is only 10%. Hence, it is having a favorable financial leverage. Right, sir? Third part of the question. Does operating and combined Sir, calculate operating and combined leverage. Easy. Operating leverage contribution divided by EBIT, which is 30 lakh 10,000 divided by 20 lakh 10,000 comes to 1.497 approx. Can I? Combined leverage is equal to contribution divided by EBT. 30 lakh 10,000 divided by 14 lakh 60,000 comes to 2.06 times 06, 2.06 approx. Financial leverage is equal to already given, already calculated 1.377. Hello, sir. What's the next part of the question? Calculate percentage change in EBIT if sales increase by the relevant data is operating leverage. What is the current operating leverage we got? 1.497, meaning 1% sales மாறினா 1.497 EBIT மாறுமா? அப்ப 10% என்ன மாறினா? Sales மாறினா 14.97% will be the change in EBIT. Clarity? At what level of sales the EBT of the company will be equal to what? 0. They want EBT to be 0, correct? So this is the earnings before tax, what? 0. But still we have to pay 5,50,000. So we have to earn EBIT of 5,50,000. Fixed cost will be there 10 lakh. So 10 plus 5,50,000, 15,50,000. Sir, contribution percentage 35%. That means this 15,50,000 will be 35%, right? So 15,50,000 divided by 35% comes to 44,28,571. So if the company is having a sale of 44,29,000 approx, round off. Are you all really with me? That's what they have calculated, man. Sir, that's it with regard to this question. So you know, if you see where we are standing in the FM, sir, the first chapter you have to prepare for your exam is the cost of capital. You know, from this chapter, cost of capital, sure shot 7 mark question is expected. Sure shot 7 mark. Cost of capital. This is the first requirement for the exam. Don't take, sir, selective study. After the cost of capital, capital structure theories like NI approach, NOI approach, traditional approach, and Modigliani and Miller give more importance to Modigliani and Miller. Another, sir, sure shot 5 to 7 mark in examination. The third topic is the EBIT-EPS analysis. EBIT-EPS analysis. A sure shot 5 mark question from exam. The first compulsory you'll be having. These topics ensure that you are prepared. In these areas and all, I have done the revision now. The number 4, after EBIT-EPS, sir, in this Modigliani and Miller, sir, arbitrage process is a very important part. Arbitrage process, right, sir? Then after this, sir, EBIT-EPS, you can get an indifference point 5 mark question. Indifference point 5 mark question. These are the maximum you will get from the cost of capital. Sir, the 5th one is the leverage analysis. You will surely get, sir, leverage analysis 5 mark question. So this itself covering nearly, man, sir, your 50 to 60% of your exam. Look here, 7 plus 5, 12. 12 plus 5, 17 plus 5, 23 plus 5, 20. So nearly 25 to 30 marks, minimum to max, will be covering from this area. And if you are ready to prepare ratio analysis, dividend decision, sir, capital budgeting, and working capital management, that's it. You are 100% prepared with your FM. So my dear lovable students, in your preparation, do the question which I have chosen, plus try max ICAI illustration and book back. That's it. More than enough for examination. Concept should be very clear. Do the same question again and again. Rather than trying 100 new question, one question you do for 100 times, that will give you a sure shot success. I believe that. It was a wonderful and a fantastic revision of the leverage analysis. In the coming slot, we'll be talking about ratio analysis. Another 6 to 7 mark in your pocket, we will be getting it. We'll meet at the appropriate time. Thank you. Bye-bye from me. Sir, very, very, very happy evening to all. Sir, we have just now completed the revision of the ratio analysis. Now we are moving into the application of the questions. I'm going to do 3 questions. RTP May 2022 question. FM Limited. in a competitive market where every company offers credit. To maintain the competition, FM Limited sold all its goods on credit and simultaneously received the goods on credit. That means debtors is there, creditors is there. Company provides the following information relating to current financial year. Debtors velocity is 3 months. What do you mean by velocity? Debtors holding period. Collection period. Instead of saying holding period, the correct technical word is collection period. Yes, for you it is holding period, right? Collection period, 3 months. Creditors velocity means creditors payment period is 2 months. Stock turnover ratio 1.5 times based on cost of goods sold. Fixed asset turnover ratio on cost of goods sold is how much time? 4 times. GP 25%, abdina cost of goods sold is equal to 75%. Bills receivable 75,000, bills payable 30,000, GP 12 lakh, super. That means this is 25%. FM Limited have the tendency to maintaining extra stock of 30 at the end of the period than that at the beginning. That means closing stock is equal to opening stock plus 30,000. A simple, straightforward 6-mark question. Determine sales and cost of goods sold. Easily we can find out, right? Sir, we know that GP ratio is equal to 25%. That is equal to 12 lakhs. Upper sales is equal to 12 lakhs divided by 25% comes to 48 lakhs is the sales. Right, sir? Sir, cost of goods sold is equal to sales into 75%. So 48 lakh into 75% comes to 36 lakhs is the cost of goods sold. 48 lakhs minus 36 lakhs comes to 12 lakh. That is matching with the gross profit. That's it. So sales 48 lakh and cost of goods sold 36 lakhs. Sundry debtors is what they want. Debtors, sir, something relating to bills receivable they have given. Sir, debtors velocity is 3 months. So I'm having debtors velocity. By using the debtors velocity, I can find out the average accounts receivable. If I split the average accounts receivable between bills receivable, I can easily find out the debtors. Correct? So debtors velocity is equal to FD on the debtors collection period you will calculate. Formulas. Average accounts receivable divided by credit sales per day. Have they given any information regarding the cash sales? No, sir. Can I assume entire sales as everything is on credit? No, correct? So can I, sir, go with everything as credit? So debtors velocity how much month? 3 months is equal to average accounts receivable divided by what is the total credit sales? 48 lakhs. I have to take per day. Sir, have they said anything about number of days? No. So I have to assume, sir, in 12 months, 3 months, abdina, sir, divided by 12. So 48 lakhs divided by 12 because 3 months comes to 4 lakh is the, sir, credit sales per month. Per month. So average accounts receivable is equal to 4 lakhs into 3 comes to 12 lakhs. Sir, opening receivable plus closing receivable divided by 2 is equal to average accounts receivable is equal to 12 lakhs. Correct? So opening receivable plus closing receivable is equal to 24 lakhs. Correct? But is opening and all given in the question? No, sir. So this route will not work. Bills receivable plus debtors, only that is possible, is equal to 12 lakhs. Because straight away, I have to treat this as closing accounts receivable instead of average accounts receivable. Because information regarding the opening accounts receivable is missing in the question. Right? That's the exit route, man. Sir, wow. Sir, GP ratio done. What is the sales you got? 48 lakhs. Cost of goods sold? 36 lakhs. Can we determine the sundry debtor? We know that, sir, debtors turnover ratio is equal to 4 times. FD, sir, because debtors velocity is equal to 3 months. So 12 total divided by 3 months comes to 4 times is the debtors turnover ratio. Credit sales divided by average accounts receivable. What is the credit sale? 48 lakhs. So 4 is equal to 48 lakhs divided by average accounts receivable. We also got as 12 lakhs, right? So on the 12 lakhs, what is there? What is there? Bills receivable of 75,000 is there. Debtors of 11 lakh 25,000 is there, right, sir? That's what debtors. Can we determine the closing stock? Closing stock is the stock turnover ratio given in the question. Is the stock turnover ratio given in the question? 1 point. So 1.5 is equal to cost of goods sold divided by average stock. Yes, they have given opening stock relationship. Then I have to be very specific with that, right? So do you know cost of goods sold? Yes. So 1.5 is equal to 36 lakhs divided by average stock. Am I right? Abdina, sir, average stock is equal to 36 lakhs divided by 1.5 comes to 24 lakhs. This is the what stock? Average stock means opening stock plus closing stock divided by 2. I know that opening stock is X. Closing stock is X plus 30,000. Divided by 2 is equal to 24 lakhs. That means, sir, opening stock plus 30,000 is equal to 48 lakhs. Am I right? That means, my dear lovable students, 2 opening stock plus 32 opening stock is equal to, straight away I can take 48 lakhs minus 30,000 comes to 47 lakhs 70,000. So 47 lakh 70,000 divided by 2 comes to 23 lakh 85,000 is the opening stock. To this, if you add 30,000, you will get 24 lakh 15,000. Comfortable? Sir, can I work out the sundry creditor? They said that creditor's velocity is equal to 2 months. So with this, can I find out the creditor's turnover ratio? Creditor's turnover ratio is equal to 12 months divided by 2 comes to 6 times. Right. If I am having creditor's turnover ratio, can I find out the creditor's payment period? Creditor's payment period is equal to எவ்வளவு மந்த்ஸ்ல இருக்கு? Credit purchase divided by average accounts payable. Sir, do you know what is the credit purchases? We have to find, sir. Correct? Sir, I am having opening stock, I am having closing stock, and I am having cost of goods sold. I know that opening stock plus purchases subtotal minus closing stock is what? Cost of goods sold. I know what is the cost of goods sold. What is the cost of goods sold? 36 lakhs is the cost of goods sold. Right, sir? What is the opening stock? 23 lakh 85,000 is the opening stock. Opening stock plus 30,000 is what? Closing stock. So 23 lakh 85 plus 30. 24 lakh 15,000. Right, sir? If I add this 24 lakh 15 plus 36 lakh comes to 60 lakh 15,000. What is the difference? 60 lakh 15,000 minus 23 lakh 85,000. 36 lakh 30,000 is the purchases. This is what? 36 lakh 30,000. Comfortable? So credit purchase divided by average accounts payable. Here there is no average accounts payable. It is sundry creditors plus bills payable. Correct? Should be equal to 6. So 6 should be equal to 36 lakh 30. Sir, sundry creditors plus 30,000. Right? So sundry creditors is equal to 36 lakh 30,000 divided by 6 minus 30,000, which come to 6 lakh 5,000 minus 30,000 comes to 5 lakh 75,000. Getting it? How they have find out the purchases they have given in the question? We also find out 36 lakh 30,000. Can I proceed? Now I am calculating the fixed asset. Sir, for finding out the fixed asset, which ratio is important? Cost of goods sold divided by fixed asset. In bracket, they specifically said that based on cost of goods sold. Do you know cost of goods sold? Yes, sir. 36 lakhs divided by fixed asset. It should be equal to 4 times. Right? So fixed asset should be 36 lakhs divided by 4 comes to 9 lakhs is the amount of fixed asset. Right, sir? So revise the track. Tell me, எப்படி sales கண்டுபிடிச்சோம் நம்ம? Sales and cost of goods sold. From where? Don't see the answer. Gross profit given in the question. Gross profit was 12 lakhs, which comes to 25%. So 12 lakhs divided by 25 into 100, I got the sales. Sir, if the GP is 25%, cost of goods sold is, so sales into 75% will be the cost of goods sold. Right, sir? For debtor, to find out the debtor, what is the grip? Debtor's velocity. Debtor's velocity is equal to 3 months. We converted the debtor's velocity into debtor's stock turnover ratio. That means 12 months divided by 3 comes to 4 times is the debtor's turnover ratio. So debtor's turnover ratio is equal to credit sales divided by average accounts receivable. But here there is no average accounts receivable. Replace average accounts receivable with closing debtors plus bills receivable. Right, sir? If we put the figures, we will get the closing debtors. Closing stock. Sir, closing stock, sir, is based upon inventory turnover ratio. So, sales and cost of goods sold, we find out based upon GP. Sundry debtors is based upon debtors velocity. Closing stock, we find out based on stock turnover ratio. They said that stock turnover ratio is based upon COGS. Upper stock turnover ratio is equal to COGS divided by average stock of finished goods. Right? Then we will get the average stock of finished goods. Average stock of finished goods is equal to opening stock of finished goods plus closing stock of finished goods. They said that closing stock is 30,000 more than the opening stock. Up X plus 30,000 will be the total stock divided by 2 into average stock. You can knock it off. Comfortable? Sundry creditors is based upon creditors velocity. Sir, we have to convert the creditors velocity into creditors turnover ratio. Then creditors turnover ratio is equal to credit purchases divided by average accounts payable. Instead of average accounts payable, put the bills payable plus the closing creditors. Fixed asset is based upon the fixed asset turnover ratio. Generally, it will be sales divided by fixed asset, but question specifically said that take based upon cost of goods sold. So cost of goods sold divided by fixed asset. You already know the cost of goods sold. So automatically fixed asset will be the balancing figure. A very manageable 6-mark question for examination from the ratio analysis. Only required is practice. Are you really with me? I'm moving into question number 1. This is a RTP May 21 question. Question number N. Given below are the estimate for the next year by Niti Limited. Fixed asset 5.2 crores. Current liability 4.68 crore. Current asset 7.8 crore. Sales 23 lakh and EBIT 2.3 lakhs. 2.3 crores. Sorry, everything is in crores. Company will issue equity fund of 5 crore in the next year. It is also considering the debt alternative of 3.3 crores for financing the asset. So, next year addition in equity 5 crore, addition in debt 3.32 crores. Okay? Debt alternative. Okay. Company wants to adopt one of the policy given below, which is financing policy, either conservative or moderate or aggressive. Short-term debt at 12%, 1.08, 2 or 3. Long-term debt 2.24, 1.32, 0.32. Total, in every case, it is 3.32, it is matching. 3.32 is matching. That means basically, out of the total debt, they want short-term debt and long-term debt. Assuming corporate tax rate at 30%, calculate the following for each of the financing policy: a return on total asset, a return on owner's equity, net working capital, current ratio. Good question. Also advise which financing policy should be adopted if the company want high returns. So I'm going to solve it. Can we calculate the return on total asset? We know that return on total asset is of 2 ways. One is, sir, pre-tax and post-tax. Question: tax given? Yes, sir. What is the tax rate? If tax is there, post-tax. Tax is there, post-tax. So what is the formula? Sir, EBIT into 1 minus T divided by average total asset. But average total asset, opening has not been given in the question. What is the EBIT in the question? 2 crore 30 lakhs. Already given as 2 crore 30 lakhs. Right? Divided by average what asset? Total asset. Basically total asset, which is current asset plus fixed asset, which is 5.2 plus 7.8 comes to 13 crores. So 2.3 into 0.7 divided by 13 crores into 100 comes to 12.38 percentage is the return on total asset. That's it, 12.38. If you want, you can show before tax also. There you can take the EBIT divided by total asset. Are you really with me? Since tax is there, there is no sense to find out pre-tax. It's always better the return to express in post-tax. If you want, you can, no problem. A return on owner's equity. Sir, it's based upon what you are going to pump. Very important question. Conservative, moderate and aggressive. Right, sir? Expected EBIT, whatever may be the plan you are choosing, your EBIT will not change. Sir, 2 crore 30 lakhs, 2 crore 30 lakhs, 2 crore 30 lakhs. Right, sir? Less interest. First plan is conservative plan. Have a short-term debt of 12%. That means 12%. Short-term 1.08 into 12% comes to 12,96,000 is the interest. Comfortable? But under the moderate, sir, option, sir, you just keep this 1.08, 2 and 3. I'm writing here. Otherwise, that much time I have to go up. 1.08, 2 and 3. There, 2.4, 2.4, 2.24, 1.32, 0.32. Sir, this debt is at 12%. This at long term, 16%. So easy, man. Now I can easily calculate. Calculator. 1.08 into 12 already we done. Next one. Sir, 2.24 into 16% into, sir, crores. 24 lakhs. Are you getting it? Yes, sir. Sir, then aggressive. Sir, in aggressive, what is the composition? 3 crores. So 3 into 12%. 36 lakhs. Are you able to appreciate? Sir, next one. Long-term debt at what? 16%. 2.24 into 16% comes to 35 lakh 84,000. Next one. 1.32 into 16% comes to 21 lakh 12,000. Next one. 0.32 into 16% comes to 5 lakh 12,000. If I add both, I will get the total interest. Am I right? From the EBIT, if I reduce the total interest, I will get the earnings before tax. Earnings before tax. From that, pay the tax at the rate of 30%. I will get the PAT at the rate of, this is my PAT at the rate of 70%. Right, sir? Whatever may be the option you are choosing, the owner's equity will not change. Owner's equity will be 5 crores. Pakka. So it will be 5 crore, 5 crore, 5 crore. So calculator, 1 crore 26 lakh 84,000 divided by 5 crores into 100 comes to 25.37%. Right, sir? Then next one, 1 crore 29 lakh 41,600 divided by 5 crores into 100 comes to 25.88 or 89%. 1 crore 32 lakh 21,600 divided by 5 crores into 100 comes to 26.44%. You tell me under which option the return on owner's equity is highest. Third option, aggressive option, because it is 26.44%. Right, sir? So that's also done. Return on owner's equity under 3 option. Can we work out the net working capital? Net working capital means current asset minus current liabilities. Sir, already they have given. Just we have to rearrange the question. Sir, current liability excluding short-term debt. What is given? 4.68. Already given, man. Then sir, mala question. Sorry, sir. Sorry, sir. Sir, current liability 4.68. So whatever may be the option, current liability will be 4.68, 4.68. But based upon option, my short-term debt will change. Correct? It is 1.08, 2 and 3. Right? I will get the total current liability as 5.76, 6.68, 7.68. Current asset already given in the whatever may be the plan, my current asset will not change. I will get working capital 2.04, 1.12, 0.12. Sir, which option need less working capital? Aggressive option. So, return on equity also higher in aggressive option. Working capital requirement also less in aggressive option. Comfortable? Then they want what ratio? Current ratio. Current asset divided by what is the current ratio under conservative option? Every option it is what? 7.8, 7.8, 7.8. Right? Under conservative option, current liability is 4.68 plus 1.08. Come to 5 point, comes to 1.35. Right, sir? Under moderate, my dear lovable students, 6.68. Under aggressive, my dear lovable students, 7.68. Comfortable? So it is advisable to adopt aggressive what policy? Financial policy. If the policy want high return, as the return on honest equity is maximum in this policy of 26.44%. I believe a good question you understood. You know, when we will really understand the question, when we do by ourselves. Hello, sir? Then only we will know what are the issues that question is having. I can only guide you. You have to do by yourself. If you are only listening to this lecture, you will know that there is a chapter called as ratio. If you are, after this lecture, if you are trying this 3 question, then you know that this is the way in which we have to solve the ratio analysis. I'm moving into a very good RTP November 2022 question, the last question from the ratio analysis. Following information of ASD Limited relating to year ended 31st March 2022 is given. Net profit 8% of sales. 8% of sales. Sales figure given, not given. Okay. So that is the crux. Raw material consumed 20% of the cost of goods sold. Direct wages 10% of the cost of goods sold. Stock of raw material 3 months usage. Stock of finished goods 6% of the cost of goods sold. GP 15% of sales. Debt collection period 2 months. All sales are on credit. Current ratio 2:1. Fixed asset to current asset 13:1. Fixed asset to sales 1:3. Long term loan to current liability 2:1. Capital to reserves and surplus 1:4. You are required to prepare profit and loss statement of ASD Limited for the year ended 31st March in the following format. My dear lovable students, sales, sir, this information has been given. Nothing. The checkpoint is the fixed asset. 1 crore. Whatever ratio, fixed asset name is there. Direct ratios are there. You convert. Sir, from the fixed asset, we can find out the current asset directly. From the fixed asset, we can find out the, once we got the sale, net profit ready, sir, from the sales, if you reduce the GP, sir, we will get the cost of goods sold. Once cost of goods sold ready, raw material consumed ready, direct wages ready, then what? Finished goods ready. Are you really with me? Every other thing can be knocked off. Right up. That's it. That's it. Can we work? So first, I'm going to work out the sales. Tell me, fixed asset, what is the ratio given? Fixed asset divided by sales is equal to 1/3. 1/3. I know fixed asset, which is 1 crore 30 lakhs. I don't know sales, which is 1/3. So sales is equal to 3 crore 90 lakhs. Comfortable? Sir, can I say current asset? Yes, sir. Sir, fixed asset divided by current asset is equal to 13 divided by 11. 13 divided by 11. So 1 crore 30 lakhs divided by current asset is equal to 13 divided by 11. That means current asset is equal to 13, 1 crore 30 lakhs divided by 13 comes to 10 lakh. This divided by 13, 10 lakh into 11, 1 crore 10 lakh. Now can I find out the raw material consumption of direct wages? Yes, sir. Sales is 3 crore 90 lakhs. On that 15% is GP. Comes to 58 lakh 90,000. Abdina sales minus GP is only cost of goods sold, which is 3 crore 31 lakh 50,000. Comfortable? Idoda 20% is the raw material consumption. That's what 66 lakh 30,000. In the cost of goods sold order, 10% on direct wages, which is 33 lakh 15,000. Comfortable? Sir, whatever raw material I am going to consume, adoda 3 months usage is the raw material stock. Same like our working capital. So 66 lakh 30,000 into 3/12 comes to 16 lakh 57,500. Getting it? My dear lovable students, calculation of stock of what goods? Finished goods. They said that cost of goods sold order 6%. 3 crore 31 lakh 50,000 is the cost of goods sold. Ade into 6% comes to 19 lakh 81,000. Can I calculate the current liability with ratio? They have given that current asset divided by current liability is equal to 2/1. But now I know what is the current asset. So 1 crore 10 lakh divided by current liability is equal to 2 by 1. But 2 current liability is equal to 1 crore 10 lakh. So current liability is equal to 55 lakhs. Comfortable? Can I calculate for debtor? Sir, debtors divided by credit sales into 12 months. Because what has been given in the question? Debtors collection period. Debtors collection period எப்படி calculate பண்ணுவேன்? Average credit sales divided by average accounts receivable. Correct? That means average accounts receivable divided by credit sales per day. That means average credit sales per day. Average credit sales per day or per month or per week or whatever maybe. This has been given in month. Abdina, sir, debtors divided by credit sales divided by 12. So cross 12 become up mela vandu chiliya. So debtors divided by 3 crore 90 lakhs into 12 comes to 2 times. Sir, I will solve this rather than going with the answer. Simple, sir. Debtors divided by credit sales per month. Correct? Do you know credit sales? Yes, sir. How much? 3 crore 90 lakhs. 3 crore 90 lakhs divided by 12. 32 lakh 50,000. Do you know debtor? No, sir. But do you know debtor's collection period? How much month? 2 months. This is what they have written here. That means debtors is equal to 32 lakh 50,000 into 2 comes to 65 lakhs. That's it. Can I calculate the long-term loan? Yes, sir. Is there any ratio relating to long-term loan given? Yes, sir. 2:1. Long-term to current liability. I know current liability now. Because from the current asset, I got the current liability. So long-term loan divided by current liability is equal to 2:1. Right? So long-term loan divided by 55 lakh is equal to 2 by 1. So long-term loan is equal to 55 lakhs into 2 comes to 1 crore 10 lakhs. Can you find out the cash balance? You tell me, current asset 1 crore 10 lakh less debtor 65 lakhs because current asset comprise of debtor, raw material stock, finished goods stock. Correct? Abdina automatically the difference will be cash. Because my current asset comprise of cash, raw material stock, WIP stock, finished goods stock, debtors, cash. Can I calculate the net worth? Tell me what is the fixed asset given? 1 crore 30 lakhs. I just now calculated the current asset. Rendu add panna balance sheet assets total 2 crore 40 lakhs minus long-term loan and current liability. Because these are liability item. I will get the net worth of 75 lakhs. Sir, now 75 lakh net worth is in the ratio of 1:4. Appa 1 ruba capital, 4 ruba reserves and surplus. Correct? Total 5 ruba. Appa 75 lakhs divided by 5 into 1. 15 lakhs is the share capital value. 75 lakhs divided by 5 into 4. 60 lakhs is the reserves and surplus. Comfortable? Now every data is with me. Sales 3 crore 90 lakhs, you know. Direct material consumed. On what you calculated direct material? Cost of goods sold. Direct wages. Cost of goods sold. Sir, you know GP because already given in the question given. So automatically this will be the production overhead, factory overhead, works overhead, whatever may be the overhead. Pakka? This GP should be brought forward. By GP brought down 58 lakh 50,000. Right, sir? Already NP given in the. So GP minus NP should be selling and distribution overhead. 27 lakh 30,000 like a balancing figure. Comfortable? Balance sheet, everything has been given. They fixer asset, they themselves given in the question. If they have not given that, we can't solve the question. Correct? Yes, sir. Current asset, stock of raw material. How much months holding period? Whatever it may be. 2 months. They have given 3 months. How we calculated that holding period? Raw material consumed into 3 by 12. Pakka? Stock of finished goods. Based on what we find out the stock of finished goods? Cost of goods sold order 6% is the stock of finished goods. Debtors. On what basis debtors we find out? Debtors collection period based on that. Cash was a balancing figure. From the total current asset, we reduced everything, we got the cash. Total balance sheet total, here also balance sheet total. Current liability from the current ratio we find out. Long-term loan ratio expression was been given in the question. Total we got as 75 lakh. The ratio or the relationship between these two are 1:2. So we got 15 plus 60 come to 75 lakh. That's it with regard to 3 ratio question. My explanation over. Your explanation not over. What you are supposed to do, you have to try this 3 question, my dear lovable students. Then you will get a flow in the ratio analysis. If you come back, we will be completing the coming chapter called as dividend decision. Dividend decision, capital budgeting and working capital management are the pending part from our side. It's not about how much time you are hearing. It's about how much time you are solving. After you solve, if you are having any doubt, if you check, you will know that how this has gone through, my dear lovable students. So study very well. We will meet with the dividend decision. Till that, thank you and bye-bye from me. Sir, very happy evening to all. So we are doing the revision of financial management. In that, my dear lovable students, these are the topics we have completed. Number 1 is the cost of capital. If you see this topic, cost of capital, standalone, we will get a 6 to 7 mark question. Basically, you will be getting a computation of WACC question, that is KO. Then after the cost of capital, capital structure theories like NI approach, NOI approach, traditional approach and MM approach, that is Modigliani Miller approach. In that, generally everyone will give weight to the MM approach, but there is a huge chance that you may get even traditional approach also. Are you agree with me? Whenever they are asking a question from traditional approach, just keep in mind that under traditional approach only optimum capital structure will be there. So that capital structure may be a 5 mark question for examination. Then arbitrage process. It's a very beautiful concept in FM itself, but it's not regularly asking area. But when they ask how to find out the arbitrage gain will be a question. So not a regular area, but still very important area. Once it's asked, once in a while they will be asking, but we can't say that when they will ask. That's a problem. Coming to the 4th topic, my dear lovable students, after the arbitrage process, we are having the EBIT and EPS analysis. This is a expected question for examination for 5 mark. If you see every question paper, this question, EBIT, EPS analysis is a regular area, my dear lovable students. Once we pass EBIT, EPS analysis, then the next point is the indifference point. Indifference point. This is also not that much regular area, but in 3 attempts they are asking once, or sir, one attempt left they are asking. So this topic has to be prepared. I will never say that leave this topic, indifference point. Then coming to the next one called as dividend decision ku munnadi, ratio analysis, leverage analysis and ratio analysis, a very important 2 analysis, mandatory area for examination, 10 to 12 mark, maybe 5 mark or 6 or 6 like that putting, don't put. So if you see the entire FM, we are left with 3 topics. One is dividend decision, number 2 is the capital budgeting, number 3 is the working capital management. In that we are going to knock dividend decision, then we will be pending with the capital budgeting and working capital management decision. What is this dividend decision is all about? I will tell you, man. There was a big fight going on. What the fight was, if 2 firms are alike in all aspects, sir, except capital structure, will the value of the firm change or not is the question. That's what capital structure theories. In that NI, NOI, traditional MM, everyone said that if 2 firms are alike in all aspects, except capital structure, no, the value of the firm will not change. Or some people said that yes, the value of the firm will change. Either of the answer they said. My dear lovable students, sir, with regard to the dividend decision, the same discussion we are going to make. If 2 firms are alike in all aspects except dividend policy, dividend decision, will the value of the firm change or not is the question. That means one firm is giving dividend, another firm is not giving dividend. Remaining everything is one and the same. A limited, B limited. Capital employed 50 lakh, 50 lakh. Risk, sir, same. EBIT, same. Only thing, one firm is declaring dividend, another firm is not declaring dividend. Because of declaring dividend, will the value of the firm change or not is the question. Some people are saying that yes. If two firms are alike in all aspects except dividend decision, value of the firm will change, because how they are proving is value of the firm is equal to number of equity shares into market price per share. Number of equity share into market price per share. They are saying that we are going to value the value of the firm based upon the liability side of the balance sheet. For example, we know that, sir, if you add the entire asset, you will get the total asset. From the total asset, my dear lovable students, if you reduce the liability, sir, assets minus liability, you will get the capital employed. Right, sir? If two firms are having same capital employed, then value of the firm will not change. But if the capital employed changes, value of the firm changes. Generally, we will go for this valuation, that is asset minus liability valuation, in case of merger, in case of acquisition, in case of amalgamation, like that circumstances. But in case of FM, we will never go through with the asset valuation. Majority cases, we will go with the liability valuation. That's why even under the capital structure approach also, value of the firm is equal to value of equity plus value of debt. Value of equity plus value of debt. So we always prefer, sir, liability side valuation than the asset side valuation. The logic is very simple. It's very tough to find out the fair market value for each and every asset. For example, you are going to value, sir, Saravana Bhavan. Have you heard about Hotel Saravana Bhavan? Yes, sir. Like this one cup and saucer they'll be having. Sir, in one cup and saucer they'll be having 25 spoons. Like that, 3000 set of 25 spoons will be there. 3000 set. Will you value each and every spoon? Is it possible? No, sir. So it's always very headache to value the asset side of the balance sheet in reality. And it's very easy to value the liability side of the balance sheet, because just we have to know number of shares. Anyway, that will be available in the balance sheet. It's a book value only. And we will never, sir, respect the book value. We will go for the market value valuation. So our subject itself is market value. So what one ideologists are saying that, yes, if two firms are alike in all aspects except capital structure, except dividend decision, yes, the value of the firm will change. The first person come up with such a thought is the Walter. Walter said that. He only started everything. Sir, generally someone should start and MM should close. That's what the MM's job. Here also it's like that only. NI has to start. Yes, NI started. Net income started. Then NOI criticized NI. Then traditional approach criticized both NI and NOI. Then MM came and closed all the three. Are you really with me? Technically, sir, MM is an extension of NOI. That story you know, because NOI operationally failed. Whereas MM were able to explain how it is exactly offset. For that, he given formula. He come up with the, sir, ideology. Are you really with me? This is what happened, my dear lovable students. So the same way, sir, now I am going to start with the Walter. Walter is saying that what I have to find out to you, number of shares into market price per share. So I am going to find out the P0, because we need two data. One is total number of share and other is the market price per share. Anyway, everyone knows the total number of shares. It is available in the books of accounts itself. So we have to calculate the market price. That is what the discussion. Right, sir? The relationship between dividend and share price based on Walter formula is shown below. Generally, Walter has asked a basic question to the, sir, everyone. For example, if there is a MAD in the market, you are going to buy that MAD, what you will pay? What you will pay is based upon what the MAD will give you. If the MAD will give more milk, you will pay more price. If one MAD gives, sir, less milk, it will give only Sani. That means you will give less price. Are you really with me? So what the MAD, sir, gives is what? The value of the MAD. Are you really with me? Are you really with me? So my dear lovable students, market price per share, Sir, today a shareholder will pay. Today a shareholder will pay, sir, based upon the future value of the, sir, present value of its future cash flows. Present value of its what? Present value of its future cash flows. Are you really with me? What I am going to get in future? What I am going to get in future? How much liters of milk I am going to get from get in future? Adode today's present value. Adode today's present value is the price which I am ready to pay today. Correct? For example, you are going to purchase a, sir, residential house property in Nungambakam. Someone is saying that 5 crore. Sir, will you simply invest 5 crore? No. Sir, a financial manager, financial management person should think that what I will get from that money because I am investing today. So, value of any asset today is the present value of its future cash flow. So, Walter is saying that according to a shareholder, he will be expecting dividend in future. He will be expecting dividend in future. Right, sir? Yes, sir. Plus, sir, every shareholder of the company will not be expecting dividend. One more element he will be expecting. Walter is explaining that the second expectation for a shareholder, for example, if the EPS of the company is 10 and if the DPS of that particular company is 6, that means out of 10 rupees, 6 rupees has been declared as dividend. The remaining 4 rupees company itself is holding, retaining. Now, the Walter is asking one question that, sir, if the company distributed 10 rupees as dividend, that 10 rupees would have been invested in, that 10 rupees would have been invested by the shareholder in some investment and would have got the return. But out of 10 rupees, hello sir, the company declared dividend of only 6 rupees and company holded. Then in the next year, my dear lovable students, my expectation is I want dividend on my original investment because I already invested the current market price, right sir? If I invest today current market price, at the end of the first year, I want DPS 1 plus that only I am not sufficient. I want one more return. The one more return is nothing but, sir, this 4 rupees has been reinvested by myself in the company. That means I want return on investment on investment. Investment on. So, what Walter is saying that 10 rupees is the EPS and, sir, 6 rupees is the dividend. So, E minus D comes to the retention, my dear lovable students. E minus D is the retention. So, earnings minus dividend. This is the money available with the company. Right, sir? My dear lovable students, this money will be invested by the company in their project. That project will earn IRR. That project will generate IRR. That means this money will give you a return at the rate of R. Are you really with me? So listen to me, man. So what Walter is saying that Walter classifying the return into 2 categories. Every year, the Walter is saying that you are entitled to get DPS 1. You are entitled to get DPS 1. Plus, sir, the shareholder will be expecting E minus D. What is E? EPS. What is D? DPS. The balance is the money available with the company. This will be invested by the company in a, sir, project. And that project will give you a return called as R. That is a rate of return. That is a, sir, will this happen? Will all the story happen for 1 year or perpetual? Perpetual. You tell me if the cash flow is a perpetual cash flow. If the cash flow is a perpetual cash flow, the present value of the perpetual cash flow is equal to cash flow divided by R. Cash flow divided by, this will be the cash flow. What is the cash flow? E minus D into R is the cash flow. Right up. This I am going to get at the end of year number 1. End of year number 1. Sir, what is the value of asset today? Present value of the future cash flow. So from year number 1, Y1, I have to bring to Y0. For that, I will be doing divided by K. For that, I will be doing divided by K. Are you all with me? Sir, will this story happen? This DPS 1 and R into E minus T divided by K will be happen only for Y1 or Y2, Y3, Y4 for infinite period. Infinite period. Whole divided by K. That means the present value of a perpetual cash flow is equal to cash flow divided by R. Are you all with me? Sir, if I write like this, my dear lovable students, can I say that, sir, Walter is equal to D by KE plus? Is this KE applicable like this? Yes, sir. D by KE plus. Sir, R by KE into E minus D whole divided by K. Right, sir? What Walter is saying that you are going to get, sir, DPS 1. You are going to get DPS 1. You discount that DPS 1 today. That's why D by K. You are going to get R into E minus D. Hello, sir. Sir, that you have to bring today from Y1, you have to bring today to Y0. That's why divided by K. Correct? Sir, this cash flow is for perpetual. Are you agree with me? Sir, the present value of a perpetual cash flow is equal to cash flow divided by R. That's what? Divided by K. So this is cut short and Walter come up with a formula that D plus R by K into E minus D whole divided by K. Can you proceed, sir? D plus R by K into E minus D whole divided by K. What is P? Market price of the share. What is E? Earnings per share. What is D? Dividend per share. What is KE? Cost of equity or rate of capitalization or discount rate. What is R? IRR. The above formula is given by Professor James E. Walter, which shows how dividend can be used to maximize the wealth of the equity shareholder. He argues that in the long run, share price reflect only the present value of the expected dividend. Sir, if a share is not at all giving dividend, no one will be ready to pay price for that particular share. If a share is giving higher dividend, the shareholder will be ready to invest higher price. This is the ideology of the Walter. Yes, sir. Retention influence stock price only through their effect on the what dividend, future dividend. So this is what the conclusion given by the Walter. What Walter said that Walter's approach consider only two factors. Walter is saying that I will consider only R and K. R is the rate of return earned by the company. KE is the expectation of the shareholders. Are you with me? For example, if KE is equal to 16% and R is equal to 20%, what Walter is saying that, sir, company is able to generate more return than the expectation of the equity shareholder. Yes, sir. Such a company don't give what at all? Dividend at all. That means if the R is greater than what? KE. R is greater than KE, then the optimum dividend policy should be 0%. Don't give what at all? Dividend at all. Only at that point of time, the company share price will be maximum. If that is the case, number of shares into market price per share, you will get a higher value. That's what our discussion is all about, right, sir? If the R is equal to KE, man, it is indifference point. Every payout ratio is optimum payout. Whether you give the dividend, whether you don't give the dividend, that does not matter at all. If the R is less than KE, that means R means return earned by the company is less than what? KE, my dear lovable students, 100% better to pay the dividend. Don't keep the company by the what? Company. Don't keep the dividend by the company. Have 100% payout ratio. This is what the story given by the Walter. So Walter is saying that, my dear lovable students, the price, market price of today, that is P0 is equal to D plus R by KE into E minus D whole divided by K. That is, a equity shareholder will be expecting two things. Number one, D, dividend. Number two, retained earnings. That is, sir, return on retained earnings. Return on. So company will, sir, earn EPS. They will give DPS. So E minus D is the retained earnings. Company will invest R provided if the R is higher than K. R is higher than K. If the R is equal to K, sir, it is indifference. You give the dividend, don't give the dividend. And if the R is less than K, numerator will become less. If numerator less, it's a degrowth. If the numerator R is greater than K means, sir, it's better to hold 100% and sir, invest in the new project. Are you agree with me? Yes, sir. This is what the story of the Walter. So, we'll be seeing what Walter is thinking through his formula. Can I solve? Question? One question? Okay, man. Second question, one part is there, we will solve. Following information is taken from ABC Limited because I want to apply that into numbers, that's why. Net profit of the year, how much lakh? 30 lakhs. Company earned a profit of 30 lakhs. Okay, sir. 12% preference share capital, 1 crore. So 1 crore into 12% comes to 12 lakhs. So 12 lakhs is the preference dividend. Equity share capital, 60 lakhs. Let it be there. IRR, R is equal to how much percent? 22%. That means if company hold the money, company can generate a return of 22%. But KE, the expectation of the shareholder is only, that means if I give dividend to the equity shareholder, they will invest somewhere and they will get a return of only 18%. What is higher? R is higher or K is higher? According to the Walter's model, 0% should be the DPOR and 100% should be the retention. Right, sir? But this guy is holding, sir, only 75%. That means this guy is against Walter. This guy is against the principle of the Walter. That means company right? Calculate the market price of the share using the Gordon's model. I'll come to it at the appropriate time. And Walter's model. It's a Jan 21 question. My dear lovable students, be with me. What is the net profit, my dear? Net profit is equal to 30 lakh. Generally, net profit means PAT. Profit after tax. So, PAT is equal to 30 lakhs. From that PAT, I have to pay the preference dividend. What is the preference share capital? 1 crore. What is the PD? 12%. That means from the 30 lakhs, I am supposed to pay 12 lakhs as a preference dividend. Are you all traveling along with me? So, from 30 lakhs, if 12 lakhs goes means 18 lakhs is the retained earnings. So, company is having 18 lakhs. Divided by number of equity shares, my dear lovable students. 6 lakhs. 6 lakhs is the number of equity shares. So, 8 lakhs divided by 6 lakhs comes to 3 per share. That means EPS, earnings per share is 3. Company earned 3 rupees as the EPS. Right, sir? Less DPS, dividend payout ratio at the rate of 25% because retention is equal to 75% means dividend payout ratio is equal to 25%. Can I proceed? So 3 into 25% comes to 0.75 per share. That means company declared 0.75 per share. So 3 minus 0.75 comes to 2.25 per share is what the company retained. This is what the retained earnings of the company. Am I right? According to Walter, what is R? What is the rate of return? 22%. This is the IRR of the company. But what is the KE? 18%. Right, sir? According to Walter, sir, the dividend payout ratio in such a situation should be 0%. Company should not give what at all? Dividend at all. Clarity? Sir, I am going as per the original share price of the Walter. This is unnecessary in the question. According to me, what 0 is equal to? P0 is equal to D plus R by KE into E minus D whole divided by K. This will be the market price of the share. What is the dividend? 0.75 because 25%. Right? Plus what is R? 0.22. What is KE? 0.18. Is the numerator higher or denominator higher? Numerator higher. What Walter is saying that if numerator is higher, don't pay dividend at all. What is the E? 3 minus what is D? 0.75. Right? whole divided by what is KE? 0.18. My dear lovable students, sir, calculator, sir, 0.22 divided by 0.18. 1.22 into 2.25, right? 2.75. So 2.75 plus 0.75 comes to 3.5 divided by 0.18 comes to 19.44 per share will be the current market price. Current market price. If you followed Walter 100%. But this company has not followed Walter. This company actually worked against Walter. If they worked against Walter, then the share price will be less. Yes, sir. Then the share price will be less. My dear lovable students, now the real answer for the question. P0 is equal to D plus R by KE into E minus D whole divided by KE. What is D? 0.75 dividend. Following Walter na 0. Correct? Yes, sir. Sir, 100% Walter I am going to do. So they won't give what at all? Dividend at all. So P0 is equal to 0 plus. What is the R? 0.22. Divided by KE? 0.18. Can you proceed? What is E? 3 minus dividend 0. Whole divided by 0.22 or 18? 18. 0.18. Can you proceed, sir? So P0 is equal to 0 plus, calculator man, 0.22 divided by 0.18 into 3 comes to 3.66 divided by 0.18, right? Comes to 20.37. So what Walter is saying that this is a firm. Correct? Yes, sir. If this company has not given what at all? Dividend at all, and assume they are having 10,000 equity share for assumption purpose. So 10,000 into 20.27 will be the value of the firm. Comes to 2,03,703 is the value of the firm. Whereas if the same firm, my dear lovable students, 10,000 into 19.44 comes to 1,94,400. 1,94,400. Getting it? Sir, for our exam answer, this is not at all required. I just prove you that according to Walter, if you give dividend, one share price will come. If you don't give dividend, another share price will come. That is why I am saying that Walter is a theory of relevance. That's why Walter is saying that my theory is a theory of relevance. So what is the answer as per the Walter's model? Sir, Walter's model 19.44. Our first answer 19.44. Right, sir? That's it. The theory of Walter. So what Walter is saying that, sir, simple. Shareholder will pay price of a share today. Price of any asset today is based upon the present value of the future cash flows. From a shareholder will get D as the future cash flows. Right, sir? Plus R divided by K into E minus D whole divided by K. This is what the formulas are given by Walter. What now Gordon is saying that, how Walter, what you are saying is correct. What you are saying is correct. The present value of any asset today is the, sir, present value of his future cash flow. Correct? But how the dividend every year will be same? Sir, 2, 2, 2, 2, 2. It will never be every year 2, 2, 2, 2, 2. There should be some growth in dividend. There should be some growth in dividend. According to Walter, sir, DPS 1 is equal to DPS 0. Everything is same. DPS 5 is equal to DPS 0 because you won't have what at all? Growth at all. But Gordon is asking to Walter that how that will work. So your formula is baseless. Conclusion is same, whereas formula is baseless. Tell me, conclusion is same, whereas formula is baseless. What Gordon is saying that following formula is used by Gordon to find out the price per share. which is MPS 0. MPS 0 means current market price should be equal to EPS 1. EPS 1 means the company earns at the end of the year 1. Correct? Into 1 minus B. 1 minus B. B stands for retention. B stands for retention ratio. So 1 minus B means, sir, dividend payout ratio. Sir, if you multiply EPS 1 into dividend payout ratio, you will get basically DPS 1. DPS 1. According to Walter, there is no classification of DPS 1 or DPS 0 and all. That's why we just said that D plus. There you should never use the word DPS 1, because according to Walter, every year you will be having same dividend. But Gordon is saying that how that is possible. So it should not be same. It should not be same. It should be different, including growth. So what Gordon is saying that, come on, at the end of year number 1, my dear lovable students, you will be earning EPS 1. On that EPS 1, you will be declaring dividend. That means out of the EPS, you will keep something with the company. That is called as B. That is called as retention. So from 100%, if you are retaining 60%, 40% is the dividend payout ratio. Up EPS 1 into dividend payout ratio will give you DPS 1. So what, sir, Gordon is saying that every shareholder will be expecting DPS 1. Every shareholder will be expecting. And, sir, this DPS 1 is a future cash flow, which is, sir, at Y1. I have to bring that to the Y0. So I have to discount. I have to discount using a discounting factor called as R. According to Gordon, that R is equal to KE minus BR. What Gordon is saying that this is the expectation of the equity shareholders. This is the expectation of the equity shareholders. Minus B into R stands for G. Growth. Basically, what Gordon is saying that we already discussed that KE is equal to. When I write KE is equal to, I am going back to the cost of capital chapter. KE is equal to DPS 1 divided by MPS 0 plus G. Are you remembering? This plus G I am bringing here, which is nothing but KE minus G. Can I say like that? Is equal to DPS 1 divided by MPS 0. Can I say? My dear lovable students, KE minus G is equal to EPS 1 into 1 minus B. That will also give me DPS 1 divided by MPS 0. If I calculate this KE, the chapter is cost of capital. If I calculate MPS 0, the chapter is dividend decision. That's it. Game over. So what, sir? MPS 0 is equal to EPS 1 into 1 minus B whole divided by KE minus G. Ennappa comfortable? Are you able to appreciate? Are you really with me? This is what the formula propagated by Gordon. So Gordon, MPS 0 price per share, today's price is equal to, it's based upon how much earnings the company is making. Not only earnings, sir, retention, that is 1 minus B, that is dividend what ratio? Payout ratio. K is the what of equity? Cost of equity. R means the IRR, internal rate of return, and BR is equal to growth rate. So G is equal to what into R? B means the amount of retention made by the company. R means at what rate that amount is going to be invested by the company. That's called as B into R. So according to Gordon's model, where IRR is greater than the what of capital. That means if the R is greater than KE, price per share increases and dividend payout ratio decreases. Same conclusion of the Walter. I will tell you, conclusion of Gordon is equal to conclusion of Walter. Whereas the approach of Gordon is not equal to approach of the Walter. What? Sir, Walter is saying that share price today P0 is equal to D plus R by KE into E minus D whole divided by KE. You will get one share price as per Walter. But the same share price you will never get as per Gordon. Because the valuation method as per the Walter and the valuation method as per the Gordon are not one and the same. But the conclusion, the basic principles of the dividend decisions are one and the same. Even Walter also saying that compare R and KE. Even Gordon also saying that compare RN. On the other hand, when IRR is lower than the WACC of capital, price per share decreases and dividend payout ratio increases. So my dear lovable students, this is the conclusion of Gordon. Sir, if the company is a growth company, that means if the R is greater than KE, don't give what at all? Dividend at all. If the company is a constant company, R is equal to KE, every payout ratio is a optimum payout ratio. If the company is a decline company, that means if the R is less than KE, declare dividend at the rate of 100%. Right, sir? Now, a relationship between dividend and share price on the basis of Gordon formula is shown as follows. Sir, according to Gordon, sir, MPS 0, what is MPS 0? Current market price is equal to DPS 0 into 1 plus G. What is DPS 0 into 1 plus G? DPS 1 whole divided by KE minus G. Both are one and the same. Both are one and the. Whereas MPS 0, current market price, correct, sir? DPS 0, current dividend, G, growth rate, KE, cost of equity. So what? The formula given by Gordon shows that when the R is greater than KE, price per share increases as the dividend ratio decreases and vice versa. So what Gordon is saying that compare R with KE. Compare. If the R is greater than KE, please don't give what at all. Then what will happen, you know, MPS 0 will increases. But you when start declaring what? Dividend, then automatically MPS 0 will reduces. Clarity. Are you able to appreciate? The same question will be solving using the what model, man? Gordon's model. The same question, question number 2. Yes, come on. So what Gordon is saying that, sir, we have to value the price as per Gordon. So MPS 0 is equal to EPS 1 into 1 minus B divided by KE minus G. So what is EPS 1? 3. Just now we find out 3 into 1 minus retention ratio. Retention ratio B is 0.75. Right up. 0.75. According to the Gordon, you are not supposed to give what at all? Dividend at all. You are not supposed to give dividend at all. Right? But still you have given 25% dividend. Right, sir? Whole divided by what is KE? 0.18. What is the growth? We have to calculate the growth. Correct? B into R. What is B? 0.75. What is R? 0.22. So calculator. 0.75 into, sir, 0.22 comes to 0.165. So minus 0.165. That means, my dear lovable students, 3 into 0.25. 0.75 divided by 0.18 minus 0.165 comes to 0.0. Sir, 0.75 divided by 0.015 comes to 50. 50 rupees is the current market price as per Gordon's valuation. Right, sir? Yes, sir. Sir, look at here, man. Sir. Here, sir. 50 rupees is the answer. What is, how you will calculate, man? Market price per share by using what model? Gordon's model. What is the formula? EPS 1 into 1 minus B whole divided by KE minus G or BR, whatever it may be. Are you agree with me? The same formula can be calculated by DPS 1 into 1 plus G whole divided by KE minus G. Are you agree with me? Yes, sir. The figures has been given. Where, what is MPS? Price per share? 50, yeah. This is 50. What is EPS 1? We have to calculate. EPS 0 is equal to 3 in the question. So EPS 1 is equal to 3 into growth rate. Correct? What is the growth rate, man? B into R. Correct? 0.165. So 1.165. Am I right, sir? So 3 into 1.165 comes to 3.495. So this is 3.495. What is the retention ratio? 75%. K already given in the question as, sir, IRR R 22%. G growth rate 16.5. Just, sir, 0.165 is equal to 16.5%. And DPS 0, 0.75. Because 3 into B, minus 1 minus B, 0.75. Right, sir? Now, computation of market price as per what model? Gordon's model. MPS 0 is equal to DPS 0. What is DPS 0? 0.75 into 1 plus G. Okay, man. Our 0.75 divided by 0.75 into 1.165 is equal to 0.87375. Correct, sir? Whole divided by 0.18 minus 0.165, which comes to 0.15. What is the share price? 58.25. Sir, inga enna kadichichu? 15 kadichichu. That is whose model? Gordon's model. Then why 58.25? Sir, is two answers are given based upon two assumption. Yes, sir. What is assumption number 1? EPS 1 as 3. Assumption number 2, EPS 0 as 3. So if your assumption changes, answer changes. Right, sir? Because question, if you look at the question, they set net profit, 12% preference shares, equity share, IRR, cost of capital, retention ratio. The following information is taken already there. Correct? So we can consider it as past. This is one interpretation. Or you can say that taken means I have gone to the company and asked what will be your future. So question is not clear whether that is EPS 0 or EPS 1. So if you treat 3 rupees as EPS 1, then 50 rupees will be the share price. Right, sir? If you treat 3 rupees as EPS 0, then the next year EPS will be more than 3. Correct? Sir, if the EPS increases, automatically share price increases. That's why 58.25. Right, sir? Sir, any assumption you can take. Sir, can I write only one answer? Yes, that's fine. No problem at all. But for this question, 2 alternate answers has been given. That's it. With regard to the first 2 approaches, number 1, Walter's model and the Gordon's model. Both are theory of relevance. Both people's conclusions are one and the same. Right, sir? Whereas both people way of proving are different. What Walter is saying that P0 is equal to D plus R by KE into E minus D whole divided by KE. Comfortable? Whereas what Gordon is saying that, sir, P0 is equal to EPS 1 into 1 minus B whole divided by KE minus G. Now the hero coming called as Modigliani and Miller. What Modigliani and Miller is saying that if 2 firms are alike in all aspects except capital structure, how the value of the firm will change? Hello, sir. Is simply asking, Modigliani and Miller is simply asking, there are 2 firms, for example, A Limited and B Limited, or simple, rather simple. Sir, there are 2 sons called as Mr. A and Mr. B. Mr. A is earning 1 lakh. Mr. B is also earning 1 lakh. In home, Mr. A is giving 20,000, whereas Mr. B is only giving 10,000. Will the value of Mr. A and Mr. B to his mother will change? Will be one and the same? Will be one and the same. Munnadi ellam. Ippo appadidana? Well and good. So my dear lovable students, hello sir, MM is asking that if 2 firms are alike in all aspects except dividend decisions, how the value of the firm will change? It's absolutely blunder. He is saying that MM hypothesis is primarily based on arbitrage argument. Already we discussed primary arbitrage and through the arbitrage process, hypothesis discussed how the value of the firm remains same, whether the firm pays what or not. What is saying that MPS 0, that is current market price of a share is equal to DPS 1. Nyayam. The same only have been said by the Gordon. Correct? What is saying that in addition to that, every shareholder will be expecting capital gain. That's what MPS 1. For example, if today a shareholder invests in a share for 100, my dear lovable students, he will be expecting 150 at the end of year number 1. So his expectation will not only be the dividend, but also the capital gain. Right up. For that only, sir, that is the future cash flow. That is a future cash flows. So if that is the future cash flow, my dear lovable students, that has to be bring to present value by using a discounting factor called as K. So first, comment said that, sir, Walter, you valued P0 as D plus R by KE into E minus D all divided by K. This valuation method I don't want. Hello, sir. You valued based on an assumption that this is what meant dividend, that is shareholder will be expecting dividend, and he want return on what earning? Retained earnings. This is how a shareholder will be looking a share according to you. But the P0 as per Walter is, Gordon is EPS 1 into 1 minus B divided by KE minus G. What said that according to the Gordon, a shareholder will value the share based upon what is the DPS 1. Because EPS 1 into 1 minus B is nothing but EPS 1. First point number 1, said that my P0 is not only DPS 1 but also MPS 1. But also MPS 1. So this DPS 1 is a future value. MPS 1 is a future value. Because this dividend you will get at the end of year 1, Y1. And MPS 1, a shareholder will get at the end of year number 1, Y1. My dear lovable students, DPS 1 plus MPS 1, this has to be discounted to today. That's why divided by K. Correct? So that I am discounting divided by 1 plus K. Hello, sir. Sir, MPS 0 means price in the beginning of the period. MPS 1 means price at the end of the period. DPS 1 means dividend at the end of the period. And K is the cost of equity. Sir, as per hypothesis, value of the firm will remain unchanged due to what decision? Dividend decision. This is a formula given by What said that value of the firm is equal to. What is the value of the firm? Value of the firm is nothing but present value of its future cash flows. Present value of its. What is its future cash flow? Number of shares into market price per share. So what is the existing number of shares? Evlo shares if already company kitta irukku. Plus delta n. That means is linking dividend decisions with the investment decisions. What is saying that, okay if the R is greater than KE, you are saying that company should hold 100%. With that 100%, will the company do pujaya? No. Company have to invest somewhere. So in order to do that investment, company need fund. Additional fund. So how they will raise the additional fund? They will raise the additional fund by issuing further shares. That's what delta N. That's what? Delta N. Additional number of shares. So at the total already existing companies having some share plus delta N means total number of shares. From this line only I started this chapter. Total number of shares into market value per share is the value of the firm. Right, sir? Minus investments. Because according to there should be very good what opportunity? Investment opportunity. If a company invests means money will come in or money will go out. Money will go out. That's what capital budgeting, investment decision. Right, sir? And during that year, company will earn something. That means, my dear lovable students, that earnings is a cash inflow or cash outflow? Cash inflow. So what MM is saying that, romba simple, sir, what is the existing number of shares? That what? N. Plus what N? Delta N. Delta N means additional number of shares you have issued to do the project. Yes, sir. That's what N plus delta N. That means I got the total number of shares. What is the value of the firm? Value of the firm is equal to total number of shares into market price per share. That market price is MPS 1. Market price is MPS 1. Hello, sir? Yes, sir. Sir, minus I, because if the firm invests means money will go out, plus E. Sir, during the entire year, company will earn. So the total cash flow at the end of the year number 1 in the hands of the company will be N plus delta N into MPS 1 minus I. This has to be discounted to today's value. That's what the N of the firm, value of the firm. That means what MM mathematically done na, instead of finding P0 like Walter, instead of find out P0 by Gordon, he directly calculated value of the firm. What is value of the firm? Number of shares into market price per share. This is the basic formula of MM. What MM is saying that you should have a very good investment decision. Right? Yes, sir. My dear lovable students, N means number of shares today existing. At the end of year number 1, you will be having a very good investment decision. You don't have money to do that. Correct? You have to raise the capital by issuing additional number of shares. That's what delta N. So N plus delta N. You will get a total number of shares. Actually, into market price per share itself will get the value of the firm. But that much capital will not be there with the company. Because you would have invested something. So I would have gone out. Yes, sir. Yes, sir. And you would have earned something during the year. E would have come in. Hello, sir. Divided by 1 plus KE will be the value of the firm. Are you with me? So with this, we will be solving question number A. Rambo Limited has 1 lakh equity share outstanding for 2022. The current market price of the share is how much? 100. So, Ippo 1 lakh into 100 is equal to 1 crore. That means the present value of the firm is 1 crore. What MM is saying that whether you give dividend, you don't give the dividend, it will be how much crore itself. Company is planning to pay dividend at the rate of how much per share? 10 per share. Let them pay dividend. Required the rate of return is how much percent? 15%. That means KE is equal to, R is equal to 15% because the rate of return. Based on MM, calculate the market price of the share of the company when the recommended dividend is number 1 declared, number 2 not declared. So two circumstances are there. Number 1 declared, dividend declared, not declared. What is MM's ideology? Whether a company declares dividend, whether a company not declaring dividend, value of the firm will be one and the same. How many new shares are to be issued by a company at the end of year on the assumption that net income of the company is how much lakh? And the investment budget is 50 lakh when the dividend is declared or dividend is not declared. Proof that market value of the company at the end of accounting year will remain the same whether the dividend are distributed or not. This is a most expected question for any examination. Simple. Always step number 1. Even ICAI itself traveling through the step. Okay. Sir, simple sir. Calculate the price at the end of the period. Price at the end of the period means we know the formula, my dear lovable students. MPS 0 is equal to DPS 1 plus MPS 1 whole divided by 1 plus K. You know current market price. What is the current market price? 100. 100 should be equal to what is DPS 1? 10. Because if they are going to give the dividend, if they are going to pay the dividend, 10 plus MPS 1 we don't know plus 1 divided by what is the KE? What is the KE given in the question? Is the KE given in the question? Required rate of return is 15%. Adan KE. Because as per MM, there is no comparison of what and what? R and KE and all. Required rate of return means the equity shareholder is expecting 15%. So 0.15. Hello, sir. Can I cross multiply, sir? 100 into 1, 100 plus 100 into, sir, 115 should be equal to 100 plus 10 plus MPS 1. 15, 150 above. 1 verum 15. Yes, sir. 0.15. Yes, sir. So 100 plus 15, 115 should be equal to 10 plus MPS 1. Right, sir? That means MPS 1 is equal to 115 minus 10 should be equal to 105. That means what MM is saying that if the company gives the dividend, correct? First they are doing dividend not paid, but we have done dividend are paid. Sir, can I move to the dividend are paid? If the company gives the dividend, today's market price will be 105. Correct? This is step number 1. Step number 2, what is the fund required? Logically answer. What is the total earnings? 40 lakhs. Are the company declaring dividend? Yes, sir. They are declaring dividend. How much is the dividend per share? 10. Already how much shares are there? So 1 lakh into 10, 10 lakh. So out of 40 lakh, 10 lakhs goes means balance 30 lakhs will be available with the company. What is the very good opportunity of investment opportunity available? Out of 50 lakhs, only 30 lakhs are there. Balance 20 lakh, company have to raise by way of new shares. Will the company raise the new shares today or at the end of the year? End of the year. That means they will be declaring not at MPS 0 but at MPS 1. What is MPS 1? 105. Up 20 lakh divided by 105 means company have to raise 19,047.62 share. This is the delta share, correct? So what MM is saying that, my dear lovable students, at the start of the year, company were having how much share? 1 lakh share. Sir, at the end of the year, company will be issuing 19,047.62 share. That's what N plus delta N. At the end of the year, will you value the company with 100 or 105? So this into 105 will be the total value of the firm without considering investment. Correct? In that you will be investing totally 50 lakh. So 50 lakh will go out and you will be earning totally 30 lakhs. 30 lakhs is the earnings, 40 lakhs done. 40 lakhs is the earnings inflow. So what MM is saying, that calculator man, 20 lakhs divided by 105. Update calculator vechko. Plus already equity share of 1 lakh. This will be the total number of shares, right? Into 105 comes to, this will be the total value of the firm, which comes to 1 crore 25 lakhs. Plus you have earned an earnings of 40 lakh minus you will make an investment of 50 lakhs. That means the wealth available with the company at the end of the year will be 1 crore 15 lakhs. Right? This is at the end of the year number 1. Why 1? I want MPS 0. So divided by 1 plus K. So divided by 1.15 comes to 1 crore is the what of the firm, value of the firm. That means already before starting all this drama, the value of the company was 1 crore. Sir, now situation number 1, company declared dividend. Then also the value of the firm is 1 crore. Now the MM is going to prove that illapa, company is not declaring the, if the company is not declaring the dividend, my dear lovable students, hello sir, the value of the firm will be higher. Sorry, share price will be higher. Share price will be, whereas value of the firm will be same. Look at here. Sir, what 0? MPS 0 is equal to DPS 1 plus MPS 1 whole divided by 1 plus K. Correct? You tell me, sir, what is MPS 0? Is equal to 3 ma? Yes, sir, 100. Because I am going to calculate the MPS 1. What is DPS 1? 0. I am not going to give the dividend. What is MPS 1? We have to calculate. So MPS 1 divided by 1 plus K. 0.15. That means, sir, 1 into 100. 100 plus 100 into 15. 15. Sir, 1 into 0, 0 plus MPS 1. That means 100 plus 15. 115 is equal to MPS 1. Are you all really with me? Yes, sir. Simple. One line summary of the entire discussion. This situation is dividend paid or dividend not paid? Not paid. Not paid now 115. Paid now 105. What is the gap? What is the DPS? அவ்வளோதான். டிவிடெண்ட் பே பண்ணலைன்னா இதுக்குள்ள அந்த 10 ரூபா சேர்ந்துருக்கும். டிவிடெண்ட் பே பண்ணியாச்சுன்னா 10 ரூபா இருக்காது. ஓ அப்படியா? அப்படிதான். Simple. Hello, sir. So, my dear lovable students, what MM is saying that 115 will be the share price, which is nothing but 105 plus 10 comes to 115. Step number 2, what is the fund required? I need only less one because I have not given what at all. I have earned 40 lakh, not given dividend at all. That means in my hand 40 lakhs will be there. I am having an investment opportunity of 50 lakhs. 40 lakhs minus 50 lakhs comes to 10 lakh. 10 lakhs is the fund required. So I will be raising this 10 lakh at the year end by issuing one share 115. So I will be getting delta N 8,695.65 shares. Already company were having 1 lakh shares. That means 1 lakh 8,695 into what is the market price at the end? 115. This will be the total wealth of the company at the end of the year number 1. Correct? Plus company earned an earnings of 40 lakhs minus company made an investment of 50 lakhs. So this will be my value of the firm at the end of Y1. I want the value today divided by 1 plus K comes to 1 divided by 1.15 comes to 1 crore. Easy, man. Appo inga paru present already we calculated how much crore? 1 crore. Sir, dividend not declared 1 crore. Dividend declared 1 crore. In any MM question in exam, just read one line. Rambo Limited has how much equity share? 1 lakh equity share. Outstanding, correct? Current market price is 100. 1 lakh into 100. That's it. All the answer should be 1 crore. That's a shortcut, man. You do this much time, answer should be 1 crore. 3 models we have done. Walter model, Gordon's model, MM approach. That's it. Question number 1 and 2 done. Shall we move into the last question, my dear lovable students? Following information are given for a company. What is the EPS? Company earn 10 rupees. What is the PE ratio? 12.5. You know, price earning ratio is equal to price divided by earnings. Price divided by earnings, which is 12.5. Correct? Price earning ratio is 12.5. Correct? Rate of return on investment are 12%. Market price per share as per Walter given 130. Yes, sir. So 130 is equal to D plus R by KE into E minus D whole divided by K. Let me ask you, 1 divided by price earning ratio is equal to KE. There is one formula, have we discussed? Yes, sir. Because EPS divided by MPS 0 is equal to KE. Tiripi pota? Yes, sir. So 1 divided by 12.5 comes to 8% is what the KE. KE actually given by way of price earning ratio. So I am having KE as 8%. I am having R as 12%. My dear lovable students. Hello, sir. You are required to calculate dividend what ratio? Payout ratio. So I have to calculate dividend payout ratio. Market price of the share at the optimum dividend payout ratio. Then I have to compare R and KE. Correct? What is the PE ratio at which the dividend policy will have no effect on the what of the company? And market price of the share at this price earning ratio. Market price using the dividend what model. One by one, I will come, you man. Sir, first I will calculate the, sir, Gordon, sir, Walter, P0 is equal to DPS 1 plus R by KE into E minus D whole divided by K. Current market price given or not given? Given, sir. Question 130. D don't know. Sir, R they themselves given as 12 and KE is equal to 8%. So E we know 10 minus D. D means dividend. We don't know. Divided by how much percent? 8%. Just now we calculated K is equal to 8%. Correct? Apingava, sir, can we cross multiply? Yeah. 130 into 8%. 10.4 should be equal to D plus, idarandi knock off panla, 12 divided by 8. 1.5 into 10 minus D appdi vechko. D plus 10, 1.5 into 10 minus D, right? That means 10.4 is equal to D plus 10 into 1.5, 15. Sir, 1.5 into D na minus 1.5 D. Are you able to appreciate? I am bringing this plus 15 to here. Sir, minus 15 plus 10.4 should be equal to D minus 1.5 D. Am I right? So if I knock off this, minus 4.6 should be equal to 0.5 D minus 0.5 D. Basically minus minus sign cancel. D is equal to minus 4.6 divided by 0.5 come to 9.2 is the dividend given. What is the EPS? 10. 10 la evlo DPS? Appa 9.2 divided by 10 into 100 na. Evlo? Appa 92% is the present dividend payout ratio. Hello? What is R in the question? 12. What is the KE? 8%. Is R greater than KE? According to Walter, according to Gordon, you are not supposed to give what at all? Dividend at all. Correct? Since the rate of return of the firm R is 12% more than KE, therefore by distributing 92% of the earnings, the firm is not following an optimal dividend policy. What should be the optimum? 0. They should not give what at all? The optimal dividend policy for the firm would be to pay 0 dividend. And in such a situation, market price will be. That means if they give 0 dividend, D will be 0 and E minus D will be entire 10. This 10 will grow at the rate of 12%. So 1.2 will be the earnings. 10.2 basically. Correct? Divided by 8. Whole divided by 8 means, sir, the price, market price of the share will be 187. That means if you are following 0 dividend policy, your price will be 187. But currently it is only 130 because of your wrong dividend policy. Able to appreciate. So theoretically, market price of the share can be increased by adopting a. This is theoretically, man, market, I don't know what will happen. Okay. Sir, if the PE ratio at which dividend policy will have what effect? No effect on the value of the share is such that KE would be equal to what? R. Sir, if the KE is equal to R, whether you give dividend, whether you don't give dividend, it will not affect. Are you really with me? Sir, KE would be equal to R. The KE would be 12 at the PE ratio of 8.33. Ebdina, what is the current KE? 8%. What is the R? 12%. Correct? Sir, R is equal to KE. R is equal to KE means 12%. Are you really with me? That means if my R is equal to KE. Hello, sir. Dividend payout ratio become irrelevant. Whether you pay the dividend, don't pay the dividend. Correct, sir? That means P ratio of what is the R repo? 12%. That means 1 divided by 12 comes to 8.33. 8 point. You just answer me. You just answer me. What is the current? What is the current? Hello, sir. R. 12%. Current R is 12%. 1 second, man. Current R is 12% and current K is 8%. Current P ratio 12.5 times. Correct? I want enna venunna PE ratio at which I want the PE ratio at which my dividend policy will not have no effect. Correct? When my dividend policy will not have no effect? When R is equal to K. That means what is my R? 12. This should be equal to KE of 12%. That means what is my KE? 1 divided by P ratio. Are you really with me? That means 12 is equal to 1 divided by P ratio. That means P ratio is equal to 1 divided by 12 comes to 8.33 times. That means if my PE is 8.33, dividend policy will not have no effect. Right? Sir, if the P is 8.33 instead of 12.5, then the KE, which is inverse of P, would be how much percent? 12%. In such a situation, KE will be equal to R. Am I right? Yes, sir. Because if the KE is equal to R, then only dividend will be optimum indifference. And the market price as per Walters will be. Now I have to calculate the market price of the share as per Walter. What is the formula of Walter? D plus R by KE into E minus D whole divided by K. D already we know 9.2 plus 12 divided by 12 because R is equal to KE. This is sir, irrelevant. Sir, this is 0. 1. Basically 1. Correct? So you will get 1. There is no effect because 10 minus 9.2, 0.8. 0.8 plus 9.2, 10. 10 divided by 12%, you will be getting a market price of 83.33%. This will be the market price per share if you are following Walters model. I am coming to the same question using the Gordon's model. Do you, sir, remembering the formula of Gordon? EPS 1 into 1 minus B whole divided by KE minus G. What is EPS 1? EPS 1 is DPS 0 into 1 plus G. What is the current DPS? 9.2. Already given in the question. Can I calculate the G is equal to B into R? Yes, sir. What is B? Retention. Retention. Correct? How much, sir? Out of 192% dividend payout. So 8% is the retention. That was 8. Every 8% will grow at 12%. Correct? Now 0.96 is the G. Now this 9.2 will grow at 0.96. Comes to 9.2883 is what the DPS 1. Correct, sir? Now can I calculate the MPS 0? MPS 0 is equal to DPS 1 divided by KE minus G. What is DPS 1? 9.2883 divided by KE 8% minus G 0.96%. Am I right? Comes to 7.04%. Getting it? You will get 131.936. 936 is the share price. Alternatively, if you want, this formula also you can apply. Instead of DPS 0 into 1 plus G, EPS 1 into 1 minus B, both will give you what only? DPS 1 only. Again, sir, there will be share price of 130.68. Hello, sir. This is without applying growth on dividend. Without applying growth on dividend means I take a numerator as 9.2. That means I assume that this 9.2 is a grown dividend. That is DPS 1. Here I am assumed that 9.2 is the DPS 0 and I made it grow to DPS 1. That means basically there are 3 people are there. Number 1 Walter, number 3 Gordon and number 3 MM. Walter is a theory of relevance. Gordon is a theory of relevance. MM is a theory of irrelevance. What Walter is saying that, sir, P0 is equal to D plus R by KE into E minus D whole divided by KE. What Gordon is saying that P0 is equal to EPS 1 into 1 minus B whole divided by KE minus G. KE minus G. Right, sir? What MM is saying that, sir, not P0. Value of the firm is equal to N plus delta N into MPS 1 plus E minus I whole divided by 1 plus K. That's it with regard to the revision of the chapter. You go through the formula, do the 3 question, try any question of the ICAI illustration book back, you will be able to answer it. We'll meet with the revision of capital budgeting. By that time, you solve the 3 models and come back. Sir, very, very, very happy evening to all. So we are going to do the question, past examination RTP MTP question from the capital budgeting. My dear lovable students, I'm going to solve illustration number A. Stand Limited is contemplating replacement of one of its machine which has become outdated and inefficient. So already they are having a plant and machinery. They are going to buy a new plant and machinery. Just now we discussed how to take care of the cash flows. Its financial manager has prepared a report outlining 2 possible replacement machine. Sir, I can replace with either machine 1 or replace with machine number 2. Initial investment, how much lakh? How much lakh? 12 lakh, 16 lakh. Estimated useful life, 3 years and 5 years. Residual value, 1,20,000 and 1 lakh. Contribution per annum, 11,60,000 and 12 lakh. Fixed maintenance cost per annum, 40,000 and 80,000. Other fixed operating cost per annum, 7,20,000 and 6,10,000. So these are the details regarding machine number 1. These are the details regarding machine number 2. The maintenance costs are payable annually in FD. That is a key point in this question. Because when you are determining the present value, this has to be paid in advance. All other cash flow, apart from initial investment, assumed to be occur at the end of each year. Actually, this is a superb adjustment in this question, my dear lovable students. 99% of the students will go wrong with this adjustment. Depreciation has been calculated on straight line method and has been included in the other fixed operating cost. Here is what fixed maintenance, other fixed operating cost per annum. Inside that, what is there? Depreciation is there. Expected cost of capital of the project is 12% per annum. Which machine is more beneficial? Using the annualized equivalent approach, ignore tax. Calculate the sensitivity of your recommendation in part 1. Changes in the contribution generated by machine number 1. This is what year number 1, 2, 3, 4, 5 and 6. Super fantastic to the core, my dear lovable students. Can I calculate the CFAT for machine number 1? Yes, sir. Be with me and process your brain. Then you try by your own. Automatically you will start. Don't think that I am not able to do this question by your own. Sir, you are learning how to ride a vehicle. Cycle ஓட்ட கத்துக்கிறதுக்கு முன்னாடியே ரெண்டு கையும் தூக்கி ஓட்டணும்னா முடியாது. First கத்துங்க. First think and be with me. Sir, machine number 1. Calculation of net cash flow. Other operating cost excluding depreciation. What is the other operating cost per annum they have given? 7,20,000. It is including depreciation. Correct? So can I have to remove the depreciation? What is the original cost of machine number 1? 12 lakhs is the initial investment. What is the scrap value? 1,20,000 is the residual value is 1,20,000. Right up. Up 12 lakhs minus 1,20,000 comes to what is the depreciable amount? 10,80,000. What is the life of the machine? 3 years. Already given in the question. So divided by 3. So 10,80,000 divided by 3 comes to 3,60,000 is the depreciation per annum. Yes, sir. So my dear lovable students, sir, 7,20,000 cash flow includes depreciation of 3,60,000. So 720 minus 360 comes to 3,60,000 is the fixed cash expenses. Fixed excluding depreciation. Come on, sir. This is what the jadagam of the first project. In year number 0, sir, you have to spend 12 lakh. Is it a cash inflow, cash outflow? Cash outflow. Year 1, 2, 3. My dear lovable students, they said that you are having CFAT. Correct? What is the CFAT? Contribution per annum. 11,60,000, 11,60,000, 11,60,000. But here you should be very, very careful. Very, very careful. Look at here. Look at here. Sir, what they are saying? The maintenance costs are payable annually in advance. That means I am not going to pay the fixed maintenance cost 40,000 at the end of year number 1. Whereas at the start of year number 1. Purida. At the start of year number 1 means Y0. So Y0 I will pay 40,000. It's a cash outflow. Sir, Y1 I will pay 40,000. And Y2 I will pay 40,000. And for Y number 3 I would have already paid at the end of the Y number 2 or start of Y number 3. Whatever it may be. Here if you go wrong, entire present value placement will go wrong. So you have to be very careful when the cash flows are happening in the question. whether it is cash inflow or cash outflow. Are you really with me? Then other fixed operating cost excluding depreciation. Other fixed operating costs excluding depreciation. Just now we calculated 3,60,000, 3,60,000, 3,60,000. This is not happening at the start of the year. This is happening at the end of the year. Are you really with me? This is happening at the end of the year. Right? So my dear lovable students, the residual value, sir, I will be getting the residual value at the end of the, sir, last end of the project. What is the residual value? 1,20,000. Is it cash inflow, cash outflow? That means the net cash flow, year number 1, actually 12 lakh rupees cash outflow at Y0 and 40,000 rupees cash outflow at Y0. So 12 lakh 40,000 rupees is the cash outflow at Y0. Comfortable? In year number 1, there is a cash inflow of 11,60,000 at the, no, 11,60,000 is the cash inflow at the end of year number 1. And at the end of year number 1, I will spend 40,000 rupees. Correct? This is actually for start of year number 2. Correct? So 11,60,000 will come in, 40,000 will go out. So 11,60,000 minus 40. And at the end of the year, 3,60,000 I have to spend minus 3,60,000. What is the net cash inflow? 7,60,000. The same story for the next year also, right? But for the third year, I am having scrap income. Correct? So 11,60,000 will be the cash inflow. Sir, 3,60,000 will be the cash outflow. So 11,60,000 minus 360 comes to 8 lakh. Sir, plus 120 comes to 9,20,000. Are you settled with machine 1? The same Jadagam I am going to prepare for machine number 2. Why are you preparing like this? Because some cash flows are at the start, some cash flows are at the end, some cash flow are at the mid, like that. So I am finalizing the, sir, cash flows track. Coming to other fixed operating cost. What is the other fixed operating cost of the second machine? 16 lakhs. Other fixed operating 6,10,000. This include depreciation. What is the initial investment of the second machine? 16 lakh. Minus what is the residual value? 1 lakh. Correct? So 16 lakhs minus 1 lakh divided by life. 5 years. So 15 lakhs divided by 5 comes to 3 lakh is the annual depreciation. So inside this 6,10,000, 3 lakh rupees annual depreciation is there. So the remaining cash fixed operating cost is 3,10,000. Getting it? Are you all really with me? So this is the Jadagam man. In year number 0, initial investment is 16 lakh. 16 lakh. Right? Contribution. Contribution, my dear lovable students. Sir, at the end for year number 1, 2, 3, 4, 5. For Y1, Y2, Y3, Y4, Y5. Will you have cash inflow? Question itself specifically told that the contribution per annum is how much lakh? 12 lakh. Right? Yes, sir. What is the fixed maintenance cost? Already given us 80,000. But the adjustment is you are going to pay that in advance. So first year fixed maintenance cost you will pay at the start of year number 1 itself. That is Y0 itself you will pay. Right? At the end of year number 1, you will pay fixed maintenance cost for the Y2. That's why 80, 80, 80, 80. And fifth year, there won't be any cash flow. Are you clear with that? Other fixed operating costs excluding depreciation, because I am talking about cash. Sir, why are you not considering what at all? Depreciation at all. Is there any tax? If there is no tax, no depreciation under this chapter. That's what the start of the conceptual discussion, 2 column. Correct? With the depreciation, without depreciation. If there is no tax, there is no role for what at all? Depreciation at all. If there is no tax, ignore the depreciation concept in the capital budgeting. You don't worry about what at all? Depreciation at all. Put it on dustbin. That is a rule. No tax, no depreciation. No tax, no depreciation. That's what this question itself is all about. So, at the end of, sir, Y1, Y2, Y3, Y4 and Y5, I am going to spend 3,10,000. At the end of Y5, I will be getting, sir, scrap value of 1 lakh. Comfortable, sir. So, sir, Y0, you are going to spend 16 lakh and Y0 you are going to spend 80,000. So total 16 lakh. 80,000 will be your cash outflow for the second project. Here 12 lakh inflow, 80,000 outflow, 12 lakh minus 80, 11 lakh 20 minus 3 lakh 10, 8 lakh 10,000 rupees is the cash inflow. Are you all really with me? Yes, sir. Sir, here my dear lovable students, 12 lakh minus 80,000 minus 3 lakh 10,000 comes to 8 lakh 10,000. Here 12 lakh minus 80,000 minus 3 lakh 10,000 comes to 8 lakh 10,000. 12 lakh minus 80,000 minus 3 lakh 10,000 comes to 8 lakh 10,000. 12 lakh minus 3 lakh 10,000 plus 1 lakh comes to 9 lakh 90,000. So these are the cash flows associated with first project, and these are the cash flows associated with second project. Now, if the cash flows are ready, can I calculate the NPV of the project? Yes, sir. Simple, sir. Sir, machine 1 and machine 2. For machine 1, year 1, 2, 3, 4, 5. Correct? Year 0. Today, the present value of today is what? 1 rupees. Then they themselves question said that KO is equal to how much percent? 12 percentage. Calculator, sir. Everyone take. 1 divided by 1.12 comes to 0.893. Correct? Is equal to boarding a calculator. 0.797 is equal to 0.712 is equal to 0.636 is equal to 0.567. Comfortable? These are the present value factor for 12 percentage. Can I calculate the DCF, discounted cash flow? Yes, sir. What is the life of the first project? 3 years. 3 years. That means this 2 years is national waste for the first project. So calculator put, sir, net cash flow 7 lakh 60, 7 lakh 60, 9 lakh 20. From where you got this figure? Our working note. That's what we have, sir, estimated the cash flow. Clear? From the Jadagam of the cash flow. Sir, calculator 7 lakh 60 into 0.893 M plus comes to 6 lakh 78,680. Can I proceed? 7 lakh 60,000 into 0.797 M plus comes to 6 lakh 5,720. Am I right? 9 lakh 20,000 into 0.712 M plus comes to 6 lakh 55,040. 6 lakh 55,040. Right, sir? Out of all the three, my dear lovable students, if I add, I will get the discounted cash inflow. Discounted cash inflow. Minus, sir, MRC, I will be getting 19 lakh 39,440 minus 12 lakh 40,000 is my discounted cash outflow. So my NPV, net present value, is 6 lakh 99,440. 6 lakh 99,440. Are you all really with me? Comfortable, sir? Sir, now I am going to calculate the NPV for machine number 2. It is having a life of 5 years. Right? Already I finalized the cash flow. Jadagam of the cash flow. Right? So, calculator 8 lakh 10,000 into what is the discounted cash inflow 8 lakh 10 into discounting factor 893 M plus 7 lakh 23,330. Everyone feel the number. Next year 8 lakh 10,000 into 0.797 M plus 6 lakh 45,570. Paka. Next one, sir. 8 lakh 10,000 into 0.712 M plus 5 lakh 76,720. Comfortable. The next one. 8 lakh 10,000 into 0.636 M plus 5 lakh 15,160. Right, sir? Then 9 lakh 90,000 into 0.567 M plus 5 lakh 61,330. Comfortable. MRC will be 30 lakh 22,110 minus 16 lakh 80,000 is the initial cash outflow. So 13 lakh 42,110 is the NPV. Sir, the second project is having highest NPV, sir, as compared to the first project. Hence, second project has to be accepted is a blunder. Because first project is only a 3-year kid, whereas the second project is a 5-year kid. This is called as project life disparity. This is called as project life disparity. If you are having project life disparity, don't take the decision based on NPV. Take the decision based on annualized NPV. Tell me what NPV? What is annualized NPV? Simple. Sir, NPV divided by cumulative present value factor at the KO. That's it. Sir, first one, what is the rate? 12%. Come on. 1 divided by 1.12 is equal to 3s. In calculator put GT. You will get 2.402. Right up. So 6,99,440 divided by 2.402 comes to 2,91,191 is the annualized NPV. That is NPV for 1 year. This is the NPV for how many years? 3 years. This is the NPV for how many years? 1 year. That means I converted a 3-year kid into 1-year kid. Come on. Here, man. Sir, for 5 years, present value cumulative factor, calculator. 1 divided by 1.12 is equal to, second year again is equal to, third, fourth, fifth is equal to GT. 3.605. That means 13,42,110 divided by 3.605 comes to 3,72,291 is the annualized NPV. Is the annualized NPV, right? So this is the NPV for 1 year. So both the kits become 1 year baby now. You tell me which baby is generating more NPV? Second one. So machine number 2 is more beneficial using the equivalent annualized criteria. So what is the main important lesson from this? Simple. If projects are having same life, take the decision based upon NPV. If the projects are having different life, don't take the decision based on NPV. Take the decision based upon annualized NPV. That's it, game over. Comfortable? Come on. Calculation of sensitivity of recommendation in part number 1 to changes in the contribution generated by machine number 1. If you see this question, my dear lovable students, enna kekranne puriyadu. Adu ennadu Pepsodent toothpaste la sensitivity pesra mari pesran அப்படிங்கிற மாதிரி இருக்கும். What is this is all about? Simple, my dear lovable students. Sir, difference in the equivalent annualized criteria of the machine required for change in the recommendation in part 1. Calculator, sir, what is the annualized NPV of second project? 3,72,291. Figures, fractions, leave it. Minus, what is the annualized NPV of first project? 2,91,190. That means what is the difference? 81,101. 81,101. So, the difference between the first project and the second project is 81,000 rupees. In terms of percentage, calculator, 81,101 divided by what is the, sir, cash inflow of the project 1. Project 1, 11,60,000. Right? 11 lakh. Up 81,101 divided by 11,60,000 into 100 na 7% yearly. 7% yearly. What they are trying to say, I will tell you, sir. Alternatively, this also will read with this answer over, then I will give my interpretation. The annualized equivalent cash flow for machine number 1 is lower by 81,100 than for machine number 2. Therefore, it will need to increase contribution for the complete how many year? 3 year. Before the decision would be invested in this machine. Right? So, sensitivity with regard to contribution is 2.911. What they are trying to say is, sir, you are having machine number 1 and machine number 2. From machine number 1, what is the annualized NPV? 2,91,000 190, 191 or 190. What is 190 in எடுத்துக்கலாமா? 191 or 190? 190, 190. We will take 190. Leave it. For machine number 2, what is it? 3,72,291. My dear lovable students, hello sir. I will choose machine number 2 because of ISNPV. Correct? Why sir machine number 1 NPV as annualized NPV has reduced? Because it is having less CFAT. Less what fat? If CFAT increases na, discounted cash inflow would have been increased. If discounted cash inflow increases na, automatically NPV would have been increased. That means the difference between the machine 2 annualized NPV and machine 1 annualized NPV is total difference of 81,100. Right up. So for for machine number 1, if the annualized NPV increases by 81,100, I will go with machine number 1. I will not go with machine number 2. Right, sir? So to increase the annualized NPV to the extent of 81,800, sir, they want, look at, sir, calculate the what? Sensitivity of your recommendation in part number 1. I recommended actually second machine. Correct, Dane? To changes in the contribution generated by machine number 1. So the denominator should be contribution. How much is the additional amount you want? 81,100. So my dear lovable students, 81,100 divided by what is the contribution of machine number 1? 11,60,000 into 100 comes to 7%. That means if the first machine's contribution increases by 7%, I will not choose the second machine. I will choose only first machine. This is called as sensitivity. எந்த அளவுக்கு ஒரு ஃபேக்டர் மாறினா அந்த ஃபேக்டருக்கு அது இம்பார்ட்டன்ட். அதான் சென்சிட்டிவிட்டி. Are you really with me? Sir, they are calculating with one more thing, my dear lovable students. இதே sensitivity they are calculating with the present value. என்ன தெரியுமா? This 11,60,000 you are going to get in year number 1, Y1, and 11,60,000 you are going to get in Y2, and 11,60,000 you are going to get in Y3. Correct? So calculator man, sir, 11,60,000 into 2.402 means, sir, 27,86,320 is the present value of the contribution. Present value of the contribution. Correct, apa? Sir, what is the sensitivity? 81,100. Because I have taken the annualized NPV difference. And annualized NPV is 81,100. So 81,100 divided by 27,86,320 into 100. Now, if you are considering time value of money, it is just 2.911%. So there is a increase of 2.911% in the contribution of machine number 1. Then I will choose only machine number 1. Right? Or if there is a decrease of 2.911% of machine number 2, then also I will choose the machine number 1. That is called a sensitivity analysis is all about. Comfortable? That's it with regard to question number 1. I'm moving into a brilliant, outstanding, fantastic past examination question. An expected question for examination, my dear lovable students. Same question can come for examination. You try question number 1 and come back. We will be solving question number 2. Yes, sir. Very, very, very happy evening to all. We have solved first question from the capital budget. We are moving into illustration number N. The second question. This is a July 2021 question. An expected question for exam. An existing company has a machine which has been in operation for 2 years. Its estimated remaining useful life is 4 years. So total life 6 years. 2 plus 4. With no salvage or residual value in the end. After 4 years, you won't get anything. Its current market value is 3 lakh. If you sell today, you will get how much lakh? 3 lakh. The management is considering a proposal to purchase an improved model of machine gives increase in output. The details are as under. This is for the existing machine and this is for the new machine. Purchase price. Existing machine I already purchased. How many years back? 2 years back. Correct? For how much lakh? 6 lakh. But if I am put it on dustbin the old machine and if I am purchasing the new machine, then my dear lovable students, 10 lakhs will be the cost. Estimated life total 6 years. In that 6, how many years gone? So remaining life, and for new machine also 4 years. That means there is no project life disparity. Residual value for both the machine it is nil. Annual operating days for both the machine it is 300 days. Operating hours per day, in 1 day machine can work for 6 hours. Selling price they given 10. Material cost they have given 2. And the output per hour in units is what? 20 and 40. Labor cost per hour for 1 hour working, sir, 20 rupees. 20 rupees and 30 rupees. So we have to convert this cost like our costing. Fixed overhead per annum excluding depreciation is 1 lakh and 60,000. Working capital is 1 lakh and 2 lakh. Income tax rate is 30% and 30%. Assuming that cost of capital is 10% and company uses a return down value of depreciation WDV at the rate of 20%. And it has several machines in 20% block. Not only this one machine, lot of machines are there in the block. Advise management on the replacement of machine as per NPV method. The discounting factor at 10%, 0.909, 0.826, 0.751, 0.683. So, how to approach such a question? First of all, understand that this is replacement decision. Replacement decision in the sense means you will be having existing machine and also, my dear lovable students, you will be having new machine. So, you have to calculate 3 cash flows. Number 1, initial cash outflow, considering the new machine and also the existing machine. And you have to calculate the interim cash flows. And also you have to calculate the terminal cash flows. Can we calculate one by one? So calculation of net initial cash outflow. Net initial. What is the purchase price of the new machine? 10 lakh. So if I am going to purchase the new machine, 10 lakh will go from my pocket. Am I right? Add net working capital. Is there any additional working capital required? Yes, sir. How much lakh? Fixed, sir, how much lakh? 2 lakh. Working capital for the current machine is 1 lakh. For the new machine is, that means the incremental working capital will be how much lakh? 1 lakh. Incremental working capital will be 1 lakh. So add net working capital is 1 lakh. This is nothing but 2 lakh minus 1 lakh. That means for already for the existing machine, I spent 1 lakh. So if I am purchasing going for the new machine, I have to invest totally 2 lakh. That means additionally 1 lakh. Less sale proceeds of the existing machine. If I am buying the new machine, I have to sell the existing machine. Correct? The current market price of the existing machine is how much lakh? 3 lakhs. The current market price is 3 lakh. So this will be my cash inflow. This 10 lakh will be outflow. This 1 lakh will be outflow. And this 3 lakh will be inflow. So the net initial cash outflow will be how much lakh? 8 lakh. So 10 lakh plus 1 lakh minus 3 lakh is equal to 8 lakh. So if I am replacing the machine today, I have to spend 8 lakh rupees from my pocket. This is called as net incremental cash outflow. Can I come to the CFAT, sir? Yes, sir. With the existing machine, how many units you can produce, sir? Have they said, sir, anything? No, we have to work out. From the basic data, we have to work out how many units you can produce. Right, sir? Sir, how many operating days are there? 300 operating days. What is the operating hour per day? So, both the machine are having the same capacity. Correct? 300 days into 6 hours comes to 1800 hours. Comfortable? What is the selling price per unit, sir? 10. Selling price per unit is 10. Correct? 1 unit can be sold for 10. Sir, in order to manufacture one unit, I have to spend raw material. How much per unit? 2. What is the output per hour? 20. Whereas here it is 40. So existing machine in 1 hour will produce 20 unit, right? So total 1800 hours are there. So calculator, 1800 into 20 comes to 36,000 units is the production capacity of the existing machine. Comfortable, sir? Whereas, my dear lovable students, 1800 into 40 comes to 72,000. Basically double. That's what they are saying, man. Annual output is 36,000 units for the existing machine and 72,000 units for the new machine. So the difference, the incremental is how much? 36,000 units. Are you really with me? Coming to sales revenue at the rate of how much per unit? 10 rupees. Sir, whether you have manufactured with the existing machine or if you manufacture with the new machine, we can sell one unit for 10 per unit. So 36,000 into 10, 3,60,000. 72,000 into 10, 7,20,000. So if you are going to the new machine, the incremental sales will be 3,60,000. Comfortable? Now I have to reduce the existing operation cost and the operation cost for the new machine. Then I will get the incremental operating cost. Are you really with me? Sir, if I manufacture how many unit? 36,000 unit. Every unit will take how much per unit? 2. So 36,000 into 2, 72,000. Whereas with the new machine, I will be manufacturing 72,000 unit. So 72,000 into 2 comes to 1,44,000. So the additional material cost I have to spend if I am choosing the new machine is 72,000. Comfortable? But the labor, sir, labor will be different. How many hours is the labor? Sir, 1,800 hours I will be working in a year with the old machine. Correct? Every hour I used to pay 20. So 1,800 into 20 comes to 36,000 is the existing labor cost. Purida? Whereas if I go to the new machine, even number of hours also increased. Sorry, number of hours will be same. The labor cost will be increased. Right? That means, sir, 1,800 hours into 30 comes to 54,000 will be the labor cost under the new machine. So the incremental labor cost will be 18,000. Incremental labor cost will be, my dear lovable students, what is the fixed overhead excluding depreciation? Presently I am using 1 lakh. But if I am going for the new machine, I have to spend only 60,000. So there is a savings of 40,000. It's a savings of 40,000 right up. So the total cost for the existing machine, now I am spending 2,08,000. Whereas, my dear lovable students, if I am purchasing new machine, it will comes to 2,58,000. So additionally, I have to, sir, spend extra 50,000 every year if I am going for the new machine. Are you really with me? So what is the profit before, sir, tax and depreciation? Come on. Sir, what is the sales revenue? 3,60,000. What is the existing cost? 2,08,000. What is the gap? 1,52,000. Comfortable? Whereas there, what is the sales revenue? 7,20,000 minus 2,58,000 comes to 4,62,000. Are you all really with me? So my dear lovable students, my incremental profit before depreciation and tax is 4,62,000 minus 1,52,000 comes to 3,10,000. 3 lakh? Clear, sir? Sir, calculation of NPV on the replacement of the machine. Now, sir, initial cash outflow is ready. Sir, CFAT is ready. Now I am going to calculate the NPV. NPV means net present value, right? In this question, is tax there, tax not there? Tax there. Since tax is there, depreciation is relevant. If tax is not there, depreciation is not relevant. Right, sir? So, year number 1, 2, 3, 4. Why, sir? Because, sir, already with the existing machine, 2 years over. There is a life of 4 years. If I am continuing with the existing machine, if I am continuing with the old machine, I will get only 1,52,000. But if I am replacing with the new machine, I will get 4,62,000. So additional or increment is 3,10,000. Right up. So profit before tax and depreciation is 3,10,000. Correct? Now I have to calculate the depreciation. Tell me what is the cost of the new asset? 10 lakhs. What is the rate of depreciation given? 20%. I can't apply 10 lakh into 20% and I can't say that 2 lakh as a depreciation because already existing block is there. So I have to prepare the block. Can I prepare the block, right sir? And then I calculate the depreciation. You tell me, this is the base for the incremental depreciation. Understand very clearly. What is the purchase price of the existing machine? 6 lakhs. Have you used the existing machine? Yes sir. For both year number 1 and year number 2. That means for year number 1 and year number 2, you would have provided depreciation under WDV method. So 6 lakhs into 20% comes to 1,20,000. So 6 lakh minus 1,20,000 comes to 4,80,000 is the WDV for second year. Adoda 20% comes to 96,000. Right up. So 1,20,000 plus 96,000 comes to 2,60,000 is the depreciation already provided. Comfortable, sir? So my dear lovable students, 6 lakh minus 2,16,000 comes to 3,84,000 is the WDV of the existing machine. This machine is already there inside the block. Correct? My dear lovable students, what is the purchase price of the new machine? 10 lakh is the purchase price of the new machine. Add WDV of the already machine, 3,84,000. Right? So total 13,84,000 will be the block value. But the existing machine, you will sell for how much? 3 lakh. So that much block will reduce. Correct? So 13,84,000 minus 3 lakhs comes to 10,84,000 is the depreciation base for the new machine. So the new machine I have to depreciate. Correct, sir? Yes, sir. Of how much? 10,84,000. That means if I would have continued with the old machine, I would have depreciated only 3,84,000 in year number 3. If I am continuing with the new machine, the depreciation base is 10,84,000. What is the gap? 10,84,000 minus 3,84,000 comes to 7 lakh. This is the incremental depreciation base. That means from year number 3, 4, 5, 6, I will calculate depreciation only on 7 lakh. Calculator 7 lakhs into 20% comes to, that's what, 1,40,000 here. Clear? Conceptually clear? So my dear lovable students, calculator 7 lakhs minus 1,40,000 comes to 5,60,000 into 20% comes to 1,12,000. Comfortable? Minus is equal to 4,48,000 into 20% comes to 89,600. Minus is equal to 3,58,400 into 20% come to 71,680. So 71,680 is the depreciation for the year number last year. Now from the profit, incremental profit before depreciation and tax, can I reduce the depreciation? Yes, sir. Calculator 3,10,000 minus, sir, 1,40,000 comes to 1,70,000 is the profit before tax. Sir, here 3,10,000 minus 1,12,000 comes to 1,98,000 is the profit before tax. 3,10,000 minus 89,600 comes to 2,20,400 is the profit before tax. 3,10,000 minus 71,680 comes to 2,38,320 is the profit before tax. Right, sir? So I am having profit before depreciation and tax. From that, reduce the depreciation. I will get the profit before tax. Can I pay tax now at the rate of this figure into how much percent? 30%. Then I will get the PAT. Basically this figure into 70%. Comfortable? Then, sir, calculator man, 1,70,000 is the profit before tax. Correct? Pay tax at the rate of 30%. So into 70% comes to 1,19,000. Right? But will 1,19,000 will be the cash available with me? No. I will be having depreciation of 1,40,000. So 1,19,000 plus 1,40,000 comes to 2,59,000 is the CFAT. CFAT. Right? Now I have to discount that CFAT. Correct? Second year எப்படி calculate பண்ணுவேன்? 1,98,000 into 70% comes to 1,38,600 plus 1,12,000 comes to 2,50,600 is the CFAT of the second year. Comfortable? Third year, sir. Third year. 2,20,400 into 70% plus 89,600 comes to 2,43,880. Getting the flow? Next year, sir. 2,38,320 into 70%, 1,66,824. Correct? Plus 71,680 comes to 2,38,504. Comfortable? What is the present value factor at the rate of 10%? Hello, sir. Already given in the question. If I multiply the CFAT with the present value factor, I will get the, sir, present, sir, discounting cash inflow. Correct? This is the incremental discounting cash inflow. Here I have considered only the interim cash flow. I have not considered the terminal cash flow. So add release of net working capital. Incremental release of net working capital. Only how much lakh? 1 lakh. 1 lakh. Because if I go with the existing machine, release will be 1 lakh. If I go with the new machine, release will be 2 lakh. 2 lakhs minus 1 lakhs comes to 1 lakh into 0.683. Am I right? So 68,300 will be my incremental terminal cash flow. Right? Less incremental cash outflow comes to how much lakh? 8 lakh. So calculator, 7,88,478.712 plus 68,600 comes to 8,56,778.712 is the incremental cash inflow minus 8 lakh, sir. So 56,778.712 is the incremental NPV. Since the incremental NPV is what? Positive. Existing machine should be replaced. Existing machine should be replaced. Are you totally with me? Any doubt? My dear lovable students, we also calculated annual output as 36,000 and 72,000. We also calculated the base for the depreciation. That's it. Answer comes to an end. But if you want, the same answer can be calculated in two different ways, called as based upon total approach. Instead of traveling through the incremental approach, sir, travel through the total approach. That means total approach in the sense means calculate existing machinery separately and new machine separately. Hello, sir. Don't do this for examination. Do only incremental. But in the answer suggestion given by ICAI, they have given two approach. So I am discussing the two approach. What is happening? Are you totally with me? Come on, man. Sir, what is the year number 1? Sir, what is the opening balance of the existing machine? 6 lakhs is the opening. First year depreciation, 1,20,000, 20%. Participate and say, sir, WDV, this will be the, sir, W2, Y2 opening, right? So 4,80,000 into 20% comes to 96,000. So 4,80,000 minus 96,000 comes to 3,84,000. Comfortable? This 3,84,000 will be the opening WDV in year number 3. Correct? 3,84,000 into 20% comes to 76,800. Closing WDV will be 3,07,200. Right, sir? And sir, year number 4, 3,07,200 into 20 percentage comes to 61,440. Closing 2,45,760. 2,45,760 into 20 percentage comes to 49,152. If you reduce that, you will get 1,96,608. Comfortable? Sir, 1,96,608 into 20 percentage comes to 39,321. Balance will be 1,57,286. What I have done is, I have calculated the depreciation for the what machine? Existing machine separately. Paka. If I am going with the what machine? New machine. The opening balance will be 10,84,000. Can I say how it is 10,84,000? Because if I am going to replace the machine, my dear lovable students, I have to sell the existing machine. Correct? Already here itself we calculated that it is 10,84,000. Right? So the capital base will be 10,84,000. I am not seeing the increment. I am seeing the existing machine separately and I am seeing the new machine separately. Comfortable? If I am seeing the difference, I will get a difference of 7 lakh. But I am not seeing the difference. Okay, wow. So 10,84,000 into how much percent? 20 percentage comes to 2,16,800. Right, sir? So what is the WDV? 8,67,200. Adoda 20%. 1,73,440. That minus panna balance 6,93,760. 6,93,760 into 20 percentage comes to 1,38,752. Right up. Adoda closing 5,55,008. 5,55,008 into 20 percentage comes to 1,11,001. You will get the closing. My dear lovable students, inga paru. As the company has several machines in what block? 20%. Value of the existing machine from the block calculated as below shall be added to the new machine. Correct, Dane? Sir, what is the WDV of the existing machine? 3,84,000. We already calculated. If you want, I will calculate once again. What is the cost of the old machine? 6 lakh. First year dip 20%. Minus is equal to 4,80,000. Into second year dip 20 percentage. Minus is equal to 3,84,000. Comfortable? Less sale value of the machine. I am going to sell the existing machine for how much lakh? 3 lakh. That means from 3,84,000. If I sell for 3 lakh, I will get WDV of the machine in the block is 84,000. I will add, sir, the cost of the new machine comes to 10 lakhs. So 84,000 plus 10 lakhs comes to 10,84,000. This value only I have provided here, 10,84,000. Comfortable? Therefore, the opening balance of depreciation of block 10 lakhs plus 84,000 comes to 10,84,000. Now I am following loose sumari total approach. Under total approach, I will calculate for existing machine separately and I will calculate for new machine separately. Hello, sir. Then I will see the incremental annual cash flow. This is what we have done there. Hello, sir. Yes, sir. Sir, then you will get then you will calculate the what? NPV. Then you will get the 56,000 as answer. You already got, sir, here in the main answer, sir, 56,778. Hello. The same thing. Total approach. But still, since it has been given by ICAI, it is my responsibility to explain. Are you already with me? Already 2 years of existing machine over. So year 3, year 4, year 5 and year 6. Are you already with me? Year number 3. What is the annual output? Existing man with the old machine 36,000, 36,000, 36,000 and 36,000. Am I right, sir? Sir, sales, sir, revenue at the rate of how much per unit? 10 per unit. 36,000 into 10 comes to 3,60,000. 3,60,000. 3,60,000. 3,60,000. Participate, man. For every number of units, what you are going to produce? 2 rupees is the material. 36,000 into 2. 72,000. 72,000. 72,000. 72,000. Right? For every 1 hour worked, 20 rupees will be the labor. So 300 days, every day 6 hours. 300 into 6 comes to 1,800 hours. 1,800 into 20 comes to 36,000 will be the labor cost. Comfortable? Fixed overhead already given in the question as 1 lakh, 1 lakh, 1 lakh, 1 lakh. Right, sir? Depreciation, just now we separately calculated that depreciation for the, sir, 4, 5, sorry, this is for 3, 4, 5 and 6 comes to 76,800, 61,440, 49,152 and 39,321. Right, sir? Yes, sir. That's the depreciation. So you will get the what cost, man? Total cost, including depreciation. Right? From the revenue, if you reduce the total cost, you will get the profit before tax. Am I right? From the profit before tax, pay tax at the rate of, you will get the PAT. To that PAT, add depreciation. Sir, you will be getting the CFAT for year number 1, CFAT for year number 2, CFAT for year number 3 and CFAT for year number 4. But in last year, there will be terminal cash flows. Right, sir? You have to take care of release of what capital? Working capital, 1 lakh. This I have separately assessed the existing machine. That means if I am using the existing machine for year number 3, 4, 5 and 6, my dear lovable students, my position will be like this. No, sir. I am going to separately analyze the what machine? New machine. How many units new machine will give? 72,000. Right? Every unit will be sold for 10 per unit. So sales value will be 7,20,000. Can I proceed? Every unit need a material of 2 per unit. So 72,000 into 2 comes to 1,44,000. Are you all really with me? And labor, sir, every hour we are liable to pay 30 rupees. Right? So 300 days into 6 hours per day into 30 comes to 54,000 will be the labor cost for every year. Right? Fixed overhead will be reduced. That means from 1 lakh, it has been comes to how much? 60,000. Comfortable? And depreciation, sir, we have calculated depreciation with the new base. Already we have done here. Right? So the depreciation for the, sir, second machine will be 2,16,800, 1,73,440. Right? If you do like that, my dear lovable students, you will be getting the total cost. From the total revenue, reduce the total cost. You will get the profit before tax. Am I right? Pay the tax at the rate of 30%. You will get the PAT. Profit after tax. Profit after tax. Add depreciation. Because depreciation is a what cash item? Non-cash item. Sir, only in the what year? Last year, my dear lovable students, there will be release of what capital? Working capital. But it is not 1 lakh. It will be, so my CFAT. Since the method of depreciation changed from SLM, it's not SLM, it is WDV. So CFAT will not be same. Otherwise, CFAT will be same. Are you really with me? So I'm calculating the incremental annual cash flow. Sir, for year number 1, 2, 3 and 4, balance years, what is the answer you got? Here 1,29,440, 1,24,832, 1,21,145, 2,18,196. Right? But if you are going with the new machine, 3,88,440, 3,75,432, 3,65,025 and 5,56,704. So you will get the incremental cash flow. 2,59,000. 2 lakh how much? Look at the first answer. As per our incremental approach. Hello, sir. Here, 2,59,000. We already got this. Sir, this is as per incremental approach. Earlier, you would have not valued incremental approach. Now, sir, if you are going with the total approach, you have to do separately for the existing machine. You have to do separately for the new machine. Then we have to find out the difference. After solving everything and finding out the difference, better to do the incremental approach. First initial itself, sir, find out the difference. So 2,59,000, 2,50,600, like that it goes, my dear lovable students. That's what the increment, 2,50,600, 2,43,880 and 3,38,504. Whatever table you done there. To find out the NPV, year number 1, 2, 3, 4. This is the incremental annual cash flow. This is a discounting factor at the rate of 10% already given in the. This is the, if you multiply, you will get the cumulative present, sir, cash inflow. Correct? Discounted cash inflow. Minus, sir, net initial cash outflow. How much lakh? 8 lakh. You will be getting incremental NPV of 56,778. Sir, this only I also got here, 56,778. Not even round off difference is there. Right? My dear lovable students, since the incremental NPV is positive, existing machine should be replaced. So either you can do method number 1 or you can do method number 2. Better to solve using method number 1. This is the net initial cash outflow. Already in the NSR first type of solving itself, we got that how much lakh? 8 lakh. Are you comfortable and getting a good understanding of the replacement decision? Yes, sir. Always capital budgeting problem. It's easy to explain. But if you start solving, doubts will come. So, my dear lovable students, I am just breaking for your 20 minutes. Sir, you just try this question and we are having only one more question to solve. This is a RTP May 19. Very good question. Again with project life disparity. Again with project life, we have to take a decision or call regarding the two machines, my dear lovable students. So spend 15-20 minutes in question number 2 and come back. We'll be solving the third question. With that, the revision of the capital budgeting will come to an. Yes, sir. Very, very, very happy evening to all. So we are going to do the last question from the capital budgeting. The third question. My dear lovable students, this is a RTP May 2019 question. BT Pathology Lab Limited is using an X-ray machine which reached at the end of their useful life. That means this question is from the front of replacement decision. Following new X-ray machines are of two different brands with same features are available for the purchases. They are having brand XYZ and brand ABC. Cost of the machine 6 lakh and 4 lakh 50,000. Life of the machine. The first machine XYZ brand, the life is 15 years. Whereas the second machine brand is 10 years. That means, my dear lovable students, there is a project life disparity. Maintenance cost, they have given 1 to 5, 6 to 10, 11 to 15. If you are going with machine XYZ, first 1 to 5 years, you have to spend 20,000. 6 to 10 years, you have to spend 28,000. 11 to 15 years, you have to spend 39,000. Whereas, if you are going with ABC, the life is 10 years. For the first 1 to 5 years, 31,000. 6 to 10 years, 53,000. And the rate of depreciation is 4% and 6%. Residual value of both of above machine shall be dropped by 1/3 of the purchase price in the first year. That means once the asset becomes second-hand asset itself, my dear lovable students, its residual value reduces and thereafter shall be depreciated at the rate mentioned above. So after that, for every year, you have to reduce the scrap value by depreciation at the rate of 4 and 6%. Alternatively, the machine of the brand ABC can also be taken on rent to be returned back to the owner after use on the following terms and conditions. So you are having two options are available. Either you can purchase the brand ABC or you can take rent ABC. If that is the case, annual rent shall be paid in the beginning of each year. And for the first year, it will be 1,02,000. That means in Y0, it will be 1,02,000. Annual rent for the subsequent 4 years shall be, that is year Y1 to Y4 will be 1,02,500. Annual rent for the final 5 years shall be 1,09,950. That means for Y5 to Y9, it is 1,09,550 because the life of this machine is only 10 years, not 15 years. That's why rental is for 10 years. The rental agreement can be terminated by BT Limited Labs by making a payment of rupees 1 lakh as penalty. Generally, once they enter into agreement, the length of the agreement will be 10 years. If you don't want, after 5 years or 6 years or 7 years, you can cancel the agreement by paying penalty. General penalty 1 lakh. This penalty would be reduced by rupees 10,000 each year of the period of the rental agreement. Every year, this 10,000 will come down. For example, 10,000 rupees is the per year penalty. That's why 10,000 into 10, 1 lakh. If you are returning after 4 years, 60,000 penalty you have to pay. If you are returning after 5 years, 50,000 penalty you have to pay. If you are returning after 7 years, 30,000 penalty you are supposed to pay. You are required to advise which brand of XY machine should be acquired, assuming that use of machine shall be continued for a period of how many years? 20 years. But the life of the asset has been given only for 15 years and 10 years. State which of the option is most economical if the machine is likely to be used for a period of 5 years, That means two extremes they are asking. If it is for 20 years, which is the best brand? And if the life is 5 years, which is the best brand? Cost of capital of BT Lab is 12%, my dear lovable students. Solution. So, since the life of the each machine is different, yes, the first brand 1 is 15 years and brand 2 is how many year? 10 year. And time span exceeds the useful life of each model. Yes, the time span is 20 years they are asking. We shall use the equivalent annual cost method to decide which brand should be chosen. So I can't take the decision based upon NPV. I can't take the decision based upon total cost because two projects having two different life. So better to choose based upon equivalent annualized cost. That is a technique I am going to use. Sir, option number 1, if the machine is used for how many years, man? 20 years. Sir, if the machine is used for 20 years means I have to incur the cost only for first 15 years. It is like the last 5 years will be cost free. No need to incur anything. So period, year number 0. Today, I have to go to the shop and purchase the machine by paying how much lakhs? 6 lakhs. They themselves said that the present value factor will be 12%. So today's present value factor is 1. So my dear lovable students, 6 lakh is the total present value. Am I right, sir? For 1 to 5 years, 6 to 10 years, 11 to 15 years, they themselves said that this is a maintenance cost. 20,000, 28,000 and 39,000. 20,000, 28,000 and 39,000. Sir, will you take present value factor or cumulative present value factor? Cumulative present value factor. Take the calculator, man. 1 divided by 1.12. Sir, second year, third year, fourth year, fifth year, GT comes to 3.605. Am I right, sir? Sir, again, cumulative present value factor. 1 divided by 1.12 for 10 years. Second year, third year, fourth year, fifth year, sixth year, seventh year, eighth year, ninth year, 10th year, GT. Total comes to 4.757 minus already cumulative 3.605. Sir, sir, GT, sir, 5 point, sorry. 3 in the GT, 10 years GT, 5.650. Sir, 5.650 minus 3.605 comes to 2.05045. Now go to the 15 years. That is 1 divided by 1.12. First year, second year, third year, fourth, fifth, sixth, seventh, eighth, ninth, 10th, 11th, 12th, 13th, 14th, 15th, GT. 6.810 or 811 rather, right, sir? 6.811. Sir, from 6.811, this cumulative you reduce. Minus 5.650 comes to 1.161. Am I right, sir? This is the present value factor for the 15th year, my dear lovable students, which is 0.183. Sir, what is this 64,000? Sir, if the life of the asset is 15 years, sir, at the end of the 15th year, sir, we have to get the scrap value, right, sir? What they have said that this is how you have to calculate the scrap value. What is the cost of the machine? Cost of the machine is 6 lakh. Cost of the machine is, so the cost is equal to 6 lakh. Question clearly saying that if 1 year over, residual value will fall by 1/3. So 6 lakh into 1/3 come to 2 lakh. Are you totally with me? So my dear lovable students, from 6 lakh, if you reduce 2 lakh, balance 4 lakh will be the residual value. And for the next 14 years, we have to calculate the depreciation. Because every year they said that 4% is the depreciation. Always calculate depreciation on the original cost. That means 6 lakh into how much percent? 4%. Into how many years? 14 years. So 6 lakh into 4% means annual depreciation 24,000. Into 14 years comes to 3 lakh 30,000. 36,000 will be the reduction in the scrap value. Because when the year goes, you won't get full scrap. Because your usage increases. When usage increases, scrap value decreases. That is the logic. Are you totally with me? So cash inflow at the end, year end, that is Y15 will be 64,000. That's what this 64,000, my dear lovable students. Are you totally with me? If I multiply, I will get the, sir, present value of the cash inflow, which is nothing but 20,000 into 3.605 comes to 72,100. 28,000 into 2.045 comes to 57,260. Sir, 39,000 into 1.161 comes to 45,279, and these all are inflow and outflow. But at the end of year number 15, we are having scrap value inflow, correct? So 64,000 into 0.183 comes to 11,712 is the inflow. So my net outflow will be, already I am having outflow of 6 lakh. And sir, here I have to add 72,100 plus 57,260 plus 45,279 comes to 1,74,639. Am I right, sir? In that 11,712 is my inflow. Are you following me? Yes, sir. So 1,62,927 is the cash outflow plus initial outflow of 6 lakhs. Total comes to 7,62,927 is the total cash outflow. Am I right, sir? Sir, this is for how many years? 15 years, my dear lovable students. I don't want the total cost for the 15 years. I want the annualized cost. So, equivalent annual cost is equal to 7,62,927 divided by cumulative present value factor at the rate of 15% for how many years, man? 15 years. So, calculator 1 divided by 1.15. 1 divided by 1.12, not 15, 12 years, 12%, yeah? 12% for 15 years. So 1 divided by 1.12 is equal to, second is equal to third year, fourth year, fifth year, sixth year, seventh year, eighth year, ninth, 10, 11, 12, 13, 14, 15. GT comes to 6.811. I hope you also getting the answer, right, sir? Up 7,62,927 divided by 6.811 comes to, sir, 1,12,014 is the annual cost. That means if I am going with the first brand, that is brand XYZ, every year I have to spend 1,12,014. Right, sir? I am having another brand, but in that another brand I am having two options. Option number one, I can either purchase the another brand or I can take rent of the another brand. First I am assuming that I am going to purchase the another brand. Right, sir? Right. Present value of the cost if the machine of brand ABC is purchased. Sir, the life of the second brand is only how many years? 10 years, my dear lovable students. In year number 0, I have to spend 4,50,000. Will this be cash inflow or cash outflow? Cash outflow. Everything is cash outflow only. Actually, this question is not from the angle of inflow. This is from the angle of the outflow. Right, sir? And present value factor is 1. So, total 4,50,000 you have to spend today. Then 1 to 5 years and 6 to 10 years, my dear lovable students. They themselves given in the question that, sorry, you have to spend 31,000 and 53,000, right, sir? Then 31,000 and 53,000 will be the cash outflow. So for first 1 to 5 years, 31,000 and 6 to 10 years, 53,000. So my dear lovable students, again I have to take cumulative present value factor. Already I have taken here. So because this I can be squarely used 3.605 and 2.045. 3.605 and 2.045. Comfortable? So 31,000 into 3.605 comes to 1,11,755. 53,000 into 2.045 comes to 1,08,385. Comfortable, sir? My dear lovable students, what is the scrap value? At the end of the 10th year, we are entitled to get the scrap. But first year gone, how much of the, sir, will go? 1/3 of the value will go, correct? So can I calculate the terminal cash flow? You tell me what is the cost of the second machine? 4,50,000. What is 1/3 of 4,50,000? 1,50,000. Appo 4,50,000 lendu 1,50,000 appove scrap value would have reduced, correct? So 450 minus 1,50,000 means balance 3 lakh maximum scrap value. But since you are going to use for another 9 years, my dear lovable students, every year 6% depreciation will come. Always we have to calculate the depreciation on the original cost. So 4,50,000 into 6% into 9 years comes to 2,43,000 will be the depreciation. That is reduction in the value of the scrap. Kandipa, if we are selling early, the machine will be new machine. Then we will get high scrap. But when years go, the machine will become old machine. Then the scrap reduces. Am I right? So 4,50,000 minus 1,50,000 minus 2,43,000 comes to 57,000 is the amount of scrap. Can I proceed, sir? This is what this 57,000. But this 57,000 you will get at the end of the year, 10th year. So don't take cumulative present value factor. Just take the present value factor at the 10th year at 12%. Can I proceed, sir? So calculator, sir. 31,000 into 3.605 comes to 1,11,755. 53,000 into 2.045 comes to 1,08,385. 57,000 into 0.322 comes to 18,354. That means I want not the cash outflow. I want the net cash outflow. If I knock it off, I will get 6,51,786. Let me ask you a question. Is this 6,51,786 for 15 years? No, sir. This is for 10 years. So 6,51,786 divided by 10 போட முடியாது, because this is having time value of money. So for present value cumulative factor for 10 years at the rate of 12%, take the cumulative. 1 divided by 1.12 is equal to second year, third year, fourth year, fifth year, sixth year, seventh year, eighth year, ninth year, 10th year, GT. 5.65. That's what they have given, 5.65. So 6,51,786 divided by 5.65 comes to 1,15,360. That means if I am going with the second brand, I have to annually spend 1,15,000. Sir, if I am going with the first brand, I have to spend only 1,12,000, right? So it's better to go with the first brand rather than the second brand. This is purchase option. But I'm having one more option. Second brand, okay, purchase rejected. It is, sir, will not work out. Can I, sir, taken that asset on rent is the next question. If I taken on rent, the life of the asset will be 10 years, right, sir? Then, my dear lovable students, in 0th year, cash outflow will be 1,02,000. Why, sir? Because they said that, sir, in Y0 itself, all the rental are upfront payment. Upfront payment means not at Y1 you are supposed to pay. At Y0, 1,02,000. Then Y1 to Y4, 1,02,500. Right, sir? That's what 1,02,500. And 5th year to 9th year, sir, 1,09,950. Already given in the question. But the only difference between this part is generally we will use to take pay rent at the end of the year. But this is the only question where we are making the rent upfront. Correct? So present value factor today, if I am paying in Y0, if I am paying 1,02,000, what is the present value factor? 1,02,000, right, sir? Sir, next one, sir. 1 to 4 years, sir. 1 divided by 1.12. First year, second year, third year, fourth year, GT comes to 3.037. Comfortable, sir? So 3.037 into 1,02,500 comes to 3,11,293 is the discounted cash outflow. Then come on. So next 5 to 9 years, sir. Take the cumulative for 9th year. 1 divided by 1.12. First year, second year, third year, fourth year, fifth year, sixth year, seventh year, 8th year, 9th year, GT. Which comes to 5.328. From that up to this cumulative you reduce. Minus 3.037 comes to 2.291. Comfortable? So 2.291 into 1,09,950 comes to 2,51,895 is the discounted cash outflow, my dear lovable students. The total cash outflow for 10 years, if I am taking the asset on rent is 6,65,188, right, sir? Now, man, I don't want the total cash outflow. I want the annual cash outflow. For that, I am going to calculate the cumulative present value factor. Just now we calculated, don't recalculate. 5.65, just now we calculated in the last option. If we purchase option, 5.65 is the cumulative, right? Presence of mind. So 6,65,188 divided by 5.65 comes to 1,17,732. That means if I am taking on rent, I have to every year spend 1,17,000. But if I am purchasing, I have to spend only 1,15,000. That means rental option veleke agadu. Ipo purchase option versus purchase option. Purchase option veleke agadu. So the conclusion is, my dear lovable students, it's better to go with the brand number 1. That's what the conclusion, man. Since equivalent annual cash outflow is least in case of purchase of machine brand XYZ, same should be purchased. First machine should be purchased. That's it. The first part of the question comes to an end. What was the first part? They want advice which brand of X-ray machine should be acquired. Assuming that use of the machine shall be continued for a period of 20 years. That means use of the machine can be continued for 20 years means the life is not 20 years. That technology will be valid for 20 years. Are you really with me? But this machine is having a life of only 15 years. Then what you will do for the remaining 5 years? Sometimes, sir, when 10 years over for the machine which you are going to purchase, still actually how many years life left will be there? 5 years. You may replace that machine with another life of 10 years. What they are saying is this can be continued for a period of 20 years. So why they are saying like that is the second machine is having a life of only 10 years, correct? But first machine is having a life of 15 years. Sir, 15 வருஷம் life வாங்கி நான் என்ன சார் பண்ணுவேன்னு கேட்டா, தம்பி, it can be used for a continuous period of 20 years. Market is there. You don't worry. You purchase life. So their life is not a problem at all. Don't decide on the actual life. Sir, even the life of the asset is 20 years, demand is there. Comfortable? Second part, they are, sir, making an adjustment, my dear lovable students. State which of the option is most beneficial. If machine is likely to be used for a period of how many years only? 5 years only. Sir, it can be used only for a period of 5 years. I can't use this technology for how many years? 20 years. If that is the case, scrap value will change, correct? Because since I am selling the machine immediately after 5 years, I will get more scrap value. Am I right? Sir, 6 lakh is the original cost of the first machine. After the end of the first year itself, two-third value will fall down, right? Then one-third value will fall down, right? Then, my dear lovable students, for every usage, for every year of usage, 4% will be the depreciation for the remaining 4 years. So 6 lakh is the original cost into 4%. This is for percentage rate of depreciation, and this is for the balance 4 years. So calculator, 6 lakh into 4% into 4 years come to 96,000, and in first year fall will be 2 lakh. So from the total cost, 2 lakh 96,000 will fall down. My dear lovable students, out of how much lakh? 6 lakh. If 2 lakh 96,000 falls down, 3 lakh 4,000 will be the residual value at the end of the 5th year. Can I proceed? Because, sir, how quick you are selling the asset, that much high will be the residual value. I am coming to the next one, man. Sir, scrap value of machine of brand ABC, my dear lovable students. What is the original cost of brand? 4,50,000. Since 1 year over, 1/3 will go. But depreciation rate will be 6% for the remaining 4 years. So 4,50,000 into 6% into 4 comes to 1,08,000. That means 4,50,000 minus 1,08,000 comes to, my dear lovable students, sir, 1 lakh minus, yes, 1,08,000 minus 1,50,000 kandipa pannu, minus 1,50,000 comes to 1,92,000 will be the scrap value of the second machine. Am I right, sir? Okay, sir. Can I proceed, sir? Now, sir, present value of cost. Sir, I am calculating the present value of the cost if the first brand is purchased. In year number 0, you have to purchase the asset for how much lakh? 6 lakh. Its cash outflow will be 6 lakh. If the life is 1 to 5 years, I am supposed to spend only the first leg of expense, which is only this 20,000, 1 to 5 years. Am I right, sir? Sir, I have to spend this 20,000, my dear lovable students. I will not take the present value factor. I will take the cumulative present value factor. Already I have taken 3.605. Last 3 times I have done 3.605. Am I right? But this is at how much percentage? 3.605. 12% for first 5 years. Can I proceed? So calculator, 20,000 into 3.605 comes to 72,100. This is the discounted cash outflow. Sir, if the life is only 5 years, I will be having more scrap value, 3,04,000. Is the scrap value cash inflow or cash outflow? Cash inflow. So I have to take the present value factor, not the cumulative present value factor. So 1 divided by 1.12, right? First year, my dear lovable students. Second year, third year, fourth year, fifth year, then 0.567. Calculator. 0.567 into 3,04,000 comes to 1,72,368 is the discounted cash inflow. Actually, I am calculating outflow, correct? So my net discounted cash outflow is equal to 4,99,732, right? Sir, what was the main problem in the first part of the question? For the first machine, life was 15 years. Second machine, life is 10 years. So there is a project life disparity. But if you are assuming that the life of the project is 5 years, sir, even for the first project also 5 year, second project also 5 year, then don't do the annualized NPV, annualized equivalent cost, correct? Because both the machine is having a life of 5 years. We can proceed as it is, my dear lovable students. For the second machine, you have to spend today 4,55,000. For the second machine, 1 to 5 years, there will be a cash outflow of 31,000. That the same present value cumulative factor. So 31,000 into 3.605 comes to 1,11,755. For the second machine, your scrap value will be 1,92,000. Is this 1,92,000 cash inflow or cash outflow? Cash inflow. Will you take cumulative present value factor or present value factor? Present value factor. My dear lovable students, same present value factor of 0.567. 0.567 into 1,92,000 comes to 1,08,864 is inflow. So these two are outflow. This is inflow. I will get the net discounted cash outflow is this 4,52,000. That means if I am purchasing the second brand, I have to spend only 4,52,000. If the life is how many year? 5 year. But if I am purchasing the first brand, I have to spend 4,99,000. That means this machine put it on dustbin because that machine is having huge cost, right? Now I finalize that I'm going to purchase the brand ABC if the life is how many year? 5 years. Now question is whether this has to be purchased or taken on rent. That's the decision we have to take, right, sir? Sir, if I am taking on rent means first year in Y0 itself rental advance has to be paid. Am I right? 1,02,000 rupees. For that 1,02,000 will be the cash outflow. And only 1 to 4 years will be there because the life of the asset itself is only for 5 years. Already first year rent paid. For the remaining 4 years, 1,02,500 will be there. So calculator, for 4 years, 1 divided by 1.12 is equal to 234 GT comes to 3.034. So 3.037 into 1,02,500 comes to 3,11,293 is the cash outflow. Sir, in fifth year, since you are cancelling the agreement, you are liable to pay penalty, correct? Actually, when you are taking rent, the rental agreement is available only for how many years? 10 years. That's what the deal. This is what they are saying. Alternatively, machine on brand ABC can also be taken on rent to be returned back to the owner after use on the following terms and conditions. That means we can return only after 10 years. But as per the specification of the question, we are going to return after 5 years. That means, sir, for every year, 10,000 rupees is a penalty, correct? So 5 years before, if we are returned back, means the person who has given rent is losing an opportunity to get the rent. So that's why he is asking for what? Penalty. That penalty is how much? 50,000. According to us, that 50,000 will be a cash outflow. Are you really with me? Sir, this has to be discounted using the present value factor at Y5 only, not Y4. Because this need not be paid in advance. Only the lease rental or rental has to be paid in advance. Am I right? So 50,000 into 0.567 comes to 28,350. So the total cash outflow will be 4,41,000 only. Wow. That means if the life of the asset is only 5 years, we decided that we don't want XYZ, brand XYZ. We are going with brand ABC. In that dual option is there, whether brand ABC has to be purchased or brand ABC has to be taken on rent. Sir, if I am purchasing, I am getting 4,52,891 cost. But if I am taking on rent, I am getting only 4,41. So I will go with the rent option, right, sir? At the end of 5th year, BT Pathology Lab Limited failed to comply with the terms relating to rental agreement with machine brand ABC because they have taken for how many years? 10 years. As a result, company is liable to pay 10,000 per annum as penalty for every year from the date of termination till the end of agreement period. That is year 6 to year 10. So 1 year 10,000. 5 years in agreement they are cancelling. 5 years in advance they are cancelling the agreement. Therefore, the terminal cash outflow for BT Pathology Limited will be how much? 50,000. That is 10,000 into 5 comes to 50,000. Sir, since cash outflow is leased in case of lease of machine brand ABC, same should be taken on rent. We are simply playing with the concept of time value of money. Are you really with me? A beautiful 3 question from the capital budgeting comes to an end, my dear lovable students. What you are supposed to do is multiple times do the same question again and again and again, and revise the concepts again and again and again, then you will be getting a fantastic grip over the topic capital budgeting. And this topic is a highly important area for exam. The highest mark scoring, sir, will be from the capital budgeting. Out of 50 mark, they will ask for nearly 8 to 10 mark in exam. 20% of the subject will come from capital budgeting. 10 mark is capital budgeting, my dear lovable students. I hope that the beautiful 3 questions we have solved and you are very much comfortable with all the 3 questions. In the coming slot, we'll be starting with the revision of the last chapter, that is working capital management. Yes, sir. I believe that you would have revised the theory part in the working capital management. I'm moving into a very important question. Illustration number A, RTP November 2022. Very good question according to me. Trading and P&L account of Beat Limited for the year ended 31st March is given below. Opening stock, sir, item wise they have given. Material, WIP and finished goods. And even closing stock also they have given. From here itself, we can prepare the average stock. Correct. And the opening stock plus purchase minus closing stock will give you the raw material consumed also. To wages, to purchases they have given credit. Wages they have given. Production expense they have given. Sales they have given and said that fully on credit. Fine. GP they have given 40 lakhs. Sir, administration expense 14 lakh. Selling expense 6 lakh. GP 40 lakh. Just cancelling only. Right? The opening and closing payable of raw material were 16 lakh and 19 lakh 20,000 respectively. That means opening creditors and the closing creditors. Whereas opening and closing balance of receivable were 12 lakhs and 16 lakh respectively. Opening receivable and closing receivable required. You are required to ascertain the working capital requirement by operating cycle method. Oh, operating cycle method. So we have to ascertain the working capital, not by number of days and all. They have not given raw material holding period method. So you are going to ascertain the working capital by what cycle? Operating cycle method. Can we calculate the operating cycle? Operating cycle is equal to raw material holding period plus WIP holding period plus finished goods holding period plus debtors collection period minus creditors payment period. Tell me, raw material holding period is equal to average stock of raw material divided by average raw material consumed per day. So from the question we'll calculate. Tell me, what is average stock? Opening stock plus closing stock divided by 2. So 14 lakh 40,000 plus 16 lakhs divided by 2 comes to 15 lakh 20,000 is the average. Correct? Can I calculate the raw material consumed, which is opening stock? 14 lakh 40,000 plus what is the purchase? 88 lakhs. Am I right? 88 lakhs is the purchases. Minus closing stock comes to 16 lakhs. So 86 lakh 40,000 is the total raw material consumed. Is number of days given in the question? No, sir. Can we take it as 365 itself? Because if it is 360, they have to openly mention. So my dear lovable students, average stock is 15 lakh 20. Have we got 15 lakh 20? Here 86 lakh 40,000 divided by 365 comes to 23,671.23. Right, sir? So 15 lakh 20,000 divided by 23,671.23 comes to 64.21 days is the raw material holding period or storage period. Both are one and the same. Can I proceed, sir? In this only one calculation is raw material consumed, which is opening stock of raw material, add purchase of raw material minus closing stock of raw material. I will get the raw material consumed. Coming to the second element of investment, that is called as WIP. What is WIP? Average stock of WIP divided by average factory cost per day. What is the opening stock? 4 lakh 80 plus closing stock 8 lakh, which comes to 12 lakh 80,000. Right, sir? Divided by 2 comes to 6 lakh 40,000 is the average stock. Now I want average factory cost. Factory cost means I have to take direct material consumed. Just now I have calculated the direct material consumed as what? 86 lakh 40,000. Right, sir? Which is nothing but cost sheet format. Material consumed. Add labor. What is the labor in the question? 24 lakhs. Add production expenses. That means overhead comes to 16 lakh. Sir, I will get some amount. Add opening stock of WIP minus closing stock of WIP, I will get the factory cost, which is net factory cost. Am I right? So 1 crore 23 lakh 20,000 is the net factory cost. This is for how many days? 365 days. So 1 crore 23 lakh 30,000 divided, 1 crore 23 lakh 20,000 divided by 365 comes to 33,753 is the average factory cost per day. How much is the average WIP? 6,40,000 divided by 33,753.42 comes to 18.96 days is the WIP holding period. So I am holding WIP in my factory for 18.96 days. Can I come to finished goods storage period? What is the average stock of finished goods? Opening plus closing divided by 2. 20 lakh 80,000 plus 24 lakhs divided by 2 comes to 22 lakh 40,000 is the average stock of finished goods. Am I right, sir? Yes, sir. Now, can I calculate the average cost of goods sold? Yes, sir. Sir, tell me, what is the production cost? Just now you calculated 1 crore 23 lakh 20,000, right? Add opening stock of finished goods already given in the 20 lakh 80,000. You will get COGAS, cost of goods available for sale. Am I right? So in my hand 1 crore 44 lakh rupees goods are there, but I have not sold 24 lakh rupees goods. That means cost of goods sold comes to 1 crore and this I have sold over a period of 365 days. So average cost of goods sold per day will be 32,876. Comfortable? So 22 lakh 40,000 divided by 32,876.71 comes to 68.13 days is the finished goods holding period. Are you all really with me? Coming to the debtors management, man. How to find out the debtors? Sir, average debtors. For that only question said that opening debtors and the closing debtors. Right, sir? Sir, 12 lakhs plus 16 lakhs. 12 plus 16, 28 lakhs divided by 2, 14 lakhs is the average debtor. Now I have to find out the average credit sales per day. They given the entire sales as credit sales. So 1 crore 60 lakhs divided by 365 comes to 43,835.62. Am I right, sir? So my dear lovable students, 14 lakhs divided by 43,835.62 comes to 31.94 days is the debtors collection period. Can I come to the, sir, creditors payment period? Average accounts payable already given opening and closing 16 lakhs plus 19 lakh 20,000 divided by 2 comes to 17 lakh 60,000 is the average accounts payable. Credit purchases divided by 365. What is the credit purchases? 88 lakhs. So 88 lakhs divided by 365 comes to 24,109. Upper 17 lakh 60,000 divided by 24,109 comes to 73 days is the creditors payment period. So can I calculate the operating cycle? Sir, raw material storage period 64.21. Sir, WIP storage period 18.96. Finished goods storage period 68.13. Sir, debtors collection period 31.93. This is my gross working capital. Am I right? Minus creditors payment period is 73. Then you will get the operating cycle is 110.24. Right? So in an year, how many days are there totally? 365 divided by 110.24 comes to 3.311 cycles are there. 3.3 cycles. Okay, they want to estimate the what capital? Working capital with the cycles. Okay, what is the total operating cost? Just now you calculated total cost of goods sold is 1 crore 20 lakh, right? Add, look at the P&L, man. In order to administer the business, I need general expense 14 lakhs and selling 6 lakh. 14 plus 6, 20 lakhs. So 1 crore 20 plus 20, 1 crore 40 lakhs I need in the entire year. In an year, how many cycles are happening? 3.311. So 1 crore 40 lakhs divided by 3.311 comes to 42 lakh 28,329.81 is the amount of working capital for one cycle. For how many cycle? One cycle. So for one cycle comprises of 110 days. For 110 days to run the business, you need 42 lakh, 28,329. Comfortable? What a beautiful estimation question this is. This is from the P&L account by using the working capital cycle. We estimated the estimation of the working capital. Beautiful question I have selected for you, my dear lovable students. If you are able to understand the nook and corner of this question, enough. Chapter working capital, estimation of working capital, two connected topics done. One is calculation of the cycle, working capital cycle, and also estimation of the working capital cycle. Two topics brilliantly we have covered. My dear lovable students, you sit and solve this question. In the coming slot, we will be talking about a concept called as data's management. What management? Data's management. We'll solve one question from data's management. Important, very important, very, very important for examination. Are you all really with me? You sit and go through this question, do the question and come back. Then we will solve the data's management. Sir, immediately after the estimation of that working capital question, we are having one more question. We'll solve that question. And then estimation of working capital concept will come to an end. Illustration number N. Basically the second question. Kalyanam Limited has provided you the following information for the year 21-22. By working at 60% of its capacity. So they are working at 60% of the capacity. Company was able to generate sales of how much lakh? 72 lakhs. So sales is equal to 72 lakhs. Direct labor cost per unit amounting to 20 per unit. For manufacturing one unit, they need 20 rupees. Direct material cost per unit was 40% of the selling price per unit. Selling price into 40% will be the direct material cost. Selling price was 3 times the direct labor cost per unit. Wow. So, selling price is equal to 3x of the direct labor cost. Profit margin was 25% on the total cost. But total cost into 25% will be the profit. So, cost plus profit is the sales. For the year 22-23, company makes the following estimate, right? Generally in question, they will give the selling price. Here, selling price is a suspense. Okay. Production and sales will increase to 90% of its capacity. They said that now it's working at 60. It will come to raw material per unit price will remain unchanged. Direct expense will increase by 50%. Direct labor per unit will increase by 10%. Despite the fluctuation in the cost structure, company want to maintain the same profit margin on sales. Raw material will be in stock for 1 month, whereas finished goods will remain in stock for 2 months. Production cycle is for 2 months. Credit period allowed by supplier is 2 months. Sales are made to 3 zones. Zone ABC, for A, 50% sale, 30 and 20, total 100% sale. Sir, mode of credit period of 2 months. That means if we make the sale, we will get money only within 2 months. Here, credit period of 3 months. If we make sale, we will get money within 3 months. This is cash sales, not required. There are no cash purchases and cash balance will be 1,11,000. There is no cash purchase at all. Entire purchase are credit. Company plan to apply for working capital financing from bank for the year 22-23. Fine. What required? Estimate the net working capital of the company. Receivables to be taken on sales. Receivables to be taken on sales. And also compute the maximum permissible bank finance for the company using 3 criteria of Tandon Committee norms. Assume stock of finished goods to be core current asset. This is an RTP May 2023 question. The same question may be repeated in exam. So I can't say that I don't know what the Tandon Committee is saying and all. First of all, cost structure. Actually, this is what missing in the question. Every question they themselves give the selling price. So tell me, what are the costs comprised of direct material, direct labor, direct expense, total cost, add profit, you will get the sales. That's it. Simple cost structure. So direct material, look at the question and tell me what is the relationship. It is how much percent of the selling price? 40% of the selling price. Already given in the question. Direct labor, they themselves given that 20. Have they given what is the percentage of direct labor? This direct labor comprises of how much percent? Like that they said, no sir. So, direct expense we have to find out. Correct? Selling price given. direct labor order selling price is equal to direct labor into 3 times. So sales is equal to 3 times of direct labor per unit. So 20 into 3 comes to 60. That's it. Selling price done. Sir, they said that if 100 rupees is the cost, they will be make a profit of 25. So the selling price will be 125. So that 60 will be 125. Am I right? So 60 divided by 125 into 25 will be the profit. So 12 rupees will be the profit. Can I proceed? So from 60, if 12 rupees goes means 48 is the total cost. 48 is the, that comprises of material, labor and expenses. Easy. So material will be 40% of the selling price. So 60 into 40% comes to 24. Sir, already labor given. So 24 plus 20, 44. I know the total should be 48. So 48 minus 44, 4 should be the direct expense. I hope that you are able to appreciate or understand. Very easy tracking of the cost structure. Come on, man. These all are per unit. Now I am going to convert into the total. How many, sir, numbers, number of units? Sir, how much is the total sales? 72 lakhs. They have given in the question. Divided by what is the selling price? 60, which is 3 times of the labor cost. Am I right? Up 72 lakhs divided by 60 comes to 1,20,000 units is what we have sold. So 1,20,000 is what manufactured, correct? Calculator, 1,20,000 into what is the raw material cost per unit? 24 comes to 28,80,000. 1,20,000 into labor cost per unit 20 comes to 24 lakhs. 1,20,000 into 4 rupees for direct expense 4,80,000. Basically 1,20,000 into 48 rupees total 57,60,000. Comfortable? Yes, sir. Profit 1,20,000 into 12 comes to 14,40,000 is the profit. Total 72 lakh already given in the question. Is there any change in the direct material as compared to the last year? No, sir. They said that material has not changed. So same as the previous year. So current year also 24 per unit. Am I right? Sir, labor increased by 10%. So 20 into 10%, 2 rupees. 20 plus 2, 22 rupees will be the labor cost, which is nothing but 20 into 110%. Can I proceed? Have they said anything about direct expenses? Direct expense will increase by 50. So 4 into 150% comes to 6 rupees per unit will be the direct expenses. Clear? So total cost will be 24 plus 22 plus 6 comes to 52 rupees. Clarity? Add profit, my dear lovable students. Sir, last year we had profit of 12 rupees per unit. Correct? Yes, sir. This year they want to keep the same profit they said. What is the cost per unit now? 52. But still they want to maintain 25% of 52. 52 into 25 means 13 rupees per unit is the profit. So 52 plus 13 comes to 65 is the selling price. Right, sir? Sir, since how many units even this year you are going to sell? 1,20,000. Calculator. 1,20,000 into 24 comes to 28,80,000. Yes, sir. Sir, production capacity last year was 60%. So, this 1,20,000 is 60%. Correct? So, divided by 60 into what is the current year production capacity? Into 90 comes to, you are going to manufacture 1,80,000 units. Am I right? So, 1,80,000 into 24 comes to 43,20,000. Can I proceed? Sir, again, 1,80,000 into 22 comes to 39,60,000. Appreciate Pandriya. 1,20,000 into 6 comes to 10,80,000. Right? Yes, sir. 1,80,000 into 52 comes to 93,60,000. Comfortable? 1,80,000 into 13 comes to 23,40,000 and 1,80,000 into 65 comes to 1,17,00,000. Once you are done with the basic data, the remaining are very easy. Number of units actually we calculated previous year 1,20,000, which is total sales divided by selling price per unit. Correct? Sir, current year, sir, this 1,20,000 was at 60% capacity. Current year, the capacity has been raised to 90%. So it become 1,80,000. Right, sir? Estimation of working capital. Now, I am going to estimate the working capital. Can I estimate the stock of raw material? Current year total raw material you are going to consume is 43,20,000. Correct? How much month stock they want to keep? 1 month. So 43,20,000 into 1 by 12 comes to 3,60,000 is the raw material stock. Comfortable? Now they want to keep a WIP stock of how much months WIP stock they want to keep? 2 months. So I have to value the WIP. WIP means raw material, labor plus direct expenses. Correct? What is the total raw material? 43,20,000. Labor 39,60,000. And direct expense 10,80,000. Elas setena 93,60,000. But since it is WIP, will 100% will be completed or will not be completed? Is there any proportion given? No, sir. Nothing has been mentioned in the question. How much is the percentage of completion? Can I assume that material 100% and labor and the direct expenses 50%? Yes, sir. What is the total labor cost? 39,60,000. Adoda padi. That's what 19,80,000. What is the total? 10,80,000. Adoda padi. 5,40,000. Comfortable, sir? That means, sir, 43,20,000, 100% of the material plus 19,80,000 plus 5,40,000 comes to 68,40,000 rupees is the WIP, value of WIP stock. Adila we are going to keep a 2 month stock. So into 2 by 12 comes to 11,40,000. Comfortable? Now coming to stock of finished goods, I have to add everything. This is the cost I am going to incur. 93,60,000 into how much stock I have to keep? 2 months. So into 2 by 12 comes to 15,60,000. Easy. Sir, receivable. Generally debtor, I will be having only one debtor. Here I am having 3 zone sales. Correct? Specifically they told that please value the debtor on sales. Since the question is a total approach, I can't do anything. I will go along with the total approach. Right? Sir, third one. First third one mudichalam. Third one, there is no debtor investment because it's a cash sales. Then 1 crore 17 lakhs is the total sale. Into 50% means the sales attributable to first zone is 58 lakh. Adoda 2 months they want to keep it as debtors. Comes to 9 lakh and here 1 crore 17 lakhs into 30% into 3 divided by 12 comes to 8,77,500. Are you all really with me? Comfortable? Coming to cash balance already given in the question as 1,11,000. If you add, you will get a total current asset as 50,23,500. Proceed pandriya. Less current liability payable. Sir, payable. What is the payable? What they said? 2 months. 2 months for Yarkalam payable. On what I am liable to pay? Creditors. Is there any other expenses payable or creditors only payable is there? Only payable is creditors. How much you are going to purchase? Every purchase is a credit purchase. Up 43,20,000 into 2 divided by 12. It is 7,20,000, but they are having 7,40,000. Is there anything extra to be paid? Sir, you have to purchase also for the raw material stock. Correct? Yes, sir. What is the raw material stock required? 28,80,000. Adoda 1 month. 28,80,000 into 1 by 12 comes to 2,40,000. Comfortable? Sir, now raw material to be, this is only consumed. This is only consumed. 43,20,000 is raw material. I will not keep the creditor based on raw material consumed. I will keep the creditor based upon raw material purchased. Concept clear? So I need to purchase raw material stock to be kept is 2,40,000, right? Plus how much I need for consumption? Consumption 43,20,000. Already how much closing stock of raw material I need? 3,60,000. கரெக்டா? எவ்வளோ closing stock? 3,60,000. What is the opening stock of raw material? 2,40,000. Correct? Yes, sir. Up I have to calculate the purchases. Every purchase calculate பண்ணுவேன். Opening stock plus purchases. You will get subtotal minus closing stock. You will get the raw material consumed. Correct? Yes, sir. You are having raw material consumed. You are having closing stock. You are having opening stock. Then the balancing figure will be purchases. So the amount of raw material to be purchased is raw material consumed minus opening stock plus closing stock. So 44,40,000 is the total raw material to be purchased. Correct? So 44,40,000 into 2 by 12 comes to 7,40,000 is the creditors payable. So totally I have to get 42,83,500. Think about operating cycle. Raw material holding period how much month? Already given in the finished goods holding period 2 months. Already given in the WIP holding period 2 months. Already given in the creditors payment period 2 months. Already given in the question. Receivables collection period based on zone. Correct? 2 months bar 3 months. First zone 2 months. Second zone, third zone 0 month. Cash sales. Right? Sir, I have not worked out what and all operating cycle. These are the operating cycle. If I add all gross operating cycle minus creditors, I will get the net operating cycle. But in order to take the gross operating cycle, here 2 bar 3 will be a problem. So one is 2 months and other is 3 months. So 2.5 months is the average receivable. Right? Clear? So, okay, I understood that this much money I need 42,83,500. Now I will go and stand before a bank. Then bank will say that maximum we will give only this much. That is called as maximum permissible bank finance. Tell me, maximum permissible. They are having calculation number 1. How bank will calculate your net working capital into 75%. What is your working capital? 42,83,500. Calculator. 43,83,500 into 75% comes to. This is the option number 1. This is the way of working number 1. Bank will say that maximum we will give 32,12,625. Right, sir? Or bank will say that we will consider 75% of the current asset and 100% of the current liability. Correct? What is the total current asset? 50,23,500 into 75% comes to 37,67,625 minus 7,40,000 comes to 30,27,625 is the maximum permissible bank finance as per method number 2. Appa in method number 1, sir, working capital into 75%. In method number 2, 75% of the current asset minus 100% of the current liabilities. Method number 3, 75% of the non-core current asset. Correct? What is the non-core? They said that what is the core current asset? Inventory. They said that take inventory as the core current asset. Something they said. What they said? Assume stock of finished goods to be core current asset. What is the value of the finished goods? Finished goods stock value 15,60,000. So what is the total current asset? 50,23,500. In this they are saying that core current asset is equal to 15,60,000. Core means main. Correct? Adla ni provision create panna vendiya avasiyam illa. So the non-core current asset is equal to 34,63,500. This is the This is the non-core current asset. On that, how much percent? 75%. 34 lakh 63,500 into 75% comes to 25 lakh 97,625 is the 75% of the non-core current asset. Right, sir? Minus what is the current liability? 7 lakh 40,000 comes to 18 lakh 57,625 is the maximum permissible bank finance under approach number 3. So what is approach number 1? Working capital, net working capital into 75%. Number 2, 75% of the current asset minus 100% of the current liabilities. Right, sir? Number 3, take the 75% of the non-core current asset minus 100% of the current liabilities. Comfortable? In all the cases, we are reducing 100% of the current liabilities. That's it with regard to the first brilliant big topic called as estimation of what capital? Working capital. In the coming slot, we'll be talking about the debtors management and factoring concept. Then we have to complete the cash management. With that, we are done with the FM revision, my dear lovable students. Do this 2 question estimation of working capital and come back. We will be dealing with the debtors management. Important, very important for examination. A company wants to follow a more prudent policy to improve its sales for the region, which is 9 lakhs per annum at present. So the current credit sales is how much lakh? 9 lakh. They want to release the debtors collection period. They want to make more sales with the average collection period of how many days? 45 days. Now 45 days is the average collection period. After certain research, management consultant of the company reveals the following information. Sir, credit policy W, X, Y and Z. Already existing is there. In addition to the existing, they are recommending 4 things. Sir, increase in collection period for 15 days. So 45 plus 15? 60 days. 45 plus 30? 75 days. 45 plus 45? 90 days. 45 plus 70? 115 days. Comfortable? Sir, if you are increasing your credit period like this, this will be the increase in sales. So already you are having a sales of 9 lakhs, 9 lakhs, 9 lakhs, 9 lakhs. It will be 9.6 lakh, 9.9 lakhs, 10.5 lakhs and 11.10 lakhs. Are you totally with me? Present default anticipated. Sir, 1.5% bad debt, 2% bad debt, 3% bad debt, 4% bad debt. Selling price per unit is what? 3. Average cost per unit is 2.25. Average cost is equal to variable cost plus fixed cost. And variable cost per unit is 2. And they have given the bifurcation. Then you have to classify the variable cost and fixed cost separately. Correct? 2.25 is the total. In that 2 rupees is the variable cost. Then my dear lovable students, 0.25 is the fixed cost. Currently we are selling how much lakh unit? 9 lakhs is the sale value. Correct? Divided by selling price is 3. So 9 lakhs divided by 3 comes to 3 lakh units. So 0.25 into 3 lakh units comes to 75,000. Comfortable? So whatever may be the increase in sale, the fixed cost will be fixed of 75,000. Correct? Only variable cost you have to vary. The current bad debt losses, that is a current, present, required rate of additional investment, that is opportunity cost is equal to, assume 360 days here, analyze which of the above policy would you recommend for adoption, my dear lovable students. There is no tax. There is no tax consequence has been given in the question. So there is no analysis of profit before tax and profit after tax. Right? Straight away I am analyzing, man. This is a most important expected question for examination. Statement showing the evaluation of the debtors policy under the what approach? Total approach. Tell me, I have to calculate the expected profit. First one, sales are, credit sales are. Already we find out 9 lakh, 9 lakh 60, 9 lakh 90, 10 lakh 50, 11 lakh 10,000. Comfortable? Less variable cost. Variable cost is 2 rupees out of 3 rupees. They said, correct? So 2 by 3 is the variable cost. 2/3 is the variable cost. 9 lakhs into 2/3, 6 lakhs. 9 lakh 60,000 into 2/3, 6 lakh 40,000. 9 lakh 90,000 into 2/3, 6 lakh 60,000. 10 lakh 50,000 into 2/3, 7 lakh. 11 lakh 10,000 into 2/3, 7 lakh 40,000. Comfortable? We just now calculated the fixed cost. Whatever may be the sales units, the fixed cost will be fixed at all level of activity. Comfortable? That means my subtotal comes to 6 lakh 75,000, 7 lakh 15,000, 7 lakh 35,000, 7 lakh 75,000 and 8 lakh 15,000. Comfortable? Sir, if I have reduced the from sales, if I reduce the total cost, I will get the profit. Sir, in addition to the profit, I have to add the bad debts. Am I right, sir? Sir, since there is no tax and all, any order I can do, there is no problem at all. Bad debts. What is the current percent of bad debt? 1%. 9 lakh into 1%, 9,000. Sir, what is the proposed bad debt percentage? 1.5%. 9 lakh 60,000 into 1.5, 14 lakh 40,000. Next proposed 2%. Next proposed 3%. Next proposed 4%. Right, sir? Sir, up 9 lakh 60,000 into 1.5% comes to 14,400. 9 lakh 90,000 into 2% comes to 19,800. 10 lakh 50,000 into 3% comes to 31,500. 11 lakh 10,000 into 4% comes to 44,400. Comfortable? So your expected profit will be, my dear lovable students, sir, from the total sales, total expenses plus bad debt. Sir, 9 lakhs minus 6 lakh 75,000 minus 9,000 comes to 2 lakh 16,000. Are you all really with me? Are you getting it? Yes, sir. 9 lakh 60 minus 7 lakh 15,000 minus 14,400 comes to 2 lakh 30,600. Getting it? 9 lakh 90 minus 7 lakh 35,000 minus 19,800 comes to 2 lakh 35,200. Getting it? 10 lakh 50,000 minus 7 lakh 75 minus 31,500 comes to 2 lakh 43,500. Comfortable? 11 lakh 10,000 minus 8 lakh 15 minus 44,400 comes to 2 lakh 50,600. Comfortable? This is my expected profit. Expected? But if I invest this variable cost and fixed cost, if somewhere I would have got some return, now I am losing that return. That is called as opportunity cost. So from the expected profit, I have to reduce the opportunity cost of investment in receivable. Right up. So calculator, 6 lakhs plus 75, 6 lakh 75,000. What is the opportunity cost percent? 20%. Yellow percent? 20%. Right. This 20% is for 1 year. Is it 20% per annum? Just 20%. So what is the policy? 45 days. Are you really with me? That means put 6 lakh 75,000 into 20% into 45 divided by 360 comes to 16,875 is the opportunity cost. Comfortable? Up from 2 lakh 16,000 goes means, sir, from 2 lakh 16,000, 16,875 goes means 1 lakh 99,125 is the net benefit expected. Next one, sir. What is the investment? 6 lakh 40 plus 75,000. Am I right up? 6 lakh 40 plus 75,000 comes to 7 lakh 15,000 into 20% into 60 divided by 360 comes to 23,833. Comfortable? I will get 2 lakh 6,767. Are you all really with me? Coming to the next one, man. Sir, total investment 6 lakh 60,000 plus 75,000 comes to 7 lakh 35,000 into 20% into, sir, 75 divided by 360. Am I right? Sir, 30,625. Sir, from 2 lakh 35,200, if 30,625 goes means 2 lakh 4,575. Are you all really with me? Sir, total investment 7 lakh 75,000 into 20% into 90 divided by 360 comes to 38,750. Comfortable? From 2 lakh 43,500 minus 38,750 comes to 2 lakh 4,750 is the net benefit. Can I come to the last one? Sir, total investment 7 lakh 40,000 plus 75,000 comes to 8 lakh 15,000 into 20 percentage into 115 divided by 360 comes to 52,069, 7069. From 2,50,600, if you reduce 52,069, you will get 1,98,531. You tell me, under which option my net benefit is maximum? 2,04,750, 2,06,767. That means under proposed policy. That means now we are falling how many days credit period? 45 days. Please increase by 15 days and make it to 60 days. If you do like that, automatically your sales increases, your profit increases. That will be good for the concern. This is called as debtors management. The proposed policy W, that is increase in collection period by how many days? 15 days. Or in total how many days? 60 days should be adopted, since the net benefits under this policy are higher as compared to the other policies. Sir, how to compute the fixed cost? We already calculated the fixed cost, right? So the total sales was how much lakh? 9 lakh. What is the selling price? 3. 9 lakhs divided by 3, 3 lakh units. Are you all really with me? 3 lakh units into 0.25 per unit comes to, so irrespective of the policy, fixed cost will not change. Whether you increase the number of units or decrease the number of units, fixed cost will be fixed. Comfortable? That's it, man. Sir, how to compute the opportunity cost? We already calculated the opportunity cost. You have to see the total investment, which is nothing but variable cost plus fixed cost. Every case, variable cost plus fixed cost is the investment in debtor. Comfortable? Into 20% per annum is the opportunity cost. Into number of lock-in period, you have to multiply. You will get the opportunity cost. So from the PAT, there is no PAT here. From the expected benefit, reduce the opportunity cost. You will get the, this is one way of solving or analyzing the debtors. This is called as total approach. This is called as what? Total approach. Can I proceed, sir? I'm coming to the next approach, man. One more way we can analyze this, called as incremental approach. What approach, man? Sir, what that incremental approach? Statement showing the evaluation of the what policy? Credit policy. Based on the what approach? Incremental approach. What approach? That means you have to find out the incremental expected profit. First, always write present. Then propose policy 1, propose policy 2, propose policy 3. Right? Always you have to start with the sales. What sales you have to take? Incremental sales. What, man? Incremental means, sir, for example, here it is 1 lakh and here it is 1,10,000. I can say that 10,000 is the increment. Less incremental cost of credit sale. Less incremental cost of credit sale. That is variable cost and what? Fixed cost. Incremental what debt? Bad debt. Incremental cash discount. Incremental expected profit. Incremental tax. Incremental PAT. Are you really with me? Yes, sir. That means nothing. Every format you add one word called as what? Incremental. And required return on incremental sales. You have to find out cost of what sale? Credit sale, which is variable cost plus fixed cost. Collection period already given in the question. Investment in receivable you have to calculate. Correct? What is the incremental investment in receivable? What is the rate of return, which may be 20 or 15% in all cases. You have to find out the required return on the incremental, then you will get the incremental net benefit. Nothing, you don't worry. I will do the same question under the incremental approach. Are you really with me? The same question under the incremental approach. Come on, sir. Sir, what I am going to do now, sir, first one, incremental expected profit I am going to calculate. Always the base you keep it as 0. Then only base minus option number 1. Base compared with option number 2. Base compared with option number 3. Like that I can move. Paka? So what is the incremental sales in option number 1? 0. Sir, present, sir, I'm doing some sale, but that is a base. Okay. If I am going to 60-day sale, extra incremental they themselves given in the question, which is 60,000, 90,000, 1,50,000 and 2,10,000. Right, sir? If I go to the, if sales increases, automatically variable cost increases. Correct, sir? Yes, sir. Sir, what is the variable cost per unit? 2 rupees per unit is the variable cost. Right, sir? Presently, we are incurring a variable cost of 3 lakh units we are selling now. At the rate of 2 comes to 6 lakhs. That's what 6 lakh is the variable cost. Comfortable? Sir, if you increase or if you start selling additional how many unit? 60,000 unit. 60,000 into 2 comes to 1,20,000. Correct? 1,20,000 will be the variable cost. You will be spending totally. Correct? Sir, if you sell, appo enna base vida adhigama extra how much is what our discussion is all about. Correct? Here, if you sell 90,000 unit, 90,000 into 2 comes to 1,80,000 should be total variable cost, additional variable cost you have to spend. 1,50,000 into 2 comes to 3 lakh is the additional variable cost you have to spend. Right, sir? Sir, 2,10,000 into 2 comes to 4,20,000 is the additional variable cost. Go to the question and check the variable cost. Sir, now when I am moving with the present policy, 6 lakh was the variable cost I have incurred. Yes, sir. But if I adopt policy number 1, what will be my variable cost? 6,40,000. So what is over and above? 40,000. That is what? Incremental. Appreciate pandriya. I am not going to check what is the total variable cost I am going to spend to manufacture 60,000 units. That is not the concept. The concept is, if I sell how many unit? First how many unit? 3 lakh unit, 3 lakh unit, 3 lakh into 2 comes to 6 lakhs. So this is what the basic NSR variable cost. Hello, sir. But in policy number 1, how much is the additional unit I am going to sell? How many unit? 20,000. Hey, I think here kepa. Sir. This is in value. This 60,000 is in value. Divided by 3. You will get what? You will get what? Number of units. Into 2. You will get the incremental variable cost. Enapa clarity. நம்ம என்னன்னா 60,000 2 போட்டோம். The 60,000 is not incremental number of units. The 60,000 is incremental value. Incremental value. On value, I can't apply the variable cost. Comfortable? So simple. By this way itself, you can do. Sir, inga simply you will get the answer. 6 lakh minus 6 lakh 40. 40,000 is the incremental variable cost. You have to compare 6 lakh, 6 lakh 60. 60,000, 6 lakh, 7 lakh, 1 lakh, 6 lakh, 740. That's it, game over. Look at here. Sir, 40, 60, 1 lakh, 1 lakh 40. Comfortable? There won't be incremental concept for the fixed cost. Because fixed cost, there is no increase at all irrespective of the activity. So dash, 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 dash. Right, sir? Now incremental bad debt. Compare with the base man. 9,000 minus 14,400. 5,400. That's what you have to write here as 5,400. Now you have to compare with everything. 9,000 minus 19,800. 10,000, that's what? 10,800. Next one, 9,000 minus 31,500. 22,500. Getting it? Then 9,000 minus 44,400. 35,400. I got the incremental bad debt. Now, sir, I will be getting incremental profit. Sir, my base profit is incremental profit. Look at here. 2,16,000 is my base profit. 2,16,000 minus 2,30,600 comes to 14,600. That's what? 14,600. Are you really with me? Yes, sir. Sir, next one. Sir, 2,16,000 minus 2,35,200 comes to 19,200. That's what I've written here. Next one. 2,16,000 minus 2,43,500 comes to 27,500. And the last one, 2,16,000 minus 2,50,600 comes to 34,600. Last one, there won't be any incremental. Correct? This is base, this is 0. Here 14,600, 19,200, 27,500, 34,600. Right, sir? Because base 0. Everything will be base 0. Base actually okay? Incremental means compared to base, how much extra to the next one. So, come on, that's it. So, required rate of incremental investment. See the incremental cost of credit sales. Look at here. What is the credit sales? 6 lakh, 6,75,000. That's why we have taken variable cost plus fixed cost separately. Correct? 6,75,000. Then 7,15,000, 7,35,000, 7,75,000 and 8,15,000. This is what the cost of investment in debtors. Sir, 45 days is becoming 60 days, 45 is becoming 75, 45 is becoming 90, 45 is becoming 115. Am I right? Now I am going to calculate the investment in receivable. Calculator. 6,75,000 into 45 divided by 360. Correct dane. So 84,375 is the base investment in debtor. Calculator. 7,15,000 into 60 divided by 360 comes to 1,19,167 is the investment in debtor if it is 60 days policy. Am I right? Then my dear lovable students, Purida, 7,35,000 into 75 divided by 360 comes to 1,53,125 is the investment in debtor. Next one, 7,75,000 into 90 divided by 360 comes to 1,93,750 is the investment in debtor. 8,15,000 into 115 divided by 360 comes to 2,60,347. So now base always 0, right? Now 84,375 minus 1,19,167. What is extra? 34,792 is the incremental investment in receivable. Are you able to appreciate what I am talking to you? இப்போ இதையும் கம்பேர் பண்ணு. 1,53,125 minus 84,375 comes to 68,750 is the incremental investment in debtors. Comfortable? 1,93,750 minus 84,375 comes to 1,09,375. Comfortable? Here, sir, 2,60,347 minus 84,375 comes to 1,75,922. Sir, in every case, the required rate of return is 20%, including the present case. Correct? So, the required rate of return, calculator man, இப்போ 84,375 into how much percent? 20% for the whole year into presently 45 divided by 360 comes to, sir, how much? 2? Correct, sir. 84,375 into, this itself is 45 days, le? Yes, sir. So, correct. Sir, 84,375 into 20% comes to 16,875 is the base. Correct? Now I have to one column, sir, they wrongly alignment mistake. Next one, sir, 1,19,167 into எவ்வளோ percent? 20% comes to 23,833. Look at the difference. 23,833 minus 16,875 na 6,958. Are you really with me? 6,958. Hello, sir. The next one. Come on. 1,53,125 into 20% comes to 30,625. Hello, sir. 30,625 minus 16,875 comes to 13,750. This is called as incremental. You understood how you have to find out? Now the net benefit. Always the base net benefit will be 0. Sir, here what is the incremental expected profit? 14,600. Correct? Minus what is the incremental opportunity cost? 6,958. Minus pannena you will get 7,642 under option number 1. Go to the main answer. Last answer. Sir, if you see here, your net benefit is, look at the difference between these two. Calculator. 2,06,767 minus 1,99,125 comes to 7,642. Here also 7,642. Comfortable? Here if you see, man, sir, expected incremental profit is 19,000 minus 13,750. Right? Yes, sir. Comes to 5,450. Look at the base and the third one, sir. 2,04,575 minus 1,99,125 comes to 5,450. Is it exactly matching? So whether you follow total approach or whether you follow incremental approach, you will get the same answer. You will get the, sir, this incremental is looking like Pythium, sir. Can I travel through total approach, sir? Because that's look good. No, sir. Because in exam, they may specifically say that Evaluate the data's management using the incremental approach. So recommendation, proposed policy W should be adopted since the net benefits under this policy are higher than under the other policy. Sir, the third approach, nothing, which is an extension of the incremental approach. If you do incremental approach, only this approach is possible, correct? Another method of solving the problem by computing the expected rate of return. Under which option you are having highest expected rate of return, you choose that, which is nothing but incremental expected profit. That means if you follow the incremental approach only, you will get the incremental expected profit, right? In case number 1, 14,600 is the incremental expected profit divided by incremental investment, which is nothing. Find out the return on investment, which is return divided by investment, which is 14,600 divided by 34,792 into 100 comes to 41.96 is the return on investments. Are you really with me? Return divided by investment, which is incremental return divided by incremental investment. That's it. Return divided by investments. Instead of return divided by investments, you have to take incremental return divided by incremental investments. Am I right, sir? Policy X, what is the incremental profit? 19,200. What is the incremental investment in debtor? 68,750. Am I right? So I will be having only 27.93. Policy Y, what is the incremental profit? Look here, 27,500 is the incremental profit. Am I right, sir? Divided by, my dear lovable students, what is the incremental investments as compared to the next last one? 1,09,375 is the incremental investment. Am I right? So 25.14%. Actually, sir, the last one 34,600 divided by 1,75,000. I'm getting 19. All the three are less. Sir, the proposed policy W should be adopted since the expected rate of return is more than the required rate of return and is highest among the given policy. Come back. Basically, both incremental approach and the return on investment, sir, is both one and the same. Sir, this ICAI has given like that, so we are proceeding like that. That's it, my dear lovable students. There are only two approaches to evaluate the data. Number 1, total approach, and number 2 is the incremental approach. Total approach means I will follow credit sales. From the credit sales, I will reduce the variable cost. I will get the contribution. From the contribution, I will reduce the fixed cost. I will get the profit. From the profit, I will be reducing the cost attributable to debtors, such as bad debt, such as collection expenses. Then I will get the expected benefit. From the expected benefit, I will reduce the opportunity cost. Then I will get the net benefit. I will choose a policy where having higher net benefit. That's it. This is what total approach is all about. I hope that you are having more clarity. With regard to incremental approach, nothing. Representation of the total approach is what? Incremental approach. In examination, if they ask incremental approach, first you solve the total approach. Then from the base, for everything you find out the difference and you present it and ensure that you are getting the right answer in the examination hall. You keep this approach, this total approach as your working note. If they ask incremental approach, main first answer, you write the incremental approach. Then it will be very easy. When I compare panni kaatnan illaya, renduku base like that. If you are simply going directly to the incremental approach, you will get confused, my dear lovable students. Don't take a chance that in examination, I have to, sir, discuss only one more conceptual topic called as, sir, factoring. What, man? Factoring. Come on. Financing of receivables. I understood one thing, that I manufactured goods today. I made credit sales. My debtors will going to pay me only after 3 months. That means for next 3 months, I am not going to get the money. Right, sir? Then I am having option called as pledging. This refers to use of firms receivable to secure a what loan? Short-term loan. I am going to bank and saying that from this debtor, Mr. X, I have to get this much money. My dear lovable students, keep this as security and give me money. This is the one form or source of working capital. Another one called as factoring. This refers to outright sale of accounts receivable to a factor or a financial agency. I'm saying that, come on, sir, I have to receive 10 lakh rupees from a debtor. You give me 10 lakh and I am ready to sell the debtor. I sold goods to the debtor. Debtor have to pay me cash. Now I am in need of cash. I am selling my debtor to a person called as what? Factor. So that factor will advance me money and that factor will collect money from my debtor at the appropriate time. That is a concept. Beautiful concept. Unexpected question for examination. So three parties will be there. Number one called as factor. This factor is like third party. And firm, sir, we only sold goods to the what? Customer. And customer will pay to the factor and factor will firm to the firm. This is how the transaction happening. So customer pays to the factor. He will not pay to us because we sold the receivable to the factor and the factor pays an agreed upon percentage of the accounts receivable to the firm. Factor will say that agreed upon percentage. For example, 10 lakh rupees is the debtor. Factor will say that I am ready to pay you 80% of itself. 80% in advance. It's like giving loan by the factor to the firm. So these are the transaction. Don't worry. The basic format of evaluating factoring proposal. So my question, as a finance manager, I'm having a doubt whether I have to wait till my debtor directly pay to me or in advance can I approach my factor. Such a financial decision I have to take. Sir, statement showing the evaluation. Sir, have you evaluated debtors management? Yes, sir. The same way you have to evaluate, man. You have to find out the annual savings or benefit on taking factoring services. Sir, instead of waiting to the debtor, if I directly go and get money from the factor, what is my annual savings? Savings in the sense means cost of credit administration saved. Yes. Sir, if I get money from factor, no need to go behind the debtor. No need to administer the debtor. That will be a savings. That cash outflow can be stopped. Point number one. Bad debts can be avoided because there is no question of what at all. Bad debt at all because I got the money from factors. Next one, interest saved due to reduction in the what collection period? Average collection. I am supposed to get money from the credit sales only after 3 months. But if I get the money today itself means I can repay my bank overdraft. I can repay my loan. I can repay from whoever I have bought the money. Correct? So I can save the what? Interest. Wherever applicable, there is no need that everywhere it has to be applicable. So cost of annual sales into rate of interest into present collection minus new collection period divided by 360 days. Okay, fine. This is a total savings you are having. Do you think that the factor person will chumma give you money? No, you will be having cost. This is what annual cost. So savings minus cost is what the net benefit. If you are having positive net benefit, go with the factor. If you are having negative net benefit, go with the debtor itself. Right, sir? What is the first thing? Factoring commission. What commission? Factoring commission. Because factor, that person will ask for commission. He will say that he will give you money. Correct? For that, he will give you commission. First of all, understand, this commission is not for the money what is giving. This commission is for the collection, what is collecting money from the debtor. So actually, debtors who will collect the money? Factor will collect the money. For that, I am going to pay him commission. But he will ensure one thing, there is no bad debt. If there is bad debt also, he will suffer that. No need to worry about me. Sir, he will pay me some money. Sir, when actually debtor will pay to the factor? When actually debtor will pay to the factor? After 3 months only. But factor is giving to me money today itself. Correct? Yes, sir. For that, he will charge interest. He will charge interest. Are you all with me? Sir, that means I have to pay to the factor both commission and also interest. Are you all with me? Sir, are you all with me? Then amount available for advance, that is annual credit sales minus what commission? Factoring commission minus what reserve? Factoring reserve into collection period divided by 360 into rate of interest will be the total. Sir, from the what minus what? Commission. From the benefit minus cost, you will get A minus B. Correct? That is a net annual benefit. If the net annual benefit is positive, go with the factor. If it is negative, sir, go with the debtor. Sir, can you do one question from this area? Why not? Why not? Surely I will solve one question. Brilliant question. Mark this as important because from factoring, sir, generally question will come. Sir, everyone study debtors management and go, ICAI will ask factoring. And one thing I will tell you, this is a ICAI study material question. This is a ICAI study material question. The same question can be lifted for 5 mark in exam from working capital. A factoring firm has a credit sales of 360 lakh and its average collection period is how many days? 30 days. That means in a year, I am making credit sales of 360 days. and always there is a delay in collection of 30 days. Financial controller estimate bad debt losses are around 2% of the credit sales. Firms spend 1,40,000 annually on what administration? So if I go with the factor, no need to incur this 1,40,000 because he will take care of the collection, but he will charge dash on me, commission on me. This cost comprises of telephonic and fax bills along with salary of staff manager. Everyone have to call the debtor and say that you have not paid the money, you have not paid the money, you have not paid the money, pay the money on time, pay the money on time, pay the money on time, right up. These are avoidable costs. A factoring firm has offered to buy the firm's what? Receivable. The factor will charge how much percent commission and will pay an advance against receivable at an interest of how much percent per annum. After withholding 10% as a reserve, that is called as factor reserve. Are you really with me? Analyze what should the firm do. So there are only two options are there. Either we ourselves can collect the money from the debtor or appoint a factor. Factor appoint panna, now we are not supposed to run behind the receivable. Point number one. Point number two, sir, we will get the money in advance. For that, we have to pay interest. We have to pay commission. Come on, analyzing. Assume 360 days in a year. Be very, very clear, man. The same question can be lifted for examination. Average level of receivable is equal to the credit sales for the entire year is 360 days, 360 lakhs. But 360 lakhs will not be debtors. Only 30 days is the debtors collection period. So 360 into 30 divided by 360 comes to 30 lakhs. Total, I have to get 30 lakhs from the debtor. Sir, if I am going to the factor, I have to pay commission to the factor. How much is the commission said in the question? 1%. So only for this 30 lakh, I am liable to pay the 1%. So 30 lakh in 1% comes to 30,000. Sir, if on this 30 lakh, whether I have to wait till the debtor giving money to me or factor will give me money? Factor will give me money, right, sir? Yes, sir. Sir, how much percent reserve he will keep? 10%. Up 30 lakhs into 10% comes to 3 lakh. That means this 3 lakh he will not give. This 3 lakh he will not give. So actually think, practically think. How you have to think, I will tell you. You think as you factor. You are a factor. I have to get how much lakhs from a party? 30 lakhs. I am saying that, Matambi, I am full time busy in teaching. Ba. Hello, sir. Yes, sir. You just go and collect for me. I will give you what? Commission. How much commission you need? 1%. How much amount? 30,000. 30,000. Correct? Yes, sir. And, sir, whether you know that debtor will give money or not? No, you don't know. You won't give me 100% money to me. Hello, sir. If you give me 100% money to me, sometimes I may run away. And tomorrow, if any case between you and debtor, I will say that, and if you go and ask to the debtor that, sir, the debtor will say that, have I purchased from you? Such legal issues may come to you. So always the factor will hold some person called as factoring reserve, factor reserve. What reserve? So you will say, you are saying that, sir, I won't give you 3 lakh now. That 3 lakh I will give you at the end. That is after 3 months. So you want how much as commission? 30,000 commission. How much reserve? 3 lakh. So in your pocket you will put 3 lakh 30,000. That means, my dear lovable students, total 3 lakh 30,000 you will hold. Thus the amount available for advance is the average level of receivable. Right, sir? So I have to get 30 lakhs from my debtor. That anyway he will pay me only after 3 months. That you are ready to pay me, but you won't pay me 30 lakh. On that 3 lakh is your reserve. 30,000 is your commission. So 3 lakh 30,000 you will hold, right? So from calculator, 30 lakhs minus 3 lakh 30,000 means balance how much you will pay? 26 lakh 70,000. Only on 26 lakh 70,000 I am liable to pay interest to you. Because that is the advance you have made. Are you really with me? My dear lovable students, how much percent interest? So 26 lakh 70,000 into 15% into, it is only for how many days? 30 divided by 360 comes to 33,375 is the amount of interest. I have to pay you 30,000 for commission, 3 lakhs for reserve, 33,375 for interest. Totally calculator 30,000 plus 3 lakh plus 33,375 comes to 3 lakh 63,375. This much amount I am liable to pay to you. 30 lakhs you have to pay to me. 30 lakhs you have to pay to me. Correct? Shall we net off? Shall we net off? Up 30 lakhs minus Sir, total எவ்வளவு சொன்ன? 3,63,375 comes to 26,36,625 only you will pay to me. This is what net amount of advance available. Concept clear? Can I proceed? Now I am, till now I have done the basic working. Now I am checking that whether to go with the factor or go with the debtor. Go with the factor, go with the debtor. Come on. Sir, if the benefit is more than the cost, I will go with the factor. If the benefit is lesser, I will go with the debtor. I will wait for the debtor to give me money. Sir, if I am going with the factor, no need to run behind the debtor. Every day, no need to call the, hey, kaas kodra, time achra, kaas kodra, picture vendiye. So I can, sir, send those staffs. I can send those staffs that no need to pay salary to those people. I can save salary. That's what? Cost of credit administration. How much like I can save? 1,40,000. And one thing is guaranteed that if I am going with the factor, no risk of what debt at all. Because the factor may keep knife also in the neck of the debtor and he will get the money. Because he is Raja, Vasul Raja, MBBS. Yaru, factor. But I am not such a person. I don't live with me. So there is no question of what at all. Bad debts at all. So bad debts can be saved. It's a savings for me. So tell me, what is the annual sale? 360 lakhs. Am I right? Into what is the existing bad debts person? Solliya. 2% comes to 7,20,000. Correct? Sir, this is the total annual benefit. But I am not evaluating for annual. I am evaluating only for how many days? 30 days. Don't worry. I'll come to 30 days. I'll convert everything into 30 days. Hello? Because credit administration is not for 30 days. Yeah, only 30 days you need money from debtor. For the entire year, you have to, sir, run behind them. Am I right? And bad debt will only for 30 days or for the entire year. So this is annual cost. Don't worry. So the benefit is in annual. So automatically cost should also in annual. Then only annual minus annual, I will get the annual benefit. Otherwise, sir, mangi minus donkey, I will get mangadang. Correct? So my dear lovable students, I have to reduce the cost of the firm. Hey, you tell me without seeing. What is the first cost? Commission. Commission, how much already we find out? Working out, 30,000. It is for how many days? Calculator. 30,000 divided by 30 into 360 comes to 3,60,000 is the annual commission. Am I right? Sir, why are you converting into annual, sir? Because the benefit is on annual, sir. So cost should also be on. Come on, sir. Factoring commission. Correct? Murcha check. Factoring commission. Now interest charges. Have we already calculated interest charge? 33,375. That is for how many days? Divided by 30 into 360 comes to 4,500,000. Hello. So totally annually I have to spend 7,60,500. My annual benefit is 8,60,000. So 8,60,000 minus 7,60,500 comes to 99,500 is net benefit. Comfortable. Since the net benefit is positive, savings to the firm exceeds the cost of the firm on account of factoring. Therefore, the proposal is acceptable. Better than you go and run behind the debtor. You just give to the and say that, Tambi, ni patuko Tambi. Hello. So it's a three-party transaction. Number one, firm will be there, debtor will be there, and factor will be there. Right, sir? What is happening? What are the cash inflows and cash outflows? What is happening? Take this question as a base question. Keep this question in your brain as a concept question. How much is the annual sale? 360 lakhs. Right, sir? Sir, how much is the debtor's collection period? 30 days. So 360 into 30 divided by 360 comes to 30 lakhs. So 30 lakhs is what I have to get money. If I am going to the factor, he will reserve money to the extent of 10% in this question. So 3 lakh he won't give me now. Hello? Yes, sir. Then number two, since he is running behind the debtor, he will ask for commission. That commission is 1%. 30 lakhs in 1% comes to that 30,000 also he will not give. Correct? That means he will give the balance money. The balance money means 30 lakh minus 3 lakh, 27 lakh. 27 lakh minus 30,000 comes to 26 lakh 70,000. So that much money, 26 lakh 70,000 today he will give me as check. So he is advancing me. He is actually giving me a loan 26 lakh 70,000 he is giving me a loan. On what basis he is giving me a loan? With the security of the debtor. With the security of the, so for this 26 lakh 70,000 I am liable to pay interest to him, correct? Into 15% into 30 divided by 360 means 33,375 interest I am liable to pay to him. So from my 30 lakh, he will reduce first 3 lakh, balance 27 lakh. From that 27 lakh, he will reduce his commission 30,000 minus interest I am supposed to pay 33,375. So the net cash inflow will be 26 lakh 36,625. This is not the benefit. This is cash inflow, cash outflow calculation. Hello. Sir, based on this, don't take a decision. Sir, don't take a decision that if I go with the factor, I will get 26 lakh. If I go with the debtor, I will get 30 lakh. No, because this is just a cash flow analysis, correct? Now only I am going to analyze if I go with the factor. Sir, what is my benefit? My benefit, no need to incur the bad debts. Number one, bad debts. How much is the current bad debt? 2%. 2%. So 360 lakhs into 2% comes to 7,20,000. If you want, you convert into 30 days also. I don't have any problem. But the bad debt has been expressed for 1 year. That's why I'm calculating for 1 year. And what is the second benefit you will be getting? What is the second benefit you will be getting? If I go with factor, there is no credit administration. What is annual credit administration? So I can save 1,40,000. Purida. So I can save 1,40,000 plus 7,20,000. I will be having a benefit of 8,60,000. Comfortable. But summa I have to incur the cost. The first cost already I calculated is the commission. What is the commission for 30 days? 30,000. That is for 30 days. Divided by 30 into 360 comes to 3,60,000. Comfortable. And my dear lovable students, what is the interest for 30 days? 33,375 divided by 30 into 360 comes to 4,500,000. That means this is my total cost. Since the annual benefit is higher than the total annual cost, I have to go with the factor is better. That's what they are explaining. Factoring, one of the expected question for examination, my dear lovable students. And this is a ICAI study material question. I hope that you will be having a big understanding now. Now you just look at here, man. Annual savings, cost of credit administration saved. As per our question, what is the cost of credit administration saved? 1,40,000. No need to pay 1,40,000. Bad debts avoided. 7,20,000. Right, sir? Interest saved in this question. There is no interest saved. That's why they are saying wherever applicable. Right, sir? So 140 plus 720 comes to 8 lakh. This is the total benefit. Annual benefit. Am I right, sir? Annual cost. Factoring commission. How much is the factoring commission? 30,000. That is for 30 days. But we want for 360 days. Total comes to 3,60,000. Then interest charged by factor. What is the interest charged? 33,375. That is for 30 days. We want for some amount you will be getting. Right, sir? On what figure you have to calculate is what this calculation. Nothing. Amount available for advance. Amount available for advance means annual credit sales. What is annual credit sales? 360 lakhs. 360 credit period on the 30 days. So into 30 divided by 360 means only 30 lakhs. Correct? Out of that 30 lakh, factoring commission I have to reduce. How much? 30,000 is the factoring commission. Minus factoring reserve, 3 lakh. That means balance is only going to give me 26 lakh 70,000. Comfortable? That's what NSR into that amount into collection period divided by 360. Correct? Into rate of interest. So 26 lakh 70,000 into 30 divided by 360 comes to rate. First rate. 26 lakh 70,000 into 15%. 4 lakh 500 into collection period divided by 360. 30 divided by 360. This is the interest I am supposed to pay. Every number are you able to appreciate? Now net annual benefit, which is nothing but A minus B. What is A? What is A? A means what? Number A means what? Savings if I go with the factor. What is B? Cost. If I have to incur if I go with the factor. Net annual benefit or cost of factoring to the firm. What is the rate of effect of this rate of effective cost of factoring to the firm? Net annual cost of factoring. What is the net annual cost? What you got? Net annual cost of factoring. கீழே வந்துச்சு, இங்க வந்துச்சு net annual cost. இங்க net annual cost. ஐயோ, that is a benefit you got. Net annual cost. Ah, 7,60,500 is the net annual cost, right? Okay, divided by what is the amount available for advance. Relax is the reserve, 26 lakh 36,625 into 100, right sir? What is the rate you are getting? 28.84%. This is the factoring cost you are incurring. Hello sir? Net annual cost of factoring or divided by advance to be paid in 100 also. Advance means amount available for advance minus interest deducted by factor. It's okay, fine. They are calculating the Ama 26 lakh 70,000. 20 that is two approach. Either you can put in 26 lakh 36,625 or 7,60,500 divided by 26,70,000 into 100. எப்படி வேணா calculate பண்ணலாம்னு சொல்றாங்க. Both are two approach. What you are going to calculate? No, effective cost of factoring to the firm. That means if I go with the factoring, what is the percentage I have to spend? Okay, முன்னாடி sir, I have to spend savings, collection expense how much? Question கீழே கீழே இருக்கிறனால போய் பார்க்க வேண்டாம்னு சொல்லி தான் உங்கள்கிட்ட சொல்றேன். 1,40,000 plus 7,20,000. அப்போ 1,40,000 plus 7,20,000 8 lakh upon 30 lakhs is what the data is. Correct? Calculator 8,60,000 divided by 30 lakhs into 100 comes to 30 lakhs தானே data se. Yes sir. 28.67%. Correct? Yes sir. 28.67%. எப்போ முன்னாடி கரெக்டா? இப்போ காஸ்ட் அதிகமா இருக்கா? 28.84 ஆயிருக்கா? எதுல? இதுலயா? ரெண்டாவதுலயா? 28.48%. Okay. This is less. Here you are getting 7,20,000 divided by 8,60,000 divided by 30 lakhs into 100 pota 28.67. Okay, this is only 28.48. Actually, the cost of factor should be less. Then only I will go with the factor. Logic clear dane? Sir, earlier I was spending 8,60,000 for 30 lakhs, sir. Yes, sir. It's not 30 lakhs, no. It is 320 lakhs, no. 360 lakhs. So this is 30 lakhs is wrong, sir. Sir, earlier I was saying because annual 8,60,000 divided by 360 lakhs into 100 na 2.38% is the cost I was incurring annually. Whereas if I go with the factor, what is the cost I was incurring with the factor? What is the cost I was incurring with the factor? Net annual cost of factoring. Kida denominator. Net annual cost of factoring. $7,60,500. So 7,60,500 divided by annual credit sale, how much? 360 lakhs into 100 means 2.11, right? But earlier it was 2.33. So earlier cost was higher. So since earlier cost was higher, it's better to go with the factor. That's what the one. So next one. There is a concept called as forfeiting. How factoring, there is another concept called as what? Forfeiting. Forfeiting is an arrangement of bills discounting in which a financial institution or a bank buys the trade bills, invoices or trade receivable from the exporters of the what or what, where the exporter relinquishes right to receive payment from the importer. For example, sir, in factoring actually I am not relinquishing the NSR payment. Still NSR debtor is liable to pay to me, but I am asking to the debtor that don't pay to me, pay to the factor. But forfeiting means I forfeited, forfeiture of share. Have you heard about it? That's it. It's closed. That means I am giving the rights of my receivable to the bank. So bank will give me money. The functionality can be understood in the following manner. For example, exporter sells what or what? Goods or service. Importer draws LC. LC means what? Letter of credit. So two parties will be there. One is what? Exporter. And importer will be there and exporter's bank will be there. Correct? Exporter approach the bank and bank pays the exporter. Then now from bank will collect from importer. Now the importer is not liable to pay to the exporter at all. Importer is liable to pay to the exporter bank or bank basically. Are you with me? This concept is called as forfeiting. This concept is called as, that's it. That's it. We are done with the debtors management. What are the topics to be taken care in debtors management? Number one, estimation of the debtors management using the total approach. Estimation of the debtors management using the incremental approach. And third one, factoring. Factoring. Are you really with me? If you go through this three topic, that is debtors management comes to an end. That's it. We are pending only with one topic called as cash management. You have to prepare a cash budget. Once you prepare the cash management, that's it. Dandanaka done with the FM. FM comes to an end. Have a revision of debtors management. Solve the question. Come back. We will deal with the cash management. Prachi Limited question. This is an ICAI study material question. Prachi Limited is manufacturing company producing and selling a range of cleaning products to wholesale customers. They are selling something. Okay. It has 3 suppliers and 2 customers. Super. Abdina debtor 1, debtor 2, debtor 3 and creditor 1 and creditor 2. From debtor they have to get the money and to creditor they have to pay the money. Prachi Limited relies on its cleared fund forecast to manage its cash. This is the crux of the question. There is a concept called as cleared fund forecast. I will teach you what is cleared fund forecast. You are an accounting technician for the company and have been asked to prepare a cleared fund forecast for the period Saturday 9th August, Saturday 9 August to Wednesday 13th August. Abdina 9, 10, 11, 12, 13. You have to prepare 5 days cash budget. That's it. You have been provided with the following information. Okay. Sir, receipts from customer. We are having how many customers? 3 customers. 3 debtors, no. 3 suppliers. 3 suppliers and 2 customers. So, 3 suppliers na. Suppliers na creditors. And what? Customers means debtors. Correct? I am having 2 debtors and 3 suppliers. So, debtor 1, debtor 2. Creditor 1, creditor 2, creditor 3. A receipt from customers. Sir, what is with regard to customer? Customer means I have to get money from the debtor. I am having W limited and X limited. Sir, what is the credit terms? 1 month, calendar month. 1 calendar month. That means if I sell today, I will get money only after 1 month. Payment, sir, BACS, that is some bankers, automated clearing services. Bracket. Okay, right. Sir, how much sales happened on 9th August? 1,50,000. 9th July, 1 lakh. Look at. 9th July na 9th August it will come. Because 1 month credit. So on this day, this 130 you will get. But this 150 you won't get. Correct? 140 you will get after 1 month. So when I prepare the next month cash budget, this 150 will come. But X limited, none, no credit sales. Check only, my dear. Sir, today's check, sir, 1,80,000. Today itself, money will come in bank. This 160 would have came last July itself. I am not preparing for July. I am preparing for August. Am I right? So this 160 is irrelevant for the data now. Receipt of monies by backs, sir, is instantaneous. Instantaneous means IMPS. So when they made the transfer, immediately money will come to our account. That's it. Appo eppa transfer pannirpanga? 9th July I made the sale. 9th August they will transfer. 9th August itself I will get the money. On the 9th August, look at here. On the 9th August, Saturday, hello sir, from W Limited, I would have got 1,30,000 or no other information. That's it. One data done. Comfortable? What is the status of the next one, man? X Limited checks will be paid into Pranchi's bank account on the same day as the sale is made and will clear on the third day following this, excluding the day of payment. Excluding the day of payment. When you deposited 9th, so leave 9th, then 10, 11, 12. So on 12th, on the third day, on 12th, will the money of 1,80,000 will be credited? Yes, sir. So come on. Sir, in your cash account, 9, 1,80,000 have not came. Sir, 10, this is 10, 10, 11 and 12. 12, 1,80,000 came. Correct? That means when you deposited that money into the bank, 9th, that means on 9th, come on, on 9th, uncleared fund float. Uncleared fund float means I deposited but money has not been cleared. So on this day, 1,80,000 it will show. This day also 1,80,000 it will show. This day also 1,80,000 it will show, but here it will get cleared. That means till it clear, their cash account will show that, okay, this much money has to be cleared. Easy pa. I will leave with me. Come to the next one. Payment to supplier. How many supplier? 3 supplier. A Limited, B Limited, C Limited. Correct? Sir, credit terms 1 calendar month. 1 calendar month means, sir, payment is standing order. Standing order means I said to the bank that every month you pay something. That's what standing order is all about. Right? 9th August purchases 65,000. When I made purchase? 9th August. I am preparing cash budgets for August. August 9, 10, 11, 12, 13. Comfortable? After 1 month only I will make the payment. So this will not considered at all. So what is the August Munadi month? July. Sir, July 9th I purchase. So I will make payment on 9th of August. Am I right? What is the value? 55,000. Clarity I don't agree with me. Yes, sir. Sir, 9th June. 9th June means it would have paid on 9th July. So this is irrelevant because I am preparing cash budget for August. Come on. Pranchi has set up a standing order for how much? 45,000 for a month to pay for the supplier from A Limited. This will leave Pranchi's bank account on 9th August. Every few months, an adjustment is made to reflect the actual cost of supply purchase. You do not need to make this adjustment. Sir, what Pranchi is doing? No, they are making payment to supplier, which is A Limited, right? Sir, 9th August, they purchase 65,000, correct? My dear lovable students, this 65,000, they will not make payment now. They will make the payment in the next month. But this 9th July, they will make the payment on 9th of September. August. Sir, how much is the payment? 55,000. So 55,000 purchase I made on 9th of July. Correct? That payment I will made exactly after 1 calendar month. That means 9th of September, I will make 45,000 rupees payment. Am I right? Yes, sir. Are you really with me? Sir, clearly understand? This is irrelevant data. This is irrelevant data for this month. It will come only the next month. Sir, last month 9th, I made a purchase of 55,000. If that is the case, means this month 9th, I have to pay 45,000. Are you really with me? So last month purchase how much? 55,000. So current month payment 45,000. 45,000. Why? Because it's standing order. Whatever may be the purchase I made, every month I will pay only 45,000. Sir, then balance 10,000. It will be adjusted in the next month. That's what they are saying. Pranchi has set up a standing order for how much? 45,000. A month to pay for supplier from A Limited. From A Limited, they will pay only 45,000. This will leave Pranchi's bank account on 9th of August. So from 9th of August, look here, outflow. Payment, 9th of August. This is 9th. 45 will go for the A Limited. Are you really with me? Yes, sir. Nothing more, nothing less. Sir, up 10,000 extra, sir. Every few months, sir, adjustment is made to reflect the actual cost of supplies purchase. You do not need to make this adjustment. Balance 10,000, you don't worry. That future automatically it will adjust it. Okay, wow. Next, B Limited. How much calendar month? 2 months calendar. How you are making payment? Check. Check na, sir, Q you have to make in the cash. Correct? Yes, sir. Sir, this month irrelevant. This month also irrelevant because 2 months period. Correct? Only 75 is valid. Because if I purchase on 9th June, I will make payment on 9th September. July, August. Correct? 9th of August. I'm preparing cash budget for August. So this 75,000 is valid. Let me ask you a question. Is this 75,000, sir, is any standing instruction? No. Branchie will send out by post check to B and what? C on 9th of August. So on 9th August only I will send the check. That day itself money will not go. But the amount will leave its bank account on the second day following this, excluding the day of posting. Leave the excluding day of posting. When they posted 9th. So leave 9th, 10, 11. 11 money will go. But till that they have to keep their bank account. That sir, payments, correct? What is the total purchase? 75,000. And this 85,000 also. Because for B and C there is no standing order. But C there is no calendar month. Correct? Sir, it is none. None means, sir, 9th August purchase made, 9th August itself they have to pay. This 95,000 they have to pay. This they would have already paid last month. This 85,000 they would have already paid last month, right? So this 75 plus 95 will be the matter. 1,70,000. And the 1,70,000 wow, where level. Comfortable? So that 1,70,000 I will show it as payable. Sir, this is uncleared fund float. In the sense means this has not gone from my bank account. But this is yet to go. Correct? When it will go, sir, 9th August over, that day only I posted, 10th August it will go. 11th August it will go, right? Yes, sir. Sir, 11th August it gone, so I have not shown it. So on 11th August, sir, I have to show it as outflow, correct? For the what limited, B limited, on 11th August, 75 gone out. And for C limited, 95 gone out. Chumma paathe cash budget. Are you all agree with me? The same question is an ICAI question, will be repeated for this time. I am expecting this question to test. Because 10 mark cash budget, no one will prepare. And they will give you a shock. Shock laga. Easy. Easy. Wages and salary. July month and August month. You are in the month of August. We are preparing the cash budget for August 9, 10, 11, 12, 13. Weekly wages is 12,000, 13,000. Okay. Monthly salary 56,000, 59,000. What they are going to do? Factory workers are paid cash wages weekly, every week. They will be paid 1 week wage on 13th August for the last week's work done in July. They work a week in hand. Apo, you are preparing for August, sir? Yes, sir. So whatever work they done in July, this is the work done in July, weekly wages they have given. Okay. Apo, July month they will pay only in August. August epo 13. August 13. So this day they will pay. This day they will pay 12,000. Sir, yedoda payment. July last week payment only 12,000. Correct? That they are going to make the payment on 13th of August. But August they are liable to pay 13,000. They will pay in maybe August end or September. I don't know, because I have reached only 13. Next week will not go to September. Next week will be there in August itself. Hey, I am preparing only for 5 days. Correct? So on August 13, there will be cash outflow. Correct? There will be cash outflow for wages of 12,000. Exactly matching 12,000. Comfortable? Sir, but this is monthly salary, not weekly. Monthly salary. What is the terms for monthly? All the officers, workers are paid salary monthly by BAS. You know what is BAS? BAS means immediate. When they make the payment, immediately it will reflect. Salaries for July will be paid on 9th of August. But this salary 56,000 I will pay on 9th of August. Can I make the payment? On 9th of August I have to come. 9th. Sir, salary 56,000 will go out. That's it. All other things will be dashed. Simple. Coming to the next one. Other miscellaneous payments. Every Saturday morning. Okay. Every Saturday morning. Saturday. Come on, Saturday. Come on. Sir, you are accounting technician for the company and I have been asked to prepare a cleared fund forecast for the period Saturday 9th. So Saturday, starting point Saturday. Okay. Every Saturday morning, petty cashier withdraw 200 from the company's bank account for the petty cash. The month leaves branch's bank account NSR straight away. That means every Saturday they will withdraw 200. That means, my dear lovable students, 200 will come to the cash account. Because from bank they will withdraw. Bank balance reduce and cash balance increases. Correct? This is what petty cash 200. No other thing. Okay. What they are going to do with that? The room cleaner is paid 30 from the petty cash every Monday morning. Every Monday morning, 30 rupees I will pay to the room cleaner. How much I withdrawn? 200. That will increase the cash balance, right? Now from that, 200, I am spending 30, I am spending 50, I am rupees 10. All these will affect my cash balance. அப்ப எவ்வளவு rupees வெளியே போகும்? 30 rupees வெளியே போகும். Come on, 30 rupees. Sir, what you are preparing? Cleared fund forecast. What man? Where is that 30 rupees? Monday. Monday is 11th August. Monday. Where is that 30 rupees? Nowhere is there. Because that will affect only your cash account, not the bank account. What I am preparing is the bank aspect. Sir, when I withdraw, bank balance reduces and it will come to the cash. Sir, I am not preparing petty cash, pa. Am I preparing petty cash account? It will affect only the bank and the petty cash. The money will go out of the petty cash. Correct? Yes, sir. Office stationery will be ordered by telephone. On Sunday, 10th August, to the value of rupees 300. This is paid by company debit card. Debit card. Such payment are generally seen to leave the company account on the next day, working day. So when I make the payment of 300 on Sunday, Monday it will go. So Monday, 11th August is a Monday. Monday 300 rupees will go out. Yes, sir. So till that day, so Sunday it will be uncleared. Correct? So Sunday already 1,70,000 was there. Plus 300, 1,70,300. On Monday everything will become clear. It will become zero. Never comfortable. 5 new software will be ordered over the internet on 12th August at a total cost of 6,500. On 12th of August, you ordered 5 new software. A check will be sent on the same day. Amount will leave Pranchi Limited bank account on the second day following this, excluding the day of posting. What is the day of posting? 12th. Leave 12th. Then 13, 14. From 14, 16,500 will go out of bank. Correct? But 14 is there? Not there, sir. So, but here you will not show. But it will be there in the uncleared fund float. That means from 12th. But from 12th onwards, it will show 6,000. That means what is uncleared fund means we are yet to pay 6,500. So it is an alarm to the company that don't spend too much. Please keep this much money in the bank account for sure. That is called as uncleared. Balance of Pranchi's bank account will be how much lakh? 2 lakhs on 9th August. From that only we started opening cash balance given. This represents both bank balance and the what fund? Cleared fund. So that is the starting point, man. 2 lakh. Look at here, man. Sir, cleared balance brought forward 2 lakh. You are supposed to get the cleared balance carry forward 2,28,200. Ebdina, here you are having 28,200. What is the 28,200? Sir, receipts, you got 1,30,000. Total 1,30,000. From 1,30,000, come on. 45,000 is you made payment. 56,000 you made payment. 200 you made payment. 45, 56, 200 comes to 1,01,200. From 1,30,000, if you make 1,01,200, 28,800 will be cleared. Cleared means excess money with you. So already you are having 2 lakh. Now you are having 28,800. So 2,28,800 will be the balance. That's it. Sir, this part, no, uncleared fund float is just a control account, not the cash account. Correct? Coming. Next one. Prepare a cleared fund forecast. Cleared fund forecast. Na clear another mattum podu. For the period Saturday, 7th August to Wednesday, 13th August, including using the information provided. So clearly the uncleared fund float each day. Appo, ingava. That's it. 7th August, 9th August. 9th August. Yes, 9th August to 13th August. Sir, next day, Sunday, leave pa. No receipt, no payment. That means the same 2,28,200 will be carried forward. This will be the closing balance. Correct? This will be the opening Monday. But Monday we got a paid. We paid 75 and 95. And 300 for stationery. So 175, 300 gone. We are having 228,800. So from 228,800, 1,70,300 gone means 58,500. That will carry forward to the next day. Next day we receive money from 1,80,000 from W Limited. Correct? No payment. So 58,500 plus 1,80,000 comes to 2,38,500. Next day morning 2,38,500 was there. From that wages we made 12,000 payment. Hello sir. Total 12,000 gone out. So from 2,38,500, if 12,000 gone at 2,26,500 is a cash balance. This is simply cash account. Coming to the uncleared fund float. Both under receipts and payments you will be having uncleared fund. Correct? Sir, receipt 1,80,000. From whom you got 1,80,000? From the debtor. But it has still not cleared. Sir, you made payment to the creditor 1,70,000. So total 10,000 gap was there. Correct? But we are having book balance of 2,28,800. Now, even on this day, our check has not been cleared. Even on this day, our check has not been cleared. So 170 was there and again 300 was there. So total net of 9,700. But on this day end, we were having 2,38,500. Every 2,38,500. Total book balance carry forward. $1,80,000. This was the fund to be cleared. 2,38,800. 300 net off. This we are supposed to get. This is supposed to be paid. Difference. Namakita irukku. Excess cash irukku. Correct? So last book balance was 2,38,000. Now the book balance is 2,38,500. Next month, still this has not been received. It is still receivable, but this has gone out. According to us, 1,80,000 receivable. And total book balance carry forward 2,38,000. Sir, somewhere can you manage this 2,38,500? Mele? 2,28,800 is the cleared balance. Correct? 2,28,800. Wait. 2,28,800. 2,38,500. $2,38,500 is the total book balance. Yes, sir. This become end, second day end. This is the balance on the second day end. Yes, sir. 58,500 opening balance. Yes, sir. Up 2,38,500 plus 58,500, 2,97,000. This is cleared balance. Minus 58,500 is a cleared balance. Correct? Carry forward. Correct, sir. 58,500 plus 1,80,000 is the total to be receivable. So total 2,38,500 should be there in our cash. This is actual cleared amount. This is yet to cleared amount. This is actual cleared amount. 2,28,800. This is yet to cleared amount. This already clear aanadu. This clear aga vendiyadu. Rendu setha enakku evlo irukum book la. This is, look at here. 2,38,500 is a cleared balance. Correct? But 6,500 pay minus 6,500. That means 2,32,000 will be the net balance. Here what I am showing is, sir, varavendidella vanda, udukavendidella kudutta. What is the net balance? Here 2,26,500. I am liable to pay 6,500. So I can plan my fund only to the extent of 2,20,000. Comfortable. Very good question. Easy question. I say study material question. If you look at the question, everyone will feel that, wow, it's a very big question. It is not my area. But when you read it, it's a very easy question. The same question can be tested for 10 mark in exam. My dear lovable students, we can say that we are through with the revision and the workout of the EFM. Ensure that these topics you have completed in your FM. Number one, cost of capital. This will surely come for 7 mark in exam. Cost of capital. Topic number 1. Topic number 2. Capital structure theories. This is coming for 5 mark in exam. Number 3. Arbitrage process. If it comes coming for 5 mark in exam. Number 4. EBIT-EPS analysis, a sure shot 5 mark area. Number 5, indifference point. Sir, if it comes 5 mark area for exam. Number 6, leverage analysis, mandatory 5 to 6 mark area for exam. Number 7, ratio analysis, sure shot 6 to 7 mark area for exam. Number 8, dividend decision, surely they are asking for 5 mark question from exam. Number 9, capital budgeting, oh my god, 8 to 10 mark area for exam. And the last one, working capital management, a 6 to 7 mark area for exam. Sir, in this, if you are asking me, can I take, is there any irregular area? This is one of the irregular area. I will never say that this will not come in exam. But this, if time shortage, if you don't have time, arbitrage process, you can keep it at the end. Sir, the next one, you can keep it at the end. Capital structure theory is also okay. 2 topics. Other than these 2, all the topics are regular topics. You have to prepare. These are the top 10 movies of the sir. If you are preparing these 10 topics out of 50, you can write for 50 in examination. It's very happy to say that we have completed the entire revision and the workout of the EFM. That's it. Sir, thank you for watching, my dear lovable students. You can update your reviews regarding the classes to this number 960-500-1043. I hope that I tried my level best to give you the conceptual clarity. You can inform me how you are feeling. I'm wishing you all the very best for the coming examination. Thank you. Bye-bye from ANM.